Hi everyone, welcome. We're going to get started now. So, just like to start by welcoming everyone here in person and also all of our virtual attendees. My name's George Beattie. I'm Head of Innovation at CFC, and I have the pleasure of being the chair for this morning's proceedings. Really all that means is I'm going to help us get from session to session safely and help you get into your coffee break as well. As the chair, I've been asked to provide some opening remarks. But given all of the brainpower gathered in the room, it feels somewhat perverse for me to force my relatively or comparatively basic worldview on you all. So I just want to offer some really initial thoughts as to why I'm excited to be here. So firstly, it's great to gather people together with the backgrounds that you all have. I'm struck by the increasing positivity in the market. Despite some really tough press that continues to arise, the market remains extremely resilient and focused on its mission. And it's a mission that we all know in this room must work. The world simply does not have enough tools in the tool shed with which to fight the climate crisis, and the carbon markets remains, at its best, one of the only real, tangible efforts that we can collectively make. So there's a real renewed sense of urgency to get deals done, and it's a great time to have this event. And you're going to hear a bit more about me and CFC and what my team is doing later on, and so that'll be great. So I'm just going to mention some things about housekeeping. So firstly, I'd like to thank all of our sponsors, partners, and speakers for their support. It wouldn't really happen without you. For those in the room, I'd like to remind you of where the fire exits are if it's not obvious. There's one there and one there. I'd like to remind you that there is an event app, so please download it. It gives you content on the day, but it also allows you to connect with fellow delegates, which can be nice as an icebreaker, so you can find the people you want to talk to and then stalk them later and hunt them down in the coffee break. I'd also like to remind you of a delegate questionnaire. So please have a look at this. I think you've all got one in front of you at some point. Give that a look and please fill it out. Lastly, just want to mention again, the event is being streamed, live streamed, and there are some attendees joining virtually. So with that, I want to kick us off by introducing Rachel Kite, who is the UK Special Representative for Climate in the UK government. Rachel's keynote address is pre-recorded, so that's going to start just now.
Hello, my name is Rachel Kite and I'm the UK's Special Representative for Climate, and I'm so sorry I can't be with you in person, but I'm here in Rio de Janeiro at important conversations around climate finance in the run-up to COP30. You don't need me to tell you the importance of these kinds of meetings as we try to build high-integrity carbon markets, compliance markets, alongside Article 6 activity, alongside what we hope will be the growth of voluntary carbon markets. Since I came on board as the Special Representative about 6 months ago, I've made it my business to see how we as the UK can really drive action across all of the aspects of carbon markets, from helping other countries to build the capacity that they need to understand the role that carbon markets will play in their own development and their own prosperity, but also to ensure that the international community works with determination to allow the carbon markets to play the role we need them to play. At COP29, we launched as the UK the voluntary principles for voluntary carbon markets, and we're out with public consultation on this at the moment. We're interested in what our business sector has to say, interested in the financial sector's feedback, as well as that of civil society. This will be important as we figure out how we can play a role as the UK, what our businesses need, as we position and continue to position the City of London as really one of the most extraordinary hubs of carbon market activity across all facets of what it takes to build high integrity markets. And as we seek to be a partner, a reliable partner of choice for other countries as they seek to understand and use the carbon markets effectively. Since Glasgow and COP26, there's been an extraordinary effort to really understand what integrity means and to build the mechanisms for integrity in the voluntary markets. At COP29, we finally got Article 6 over the line. And we've also seen the growth of compliance markets. And now Brazil in particular is interested in the interoperability of markets around the world so that we can get closer to the prices that carbon markets should really achieve, to integrity on the supply side and demand side, and the ability to both jurisdictionally at the project level drive carbon market activity. And it has to be a purposeful market in the voluntary sector, but it also should be purposeful overall. How countries use the proceeds from their carbon markets will be a driver of how they achieve their NDCs. But the use of the carbon markets will be absolutely essential, especially for hard-to-abate sectors, as they try to move more quickly through their transitions and need to access the markets in order to be able to do this. And of course, the additionality of how we manage the carbon markets from a country jurisdictional perspective is an important issue and one that remains sort of technically up for discussion in many countries. So we see the devastating news of still rising deforestation rates in some parts of the world, but we also see in other parts of the world that countries are getting their arms around deforestation and it's beginning to drop away. But we also know that we have a real need to deploy these markets in the really difficult challenges of phasing out and away from fossil fuels. Different countries need the carbon markets to do different things for them, but the one thing that is true across all kinds of carbon markets and across all jurisdictions is the fact that they have to be high integrity. The slings and arrows of the attacks on different aspects of the carbon markets and whether or not markets can play the role that we expect them to play have been at a crescendo in recent years. But what I see as I travel all around the world, here in Brazil, across Southeast Asia, across Africa in recent months, is that there is a determination and a pragmatism about the fact that there is no way that we will be able to finance the transition of hard-to-abate sectors, nor will we be able to generate the revenue flows that we need to protect nature so that nature can protect us, unless we have robust carbon markets, unless the prices are the real prices, unless we have the differentiation we need for different products and services in those markets, unless we have the insurance industry coming in and insuring against the possible threat to the supply integrity of the markets. These are all extraordinary opportunities in using new technologies, the kind of work the World Bank Group and others are doing, the extraordinary innovation that we know exists within the private sector. These are all reasons to embrace the markets and hold ourselves to account to build markets that can be working with integrity and can deliver the results we need. When I look at COP30, which will be a COP in the Amazon, a COP that will put nature finance at the front and centre of its work, I can't imagine what would be more important than be able to tell a really strong story about integrity and effectiveness and effective prices and financial flows in carbon markets, whether they be markets of trading schemes, whether they be the markets of voluntary activity, or whether they be the markets allowed for under Article 6. It's taken us too long to get to this point, but I know that there is determination amongst all of you that we can go the extra mile. The perfect should not be the enemy of the good, but the good has to be good enough. There's lots for us to talk about. I'm sorry I'm not there with you, but Godspeed.
So thank you very much to Rachel Kype for that fantastic talk, a really resounding vote of confidence in the strength of high-fidelity carbon markets. So I'd like to move now to our first panel. I'd like to invite Katerina Busuttil to the stage. Katerina is Head of Standards Development at the Voluntary Carbon Markets, BSI, and she is going to introduce her fellow panelists. So over to you.
Okay, good morning everybody. Just very briefly, just to give you some context on what we're covering today. As Rachel said, the climate change is a real issue and it's something that we have to tackle, and it's really quite critical that we stay within the 1.5 degree threshold that was set in the Paris Agreement. We do know that there is quite a lot of finance that's being allocated to this by countries, and that is around the $300 billion mark per year up to 2035. But at COP29, we also were told that this is far short of what is actually required to maintain that 1.5 degree. So this is basically where the carbon markets can come in as one of those tools. And at this point, we need to work out how they're going to come in, what they can give us, and how the UK can actually support and lead in terms of the international global carbon markets. So that was just a brief introduction. I'd like to introduce my fellow panelists and ask them some questions about how the UK is getting involved in voluntary carbon markets. So I'll invite Bronek up, if I can see Bronek. And Chris and Adrian. So if you'd like to introduce yourselves, starting from my left, Bronek.
Good morning, everybody. My name is Bronek Masciarda. I am, as it says, an alderman of the City of London, and I'm their nominee on the Carbon Markets Forum. Previously, I was chief executive of a FTSE 100 company. So I've sat on the other side of the table, actually trying to grapple with the corporates and how do you navigate through the path to net zero, and practically, how do you deliver it, and how do you engage your workforce, your shareholders, to do that. Now I'm slightly on the other side of the table, but I'm bringing that knowledge with me. And I'm clearly pretty new to this side of the table. But what I've learned already is that within the whole climate change area, everyone in this room is very passionate about it. Everyone has very good ideas about what other people should do. I'm much more practical than that. When I was FTSE trying to get carbon neutral, I remember the first year we decided we were going to be a carbon neutral firm. We ended up funding various projects around stoves in Africa. I wasn't sadly surprised when a few years later it turned out a lot of those projects didn't have veracity. The second year we got involved in a Texan wind farm because I felt there was veracity in that what was said would happen would actually happen. And now we need to scale that. And I think the UK has a wonderful role to play in scaling that, not just because of our leadership in the ETS, the government-mandated EU and UK ETS. I met somebody earlier on this morning who's trading ETSs for Barclays. But we can take that skill set and put it in the voluntary carbon markets as well, because we also have other skills. Going back to my little example, I was trying at a personal level to try and evaluate the pros and cons of different carbon projects. But we have huge rating capability. If you're in the bond market, every bond can have a rating, and there are independent experts who will rate different bonds issued by different companies. We have the skill sets, and there are firms already taking that and making that available for different projects which are available. Because high integrity is important, but we all know that every carbon project isn't the same. It's not a pass-fail, there's a gradation. And I think we have the skills to do that. Clearly, we have the interest, but I think, again, one of my personal pleas is that we get our head around what is the role of carbon neutrality in the road to net zero. Because somehow you have to do A, B, C, and D, and then you can use carbon credits. Whereas my view when I was running a business was, let's go carbon neutral today, and that gives us a price of then all our mitigation efforts about what's worth doing. And as the price goes up, well, then we can fund more and more mitigation efforts, and that will then accelerate the transition. And when I get involved in the debate now, it's like, no, you can only do that right at the end, after you've done everything else. For me, if this is a crisis, we need to act now, and carbon neutrality is a very good way of doing that. And I hope that in the forthcoming government consultation, that is recognised. My other challenge is to all of you in the room. You're all believers. Nobody in this room is net zero personally. I decided I want to become carbon neutral personally. So I went online to try and buy carbon credits to offset my family's personal consumption. And it's pretty easy to buy a renewable electricity tariff. It doesn't say carbon neutral, it doesn't say net zero, it just says renewable. But beyond that, it's impossible. There's no way where you can easily go online. You don't know where the money's going. You don't know whether it's going to be delivered. So I think there's a real opportunity to create a transparent market for carbon credits with a rating. So I know whether I'm buying a 5-star rating, a 4-star rating, and a 3-star rating. And that's how we can drive demand. And if there's demand, the price will go up. And if the price will go up, we can finance more investments in getting to net zero. And it's getting that virtuous circle started. That's why I want to be involved. Because I agree, like our previous speaker, that we can't let the perfect be the enemy of progress. And to me, progress at this stage is way more important than perfection. Perfection will come over time. But so my challenge is there will be the City of London's Carbon Action Week in July, that if any of you are the audience then, and I say, please put your hand up if you're carbon neutral. I'm not going to ask the question, who's carbon neutral in the audience today? Okay, 3 people. I'm not. And we're all believers. And if we, the believers, can't do it, how can we ask the skeptics to do that? So my challenge is that let's hope by July you've all gone online and figured it through, and maybe somebody will see there's an opportunity to create an easily accessible, verifiable market where people can just go and buy carbon credits to actually, at a personal level, take real action. Thank you.
Thank you. Thank you. If I can ask Chris.
Hi, thanks. Nice to be here. I'm Chris Shipley, Head of Global Carbon Markets at the UK Department for Energy Security and Net Zero. So my team manage a part of our ODA portfolio that supports carbon pricing and access to carbon markets in emerging markets and developing economies. We manage input into the Article 6 negotiations, and we manage the voluntary market policy, including the open public consultation. So I think I'd like to talk a little bit about some of the opportunities and risks that the UK government sees in this space. Rachel set some of them out already, and Rachel's a pretty hard act to follow, but I'll give it a go. So, we come at this as a long-standing advocate for the use of carbon markets to foster more cost-effective emissions reductions, to realise sustainable development benefits, to enhance climate ambition. And that's clear, I think, from our long history of pricing emissions through the UK Emissions Trading Scheme, then the UK-EU, now UK, and now we're talking to the EU again. It's also demonstrated through our support for uptake in developing countries, so where we're helping 20-plus countries with the technical assistance they need in order to access carbon markets with confidence. It's also hard at work, domestically as well on nature standards in the UK. So we have the Woodland Carbon Code, we have the Peatland Code, and we're working with BSI actually on new nature standards in the UK. And internationally, of course, we continue to advocate through the UNFCCC for strong Article 6 rules. And we're very pleased, obviously, to reach agreement on the framework there in Glasgow at COP26. And it was in the run-up to COP26, during our presidency, that we turned our attention then really to voluntary carbon markets, because there was a welcome sudden deluge of corporates coming forward with net zero targets, and of course that brought up the question of how you address residual emissions, how you address those emissions that could not feasibly be abated. And so back then we seed funded 2 initiatives which many will be familiar with here, the Integrity Council for the Voluntary Carbon Market and the Voluntary Carbon Market Integrity Initiative, which since then have come forward with outputs. And I'll go into those in a little bit more detail later on. But essentially in the voluntary markets we see an opportunity to raise significantly more finance than has been raised to date. At the moment, as Rachel said, we can't leave any stone unturned. Like, climate finance goals are steep, must be met, and it's on us to maximise every possible modality in doing so. Markets obviously also offer an opportunity for businesses to address or take responsibility for emissions that they can't feasibly abate, and that question of what is feasible is one that we're exploring in the consultation. And there's also an opportunity now since, as I said, VCMI and ICVCM have issued outputs now. And there's evidence as well, that early evidence, I would say, that ICVCM's outputs are driving improvements in the market. So, for instance, we see methodologies making changes to what they disclose and how they operate in order to get that CCP certification. So these standards are ready now, and we think it's on governments to take a view and to endorse where they see fit and to put those into practice. And of course 6.4, which agreed at COP29, and since then we've had some positive developments in terms of like the additionality rules, and more recently on baselines and leakage provisions. So big opportunities there, I think, which we should seize. And also, City of London, the UK, are very well placed to shape and benefit from these markets. So deep history of emissions trading and the infrastructure that underpins that. New insurance products, which I'm sure we'll hear about later, which are helping give buyers and investors the confidence they need to transact. A web of project developers, new market intelligence firms, Silvera, B0, new registries, Isometric, and so on. So, as we say in the consultation, we want carbon markets to be part of London's growth story, and there's a good opportunity for us to put that expertise into practice in shaping the market, I think. I mean, risks remain as well. We want to unlock finance through the market, but that can't displace action on source emissions. So there's a balance to be struck. We go into this a little bit in the consultation, essentially what we are doing is proposing to endorse VCMI's Claims Code of Practice as representing international best practice, the sort of North Star, if you like. But we also recognise that that's very challenging or extremely challenging for some companies to meet. And so what we're looking for is a pathway to bring those companies that are unable to, say, set scopes 1 and 3 targets, interim targets, net zero targets, report against those transparently, be on a net zero pathway, etc. What could we do? Very hard to do that. We think there's a big reservoir of potential climate finance that could be tapped if we were to find a pathway that enabled companies to buy credits who can't quite meet those criteria. But yes, of course, that can never displace investment into value chain emissions. So there's a balance to be struck there, and hopefully we'll get lots of views through the consultation. I think a final risk, I think, is fragmentation a bit. Obviously, there are countries, companies, international organisations engaging in carbon markets in ways that they see fit, and in many cases this reflects national prerogatives. It's up to a country to decide how it wants to engage, but that can also lead to fragmentation and friction a little bit. So we also say in the consultation that it's important that countries act together to sort of coalesce around standards, to agree where they can, aligned regulations, legal classifications, those kinds of things, and to cooperate as well on that bit in the middle, if you like, the data models, registries, and making sure that those are set up in a way that's interoperable, that reduces friction, supports trade. This is a risk, but I think it's one that the community is starting to address. It's just on us, I think, to contribute. I will stop there, but thank you.
Thank you, Chris. Adrian?
Thank you. Nice to see you all today. So my name's Adrian Rimmer. I'm part of the Sustainable Finance team within London Stock Exchange Group, and as part of that, I lead our work on carbon and nature markets. And I think it's important to sort of highlight here the group as a whole is far bigger than the London Stock Exchange itself. We have so far looked at how we can play a role in helping scale markets and applying the various different business activities that we have, from the exchange itself to clearing to data and analytics, to really think about how we can help bring financial markets infrastructure to bear to help scale this market. I've been in this space for the last 20 years, from investment banking into sustainable finance, really looking at how we drive capital into addressing climate and environmental issues. And as part of that, I've been in carbon markets for a good chunk of that. So I was CEO of Gold Standard for 5 years, and built out the carbon desk at ABN AMRO way back. So I've seen this market evolve, and as we look at how London Stock Exchange Group can play a role, and the City of London generally, then we've really started to think about how we institutionalize this market. It's very early stage, but if it's going to work effectively, it's going to need those various different parts of the capital markets to work effectively. The insurance has already been mentioned. There's technology infrastructure that's needed, but there's also governance and the wider ways in which the city understands how to allocate capital and to do so effectively. So we're involved in that, and we'll talk about that through some of the panel pieces. But I think another key piece of this is the convening role that we play. We play a very fortunate part in the market, which is that we sit between those with capital and those seeking capital to apply in search of a goal. And so when we think about carbon nature markets, we're really thinking about how do we enable those who have real commitment to addressing climate change through implementing projects to enable them to meet those with capital they want to apply in service of that objective. And so we spend a lot of time engaging with the companies that are listed on our market. For example, we run something called the CSO 100, which is the FTSE 100 CSOs, but much broader engagement across the 2,000 companies that are listed here, and indeed the governments that we work with. So most governments that have issued a sovereign bond have issued that in London, and they do that because it's the most international capital market in the world, and with an investor base that really understands this sector. So we spend a lot of time thinking about how and understanding what the barriers are and how we can come to apply those. So, for example, we know that a lot of corporates really struggle to engage with buying carbon credits. The information gap is significant. The access to the market is still not as efficient as possible. And there are the smaller players that large corporates struggle to deal with. So how can we help facilitate that? Investors would like to apply capital at scale to this, but the market is still quite small. So how do we get from A to B? And that's another part of how we've thought through this. So the way that we've approached it so far is we've built a really strong research offering. So we have 14 analysts covering all the main compliance markets, Article 6 and the voluntary markets. And that's to give investors an understanding of how the market works and how it's interplaying with different commodity markets, particularly power and gas, etc. We've onboarded the data from the main project standards, so to make it easier to access than going through the individual registries. So we have 4 standards so far, and we're adding to those. And we've created a set of listing rules for funds and companies that want to raise capital to invest into carbon projects. And the reason for that, again, is to really address some of the information gap, the knowledge gap, and the trust gap. To really look at how do we put some guardrails around the types of activities, so eligibility criteria, the types of expertise, and ensuring that companies and funds have relevant expertise. They've understood risks and put in place a risk management plan, and that we have an ongoing annual requirement for providing specific updates in relation to the performance of the pipeline of projects they're investing into. And again, that's to give investors information on a plate in a consistent fashion. So that's how we've approached it so far. We're working with various different other parts of the market to really bring together the various different parts of the ecosystem, and look forward to discussing it.
Thank you. Okay, I've got a few questions for you today. I'll start with Chris. Chris, you've already talked a little bit about the risks and opportunities, and you mentioned the consultation. So how can people in the markets get involved and engage with what's happening with the UK government?
Thanks. I think so the primary route, I think, would be through the consultation, which is open until the 10th of July. What we hope to do once we've received responses is to issue a government response later on this year, around the autumn, and that will set out the things we're going to do immediately and the things that we're going to do in the kind of longer term. I can come on to that a little bit. I mean, it's quite a broad document. There's a lot of interest there across Whitehall departments. So there are various equities reflected. We have environment, food, rural affairs colleagues are interested for the UK domestic angle, for the environmental regulation angle, and Treasury, of course, for the City of London financial regulation angle. But I think among the more pressing points, I think, that might be helpful to go into a little bit more detail here, are on the supply side and demand side areas where we're seeking feedback. And I think the key issue for us, or at least the one that we hear most about when we discuss this externally, is this case for how we can make a stronger upside for businesses that buy corporate credits, carbon credits. And I mentioned that we will be proposing to endorse VCMI's Claims Code of Practice as international best practice. But looking at some data, we can see that in order to make that claim, you have to satisfy various criteria. And if you look at the number of companies that report under CDP, and you look at how they sort of fall away as you apply those criteria, then you're left only with a very small number of companies that can make claims under best practice. And so what we want to do through the consultation is say, okay, well, if credits were to be used against a proportion of emissions from scopes 1 to 3, what might that look like? What might the safeguards be that we could put in place to help ensure that companies using those credits don't distract, don't pull attention from value chain reductions? And those could include, for example, that the credits meet a certain quality threshold. For example, ICVCM is the example we give in the consultation. Could also be 6.4 once final rules are ready. Should a proportion of those emissions represent removals with durable long-term storage, that would align, for example, with the direction SBTI seems to be taking. And also, what's the disclosure requirement that might come with this arrangement? So VCMI in their Scope 3 Action Code of Practice, where they're looking for ways for corporates to get back up to best practice, include as a requirement that buyers disclose why they've been unable to set a Scope 3 target and the steps that they're taking to make good on that. But there has to be a quid pro quo, I think, for businesses to make those disclosures. Also requires that governments provide some form of recognition or endorsement incentives to say, yes, we recognise that you're doing all you feasibly can before you start using carbon credits. And all you feasibly can might not be like a perfect net zero aligned pathway. But in these circumstances, we think that it's legitimate for credits to be used. And SBTI appear to be heading in this direction as well, or at least they're consulting on some of these points, which so there looks like alignment between us and their direction of travel, which I think is helpful. So yeah, we'd welcome feedback on that in particular. I mean, and in terms of broader outreach, we're not standing still and waiting for responses to come in. We are working with other countries as well to think about how we can align guidance and approaches. We have a very busy set of activities planned for London Climate Action Week, so we'd be happy to join panels and speak there as appropriate. We're doing some outreach at the moment. I was speaking to Adrian this morning, and we're going to do some engagement with asset managers to try and understand some of the issues there in a little bit greater detail. So yeah, do reach out, keep talking, and thanks. I'll pass back.
Perfect. And when does the consultation finish?
So the consultation will close on the 10th of July, and then there'll be a period where we analyse the responses, formulate policy, agree it across Whitehall, and then respond. So we hope to do that, as I say, in the autumn, and ideally before COP30. But that kind of depends on the volume and the nature of the feedback that we get as well. So thanks.
Thanks. So coming back to you, Bronek, actually, and you did mention about it's quite difficult to navigate what's out there. And how do you think we can help buyers navigate towards high integrity and basically manage the risks?
I can just, picking up on what I said earlier and what Chris has just said, I think having a rating on different climate projects is critical. Because if you are, and it comes back to, I know there's a lot of incentives, but I ran a global company with a huge range of views across the world as to whether this was a good or a bad thing. However, if you're listed in the London Stock Exchange, it's the law. So we actually stopped the debate. We said, it's the law. We have to have a plan with a path. So we're not having a debate about what we're doing. We're going to have a debate about how we're doing it. And again, if you take the lessons from other markets, so an insurance company has a huge investment portfolio with lots and lots of investments. But you were able to say, we have a X billion dollar portfolio with an average credit of AA and an average duration of 2.5 years. Everyone understood what that meant. And you got more credit for that than if we'd said we have a 2.5 billion portfolio with a BBB average duration of 10 years. That's a lower quality, more volatile portfolio. And people judge you in your share price and as a response. And to me, the thing that London should be doing is trying to replicate that on carbon markets. So I know I'm a little bit... Make companies go carbon neutral today and report against those sorts of standards, whether it's from a rating agency, whether it's using insurance-protected ratings. All of that is to provide integrity and belief in what it is you're buying, and a nice simple way of reporting it. And you get, over time, competitiveness will take it from BBBs to single A's, and the quality will improve over time, either because the projects are getting better or because the insurance enhancement is getting better. And the insurers will force an improvement in quality too as part of the underwriting criteria. They'll want verification, just like the rating agencies want verification. And I know there's that you've first got to mitigate, you've first got to avoid. There's a whole lot of steps to go through. But I promise you, if people are carbon neutral up front, it'll accelerate all the other activities, because they can say we've reduced our own emissions by X in the year, and for scope 1 or scope 3, this is how we're mitigating that. And to me, that's where the market will make it easier. And if there's a nice platform on which you can do it, so much the better. And so I think transparency and simplicity is key to do that. And progress is much more important than perfection.
Okay, thank you. I'd like to bring Adrian in now and ask you a little bit about the role of the capital market infrastructure in scaling markets. You touched upon it briefly and said you'd come back to it. If I could invite you to do that.
Thank you. I think a lot of the time, and the debate is moving because the markets move slightly, but we have been quite hung up on trading of carbon credits. And actually, a lot of the negativity is around this idea of trading carbon, and can markets do that? That is a necessary part of the market. But actually, if we come back to what the point of this thing is, carbon markets are a financing tool. They're designed to drive capital into climate action, and to do that, funded by those who are polluting in terms of greenhouse gas emissions. That's their fundamental purpose. So if we start with that and think about how do we get capital to flow, then everything sort of works back to that. And Bronic's touched upon a number of those points. So we need to understand the scale of the problem. And we need to understand the types of activity that can be used, the costs of those activities, in terms of what they cost to undertake, and therefore how we move through them. Now, we're very fortunate because actually a lot of the legislation in terms of sustainability disclosures has been moving alongside this. And so we're starting to get to a point where most companies that are listed, and large companies, certainly in the UK, have been having to comply with the TCFD regulations for some time, so starting to think about climate risk. That's starting to evolve around the world, certainly, and potentially here as well into ISSB accounting, so standardised reporting around the world around these activities, including on climate. And then we're moving to a world where we're also going to have transition plans. And again, that starts to make the voluntary behaviour of the leaders in the space around things like science-based targets become the norm, because most companies will have to have a transition plan. And therefore that transition plan can be judged in terms of its effectiveness and what the gap is between where they are trying to get to in terms of climate transition and decarbonisation and where they are today and where they will be in 10 or 20 years' time. So that the information side on the demand side is starting to flow. We've started to build a lot of expertise in understanding the types of activity that can be done. We've been going for 20 years in this space, and there are hundreds of different types of projects. Many more keep coming along on stream. Methodologies and the science is getting stronger, and we can start to think about what the costs of those mitigation activities are. So it enables buyers, so the ultimate demand side corporates, as they start thinking about where the gap is and compensating for their emissions today, which I absolutely think is vital. The more we mitigate today, the less we have to remove later. And and start to think about, okay, well, how do we build a portfolio for mitigation, for compensation today and over time that reflects a price that we can afford and strong science behind it as well. So I think data is really where all this stuff starts, and we're starting to see it sort of come together. And then we need the different parts of the market to really start engaging. So we will need asset managers and indeed the asset owners that mandate them, the pension funds, etc., to start thinking about encouraging, incentivizing companies to compensate for their emissions. So it's not just a government legislation job, it is actually also about the macro climate risk that pension funds are exposed to being addressed by individual actions by their investee companies to mitigate climate. So we need asset managers to come on side, and we also need then the ability to invest at scale in climate mitigation projects that can come on stream over time. And that was one of the reasons we created the designation for the listing rules for carbon funds, is that actually that enables, we've seen huge success in green infrastructure funds, so renewables, energy efficiency, energy storage, hydrogen, that sort of stuff. And actually, carbon projects are very similar in that nature. They are highly illiquid, they're quite high risk, and it's better if you can aggregate a whole bunch of them and mitigate those risks across a portfolio. For that, you need a lot of capital. For that, you need institutional investors. And they, at this stage, are looking and going, well, where's the demand side I can't see? Where's the price signal? I don't understand it, and that's quite reasonable. So we also need markets tools to think about how do we create pricing signals that are clear. In voluntary, that's really hard because individual companies are doing different things. Their buying motivations are different, their requirements are different. But I think we're starting to come up with ways that we can standardize pricing. And we've been involved in working groups that really bring together various different parts of the market to think about how to do that effectively. And that's by creating a price signal, by seeing demand start to scale, institutional investors will want to apply that capital, and they need the vehicles to do that. There are already a number of private funds. We hope that will be followed by a bunch of listed funds that will participate in that place, and insurance is an enabler of that is also key. So I think really, it is looking across the spectrum of what are the different capital providers, who are the end buyers, and how certain are we of demand, how do we know what that's going to look like through the data they'll be disclosing and that investors can look at, and then how do we get better information around projects. And I think ratings is a really key part of that. As Bronix mentioned, I think what's missing at the moment, certainly from the conversations we have with companies that are listed on our market, is they don't really understand what an A+ or a B+ is in this market. What they really care about is how certain am I that this project's been executed with decent governance, i.e. the execution doesn't harm the individuals in the regions that these projects are taking place in. And secondly, how certain am I of the ton of carbon? So I think actually we need to move, and I know some of the ratings agencies are going to this, to away from this idea of integrity towards terms that we use in the financial markets, risk and governance. What is the risk associated with a carbon credit from a forest conservation project versus a methane avoidance project? And if I know that the science means that nature-based projects are harder to account for, and therefore actually it might be simplest if I simply buy 3 for 1 because I've got a 30% certainty of the emission that's been removed, then that starts, and we know from talking to corporates that they're prepared to do that. They like nature credits, for example. They are concerned about the risk associated with them. But if we get to a stage where we can say, well, this project allows this level of certainty, so to ensure you've got a reasonable claim, then X number of credits for the claim, then we start to get to a really interesting place. So I think the more we can measure, the more we can apply these various different sources of data and build a credible supply and demand side, the more successful this market will be.
I've got a follow-up question to that. So how do we drive demand?
I think from two pieces. I think the signals that the UK government and other governments around the world are sending around engagement with the voluntary market is incredibly powerful. It's really important that companies see that this is something that they should engage with, and it provides the sort of air cover for that. And I also think associated with that is the growth of policy-driven markets. So I won't say necessarily compliance markets because there's a lot of different ways you can apply that, but policy-driven markets with incentives, whether that's one end an emissions trading scheme or another which is a kind of tax-based system, Again, we've seen time and again that as compliance or policy-driven markets grow, voluntary action follows because it gains that credibility as an instrument, and it gives you data that you can use to be more certain of what you do. And then finally, I think it is what's been missing so far really is the investor community, pension funds in particular, who are very active on climate change, and the insurance community as well, as asset owners, to start thinking, actually, what is our role in incentivizing or encouraging our investee companies to engage on this topic? I think, again, investors drive action. They could be the owners of the companies, and I think that could be a really strong piece.
Thank you. And actually, I'll pick up on the insurance piece and maybe ask Veronica to elaborate a little bit further on what the role is of the insurance markets.
I think insurance, why do any of us buy insurance? Against something going wrong. That's why you buy it. It's a hedge against the downside. And if you're investing in a carbon project of some sort, you've had it touched on as if it's in a will it underperform versus its promise. So the insurance will actually pay out if it promises it's going to do 100 tons and it only does 90, you can cover that shortfall and be compensated and be able to buy that 10 tons somewhere else. So that sort of veracity of performance is really important. The second one is sort of invalidation. What happens to the whole thing's a con job? Well, again, insurance can cover that quite easily. It's a different form of credit risk. You know, you can insure a bond that's a double B and enhance it to a double A. Well, you can do the same for a project of that sort. And then it's completion, because often you're going to put your money up today, but the project's going to take a year to build. You can have a construction completion insurance that the project will actually be delivered. So there's a whole range of things about managing the downside risk that insurance is perfectly adequate to do. Earlier in my life, we used to insure against confiscation by the governments in various countries around the world. And if you can do it at that sort of level, you can do it at a project level, not very easily because you've got to develop the knowledge, but once the knowledge is there, the markets, there will be people in the insurance market very happy to take the risk and provide that sort of credit enhancement and downside risk protection to the buyer. Just one thing about demand. I know we focus companies. I think that in every consultation, we should be encouraging individual demand. Because at the end of the day, if we do it personally and everyone does it, individually we are nothing. Collectively, it's the accumulation that counts. So it's all very well to talk, but we have to walk. And that's what I think is part of the gap of people in the market, is this sort of gap between, I've got very clear view of what other people should do here, but I'm not going to change my own personal behavior. And I think you've got to do both. And if you can do both, it again will drive the demand. And if the demand is there, guess what? The price will go up and the supply will follow too.
Coming back to the UK government, so obviously you've got the consultation out at the moment. So what is the plan going forwards for the next 2-3 years, short term, long term? What are we looking at?
Well, we'll be looking to see how we can put the 6 voluntary carbon and nature market integrity principles into practice. And the consultation asks for views on how we could do that through updated guidance, policies, and or regulation. And obviously these would all come with different time spans. So in responding, I think we would likely look to, as a quick response, I think probably update guidance for corporates on what we see as good practice in voluntary carbon markets. There's some today under the environmental reporting guidelines, but that could usefully, I think, be as a quick exercise, be updated. There are broader questions as well, I think, about how carbon markets and the use of credits could relate to transition planning. And transition planning is not something that sits in my team, but is something that the government committed to in their manifesto, and a consultation on how that might be taken forward is expected shortly. But our consultation asks some preliminary questions around how the use of carbon credits might be incorporated into that, were it to become firmed up into policy. And then another area we may seek to act is around disclosure. So in the consultation, we point to VCMI's requirement around best practice for disclosures there. And so that's something that could be factored into guidance or into policy. Whether or not there's regulation to follow, I think is going to be a matter for ministers. But as a principle, I think what we want to do is make sure that we're making best use of existing regulation, and so consultation seeks views on that. Yeah. So outside the consultation, of course, we're busy in lots of other fields. Our work to build capacity in developing countries to access carbon markets will continue. There are still very challenging questions for those countries that want to supply Article 6 in terms of how they balance selling credits with their own NDC achievement, which we're helping to resolve. But I think it's fair to say that increasing emphasis will be on this demand side question, on how we can unlock that in future. And I mentioned also the bit in the middle, the interoperability questions. We're very engaged, for instance, through the CAD Trust, which is helping to link and harmonise carbon credit registries. And we're very supportive of the work that South Africa are doing under their G20 presidency towards a common data model for carbon credits, which will, I think, really help to reduce friction if it's developed and put into practice. So I think on the marketplace demand side, but we're not taking our eye off the ball on supply as well, because there are really important forms of assistance that you need to put into place there. And probably just to head off the inevitable question, there's no change in the UK position on the potential use of Article 6 towards our climate targets. So the position is that we reserve the right to use Article 6 towards NDCs and carbon budgets. But our intention is to meet those targets through domestic action. And of course, we're still active in fostering carbon markets through consultation, through negotiations, through provision of technical assistance elsewhere. Thanks.
Thank you. Adrian, I've got a question for you around the international finance community and what it needs on a global scale.
I actually think that so part of the answer to the question is that this is a global market, it's a global challenge. And one of the issues that we see so far, and it's really a function of the size of the market and there's kind of the lack of clear demand signals that we have at this point in time, is that different financial actors have very different risk appetites, very different abilities to deploy capital in different parts of the world, in different types of instrument. And so the more we can align the actors that have ability to deploy capital in the places we need to put it, and the more that we can help those others get engaged in investment structures where they are able to meet their risk appetite by applying capital through intermediaries or different institutions, I think that's very helpful. We've seen so far, and it's not surprising, that some of the biggest actors that are sort of coming into the market as it starts to scale are the hedge funds. They are able to deploy capital in funky, interesting ways. They have a higher risk appetite, but we need to bring greater levels of scale. So I think one of the key things is going to be around trying to facilitate the engagement of different actors in the right ways and enable them to kind of work together collaboratively, if you like, in terms of the way that the capital stacks tend to work in other areas. And the other thing that the piece will help, I think, is really around getting greater clarity on, what's the sort of legal status of carbon credit. That's been attempted in a number of jurisdictions, but the more you can put certainty around the underlying assets that are being created, the more helpful that becomes. A good example of that will be, there's a work that's been discussed in government around the use of woodland carbon code credits within our own ETS. Suddenly that changes the nature of that carbon credit to something that is a voluntary asset that I can use for a claim if I use it in the right way, to something that has a legal underpinning. It's an eligible instrument within a compliance scheme. And that is starting to happen in other parts of the world too. So the more we can put clarity around the instrument, how it can be used, in some cases it's tax status, etc., I think the more we can start building infrastructure around that.
Thank you. And then just a very quick answer from all of you. How do you think we can join all of these pieces together to make the carbon markets work? Very quick answer.
Well, I would say common standards across the country first and the world second is the way you start linking things together, because you see it in accounting standards. They're bloody grinding to work out. But once they're standard, it becomes much easier to evaluate different companies in different parts of the world. And the same as the framework for carbon markets. the greater the consistency around the world, the lower the friction, the more likely it is for investors to engage. So for me, and there is a role for governments, because they're the only ones who can make that sort of commonality measurement. Once you've got a common standard, then actually I think it reduces barriers a lot.
Chris?
Bronach, you took my answer. I think that's exactly what I was going to say. But
I can't believe I said the government have to play the leading role myself.
yeah, but I would agree. I think it's these standards are ready now. It's a question of coalescing around them and trying to build a level playing field, trying to support transparency, and for us, it's about making sure that the right incentives are in place to help these markets realise more of their potential. And I think we won't get it right every time. I think we just need to, there are documented problems with markets, but I think as long as we approach this from a point of view of being transparent about that, learning from it, iterating, building back better, that's how markets will move forward.
Yeah, and I obviously agree on those points. I think the real catalyst has been what happened in terms of Article 6, actually, at COP last year. Because that's really enabled countries to get on and start thinking about how they build schemes. As I mentioned, when we start to see policy-driven action, then a lot of voluntary action follows that. But more than that, what it does is allow the combination of that with the work that's been done in terms of ICVCM and VCMI, the sort of standards bodies that have been civil society / private sector driven, really help, because they're being applied by governments around the world to try and make them ensure that their systems they create are strong. As soon as we start seeing markets in different countries, the reason we're engaged in this market as London Stock Exchange Group is we see the global picture. We see a very large international market being formed at the moment. Now, we sort of view that as a kind of what will become a kind of archipelago of regional and domestic markets, and they will have common aspects in terms of the types of credits that will be used, but some credits will be eligible in certain markets, not in others, etc. So as we start to see that archipelago form, we can then have the ability to look and say, well, what's a stronger system? We can look at where the relative strengths and weaknesses of those international markets are, in the same way we do with currency markets. We can start to say, well, where does that scheme need to be strengthened? Or how does that affect the sort of way that we apply carbon border taxes and so on? So I think ultimately, this market, what do we need now is we need that process to form, and all the different things we talked about today are enabling that to happen.
I've got about a minute and a half, some quick questions from the audience. Yes, if you could give your name and affiliation before you ask questions.
Thank you very much for your interesting discussion. Virginia Furness from Reuters here. Chris, I had a question for you. You mentioned the UK ETS and talks reopening with the EU. I wondered, what is the expected timeline for that linkage? And could you sketch out some of the key hurdles that remain? Thank you.
Thanks for the question. Yeah, I'm not responsible for ETS policy, but I think we'll be familiar that at a political level, talks have reopened on the prospect of linking. I think linked systems would provide potentially a cheaper path to net zero, and there are negotiations taking place at the moment on that timeline. So I don't have any specifics there, I'm afraid.
Yes.
Thank you. Simon Paulson-Jones, Emerald Carbon. A query about the potential role for the UK government as a buyer of last resort for, let's say, CCP-labelled projects that have either been financed or insured out of the UK. The logic being that the finance won't come from banks without confidence that there'll be an off-taker. You could set a floor price at which the government would agree to acquire projects that, for whatever reason, haven't found a buyer. That floor price would then give the banks confidence to lend because they know there's a buyer of last resort. Hopefully, that never needs to be used because buyers are found in the market. But you've unleashed the finance at the beginning. And if you have a caveat that says, well, we're only going to buy stuff that's financed or insured out of the UK, you get London as a centre for international markets. So interested in thoughts around the role of the government potentially as a buyer of last resort to drive jobs and growth in the UK, support achievement of the government's net zero mission, and unleash debt finance and insurance at scale.
Yeah, thanks. That's a really interesting proposal. And I think we do something similar in the LEAF coalition. So it's a public-private partnership, us, Norway, the US, ambitious corporates, where we use UK ODA to provide that floor price. And there are also elements, I think, of that under that program where we act as a buyer of last resort to ensure like a certain level of revenue for the forest country. But I think that's certainly an idea worth considering, like how you could take those principles and apply them beyond a single program acting in a particular sector. So, in principle, it sounds like a great idea. So we should talk.
Okay, I think we're out of time. So I would like to thank my speakers, Adrian, Chris, and Bronek, and thank you all for listening.
Thank you. Well done. We could relax. You did all the thinking.
Thanks very much, Katerina and Bronek, Chris and Adrian for that. That was a fantastic panel. I was struck by Bronek's plea for simplicity. You know, why is it so hard to discern quality, and how do we change that really quickly? He emphasized the importance of ratings and emphasized the importance of progress over perfection. Chris highlighted the progress occurring post-COP and mentioned it takes an ecosystem for us all to win in this endeavour. He also gave some thoughts as to Article 6 challenges in emerging markets, which I think we're seeing in my team at CFC nearly every day. Adrian's comments were around capital markets and insurance being key. He commented on London Stock Exchange's key role in bringing together capital providers and capital seekers in one place, and mentioned the information gap for corporations, which is holding them back. So there was a call for better data there as well. I think on the demand side of things, it is the ever-present question that we have within this space. Our society appears to lack the moral conviction to commit to truly voluntary market. And so in previous conferences, I was struck by a movement to move past voluntary language towards talking about project-based credits and the role they may play in a future compliance market where a carbon price is necessary because of calamities occurring around the world. So fantastic panel. Thank you very much again to the participants. So we're going to move on now to the next keynote address. This is from James Grabbert, who is the Director in the Mitigation Division of the United Nations Climate Change Secretariat, and he's being beamed in by video.
Distinguished participants, and ladies and gentlemen, it is a great honor to address you today at this important event. I would also like to extend my sincere appreciation to Citi and Financial Global for the kind invitation. My name is James Grabbert, a director at the UN Climate Change Secretariat. This event holds particular significance as it marks the midway point between COP29 and COP30, from Baku to Berlin, offering a critical moment for reflection and forward-looking dialogue. The Paris Agreement has marked not only a milestone in the global response to climate crisis, but also a major turning point for international carbon markets. Unlike the Kyoto Protocol, the Paris Framework commits all parties to national climate goals. In this new context, Article 6 of the Paris Agreement plays a critical role as an enabler, promoting cost-efficient emission reductions, encouraging the transfer of low-carbon technologies, unlocking climate finance, and strengthening the capacity of market participants to contribute meaningfully to the achievement of the Paris goals. In this new landscape, developing the rules for international carbon markets under Article 6 of the Paris Agreement was no easy task. This process required negotiators to strike a careful balance between enabling buyer countries to pursue cost-efficient emission reductions, and in doing so raise their ambition, while also ensuring that seller countries could equitably receive their share of benefits under Article 6. The adoption of the Article 6 rulebook in Glasgow laid that foundation. This was further elaborated in the Sharm el-Sheikh conference, and finally with the adoption of additional guidance in Baku last year. We have brought this 9-year journey to a close, providing much needed clarity and certainty to the international community. Under Article 6.2, which is based on voluntary cooperation, parties made significant progress in Baku to enhance environmental integrity and transparency. Greater clarity was provided to participating parties by specifying the key triggers for nationally determined contribution accounting, authorization, and the first transfer of ITMOs. Parties also agreed to submit supplementary information and decided that if inconsistencies are identified in the information submitted, these must be made public. Where the concerned party fails to address such inconsistencies, the related ITMOs will not be eligible for use. These decisions further strengthen the environmental integrity of Article 6.2. All information related to Article 6.2 will be made publicly accessible through a centralized platform known as CARP. The decision also clarified the interoperability between the Article 6.2 International Registry and the Article 6.4 Mechanism Registry operated by the Secretariat and National Registries of Parties. In addition, it was agreed that upon request, mitigation outcomes may be issued through Article 6.2 International Registry, thereby enhancing transparency for investors. Under Article 6.4, also known as the Paris Agreement Crediting Mechanism, significant progress has been made in establishing an ambitious global benchmark for international carbon crediting mechanisms. Notably, methodological standards were adopted to ensure the Paris Agreement Crediting Mechanism activities increase ambition over time, including the requirement for downward adjustments. The decision also addresses the issue of potential reversals and removal projects and introduces a sustainable development tool as a mandatory reporting requirement. This aims to minimize potential negative social and environmental impacts and to ensure that host parties' sustainable development priorities are upheld. At its recent meeting, the supervisory body adopted two major standards that will guide how emission reduction projects are assessed under the Paris Agreement crediting mechanism. These decisions represent a significant milestone in the full operationalizing of the carbon markets under the UNFCCC and provide necessary guiding light to the carbon market in ensuring the credibility and environmental integrity of the carbon market under Article 6.4 of the Paris Agreement. In addition, host parties are now allowed to authorize Article 6.4 emission reductions either partially or at a later stage. The interoperability between Article 6.4 and Article 6.2 registries was also clarified, providing much needed certainty to all stakeholders engaging in the Paris Agreement crediting mechanism activities. So what impact do Article 6 and its decisions have on the international carbon market? Well, the inclusion of Article 6 in the Paris Agreement led to the creation of the first international compliance market under this global framework. By decision, Article 6 mechanisms were expected to evolve in alignment with the goals of the Paris Agreement. And thanks to the continued effort of parties, up to and including in Baku, we now have a mechanism that are both ambitious and environmentally robust. Importantly, independent carbon crediting standards that wish to supply ITMOs under Article 6.2 must meet the level of environmental integrity required by the Article 6 framework. This signals a broader shift, one where the international carbon market over time is likely to align itself with the integrity standards set by Article 6. In the case of the Paris Agreement crediting mechanism, emission reductions issued from the mechanism activities may or may not be authorized by the host party. If authorized, these AERs, as they're called, are recognized as ITMOs and may be used towards a country's nationally determined contribution or other international mitigation purposes such as CORSIA. If not authorized, they remain mitigation contribution units, which can be used for a variety of purposes, including voluntary climate action by companies, results-based climate finance, and domestic carbon pricing schemes. Once a participating party under Article 6.2 or a host party under the Paris Agreement crediting mechanism authorizes a mitigation outcome, that unit becomes subject to the guidance of Article 6.2, including all relevant decisions. If the authorized mitigation outcome is internationally transferred, whether for use towards an NDC or other international mitigation purpose, the selling country is required to apply a corresponding adjustment by adding the volume of transferred ITMOs to its own inventory of emissions. In contrast, unauthorized units, the MCUs, are not subject to the corresponding adjustments. As such, they can be used for a variety of purposes, as mentioned earlier. As the Paris Agreement crediting mechanism enables the supply of high-integrity credits for these additional markets, the demand side can also contribute to the achievement of the Paris goals. With the decisions adopted in Baku, Article 6 is now ready for business. The standards established under Article 6 provide clarity and certainty to investors, helping to build confidence and encourage participation. This year marks the 10th anniversary of the Paris Agreement. Yet, despite the progress made, much more effort is still needed to achieve the Paris goals. Building on the Baku decisions, we must now move swiftly into the full implementation phase. Article 6 will serve as both an enabler and a catalyst to make this transition possible. International carbon markets under Article 6 will play a pivotal role in raising the ambition of the NDCs and accelerating their implementation across countries. Article 6 is no longer a concept on paper. It is a functional framework ready to deliver real impact. The choices we make now will determine whether international cooperation truly accelerates climate ambition. Let us seize this opportunity to turn standards into action and mechanisms into results. Thank you.
So thank you very much to James for that keynote highlighting progress at the UNFCCC in relation to both 6.2 and 6.4. I think his remarks really bring home the fact that it is a ferociously complicated area and the diplomatic effort continues. Hopefully we'll see more progress at COP30 and beyond. So the next session is being hosted by Camilo Mejia, who is the Chief Executive Officer of Innovate AI, and it's a bit of a change to scheduled programming. It's going to be an interactive session, whatever that means, but I'm excited to see. So please welcome Camilo on stage.
Good morning, everybody. Can you hear me? Yes. Good. Well, thanks for the time and the presentation. We are coming from the other side of the Atlantic. We are going to talk about defining trust in high-integrity carbon credits. I think everybody is talking about high-integrity carbon credits, but how do you trust high-integrity carbon credits? So we are going to talk about data. It's going to be very interactive. Let's see if that works. So we have Zach, one of our customers. We have Pascal working in the insurance side. So I'm going to get it going. So talking about how we actually decarbonize legacy infrastructure. We are from oil and gas. We are no evil. Everybody call me evil because I'm from oil and gas, so let's get that out of the way. We are part of a new generation. We have different priorities. We are aligned with climate, but we also believe in operational excellence. We believe sustainability, climate, is a byproduct of doing the right thing, and that's what we're going to talk about today. The oil and gas industry has a significant responsibility in achieving the climate goals. So what you're looking at here is not promises, it's actually facts. I'm an engineer, I'm a scientist, and trust is defined by deterministic models, and that's what we're going to talk about. So what you're looking at here is an asset in West Texas, very polluting asset. Actually, Zach will talk about it in a minute. And I'm going to show you the difference between science-based models and actually measurements, engineering practices, and how that really matters when it comes down to climate forcing priorities. So this is before and after. We are using technology. Before, you can see the polluting asset, really complex, matter of fact, really bad. That's oil and gas, yes. But we are here to show everybody that we are doing the right thing. And that really matters going forward if we talk about high-integrity carbon credits. So Zach is going to talk about what he did in his asset to achieve the after, a reduction of more than 1 million metric tons, well, equivalent CO2 metric tons. It's quite significant. Everything is basically technology-driven. Everything is stored in blockchain. There is traceability. We have really strong engineering principles around quantification and uncertainty. So carbon credits can actually be validated in real time. So how we get from point A to point B? The first one is really contrasting science-based models with data. And from an engineering standpoint, from a science standpoint, that really matters when it comes down to trust. That's what we do really well in oil and gas. So when we compare science-based models versus data measurements, this is the difference. 20,000 metric tons versus 1 million metric tons, roughly 1 million metric tons. So how we get to that point, I'm going to talk about it, but we follow international standards. This is just some of the standards that we follow when we are actually looking at the data, quantifying the emissions, measuring the uncertainty, working with different types of technologies. I'm talking on behalf of several groups of people working towards this particular goal. So it's very technology, framework related. Why oil and gas is important, we are talking about climate change. When we look at the difference between this type of emissions versus traditional nature-based, CO2 matters for sure. But when we are dealing with CH4, we are dealing with gas that is 84 times more dangerous than CO2. This is just engineering showing global warming by reducing CH4 as opposite to CO2. We have 70 to 80% more opportunity to keep everything within 1.5 degrees Celsius if we focus on CH4. So if we are talking about the Paris Agreement, if we are talking about climate forcing priorities, this is the way. Zach, do you want to talk about it? Last mile?
Yeah. I think this is on. If not, everybody, hello. My name is Zach with Last Mile Production. I am from Texas, and I do wear the hat all the time. So, oil and gas operator, but previous to that, I was actually in ESG finance and insurance with one of my partners. And it was interesting. My family has been in oil and gas all growing up. That was the expectation. You choose farming or oil and gas. And I chose to go into ESG finance, was pretty much the black sheep of the family. But there was an opportunity, and if you go back actually to that first slide that shows, right here. So we had an opportunity to go out. Someone called us and said, hey, could you finance an oil and gas asset? I said, of course I can. What kind of question is that? So we went out and took a look at the asset, and I was blown away with what we saw. The gas coming off the top of the tank, what you don't see here in this picture is there's a swing set over there where the words are, and a house over where Camilla would be. Less than 100 feet away. The family loves the oil and gas assets. They said this pays us a royalty check every month. But what they didn't see was the methane that was coming off of it and the volatile gases. As we showed them the camera images, they immediately got on board and said, please, take care of this for us. But what was even more interesting is that the operator prior to our company left the keys at the door and said, we don't want to manage this asset anymore. To them, the gas is a waste. They're looking for oil. That's what they want. Everything else is a waste product. But that is the opportunity. And we recognized pretty quickly the opportunity was to be the operator and to make the change from the ground level. So I took some notes here real quick. I'm bad with names, but Bronick, Adrian, and Chris talked about change. Change starts at the operational level. We make the change from the wellhead, we collect the data, and we implement it in real time so that someone can see exactly what we're doing. While it is a dirty carbon credit, people look at methane as maybe not the cleanest of carbon credits out there. This is an opportunity to make a change across the world where every carbon credit matters. Whether it's nature-based or methane-based, we have to make the change. This was another one. So an operator left the keys at the door. Most of these, the operators will get to a certain point and they'll just get rid of it. It'll be passed off to the next person. So when we talk about orphaned wells, there's a lot of orphaned wells out there. There's probably 20, 30, 40 times more idle wells that look just like this, the one that you saw previously. This is where we have to step in and we can make change immediately on these type of assets. And it's a quick fix. But when we think about the oil and gas industry, everyone's focused on the drill, baby, drill. But no one thinks about the mitigate and the retirement of assets. That's where last mile production comes in. So we're focused solely on the retirement and decommissioning of assets. What it's done, though, is it's offered an opportunity to change a mentality in the industry. When you go to West Texas, I'll tell you there's nothing else like it. Because everyone is stubborn, they're stuck in their ways, and they believe in oil and gas, which is okay. But what they need to do is see that there's an opportunity to be better stewards of the land, be better stewards of the resources, and make the change as an operator at the wellhead that can impact everybody across the world.
Thank you, Zach. Appreciate it.
Thank you.
So let's talk about data and why this kind of credits really matters. We are talking about through avoidance. We are talking about really the opportunity to quantify the emissions. We are counting molecules. We are not moiling. We are counting. We are using technology to be true. There is no risk for reversal. It's permanent avoidance. We quantify the uncertainty through the technologies we use. We don't have issues with additionality. There are plenty of benefits, part of the goals with this particular strategy is about bridging the legacy infrastructure into the new smart energy systems. So SAC is using carbon credits to retire the assets, develop geothermal power generation, diversify electricity production, many co-benefits as well. And integrity, which is what we're talking about. So we believe the future of the carbon offset must be engineered for endurance. It should be deterministic. We need to take into account all the opportunities to really make a difference, and this is something that can make a difference. So from an engineering standpoint, from a science standpoint, we are really verifying physically the fact that we are claiming to the market. We are making operations that are geomechanically and geochemically stable, and we can verify the process in real time. We are impacting the environment today, in 10, 20, 30, or 40 years from now. We are focusing on really making the process fully traceable. And last but not least, is 100% aligned with climate forcing priorities. We follow regulated frameworks in oil and gas like OGMP 2.0. We follow ISO standards, and yes, we deal with different regulated markets as well. Everything is about data, it's about technology, it's real time. We deploy sensors, advanced sensors, we manage the uncertainty, we provide recommendations in real time for customers to reduce emissions in real time. Again, climate sustainability for us is a byproduct of operational excellence, and that's the future in the energy sector across the board, oil and gas power generation. So technology is really enabling operators to be more responsible about the decisions at the operational level. We quantify the uncertainty. So when we deal with this kind of asset retirements, which is the right side, that's P&A, we have 90% certainty of the data that we are capturing and using for the carbon credits. Leak repair and detection, 95%. More data means more certainty. More certainty means less risk. Less risk means more value. We use AI technologies, different regulatory frameworks. We kind of focus on data confidence. This is 92% data integrity confidence following ISO 14064. This is one of the projects from SAC. We use AI to verify the integrity of the sensors. We use regulated frameworks like OGMP to be deterministic about where the data is coming from and how we are using that data. 92% is quite significant. If we are below the 10% threshold, you are dealing with really high integrity. And that's really what trust is all about. We can demonstrate why it's high integrity carbon offset. And everybody can verify the data in real time. On a go-forward basis, it's not only about issuing the credits. We have technology that is constantly looking at what's going to happen after the fact. This is what we deliver to the insurance team, where we have technology tracing any potential challenge in that particular asset where we are getting the credits from. So we have 24/7 long-term monitoring, no risk. What that means for the industry, buyers insurance, if you have changes in the operational performance after the fact, that change in the operational side is related to, obviously, risk. Risk from a regulated standpoint, from a reversal standpoint, from a data uncertainty standpoint. We report 24/7 to the insurance team, to the buyers, what is going on with that asset, where they got the credits from. With that being said, I'm going to pass it to Pascal. Thank you.
Thank you, Camilla. So when you're looking at risk, there are two things that we like to focus on. The first is all risk starts with the business model. Okay? Okay, so that's point number one. Point number two is all value starts with data in insurance and finance. So we have 2 points. And so when you're underwriting something on the insurance point of view, and with us, we start with intentionality in the business model, you run into problems. So if you look at the voluntary carbon market model, and you look at some of the data that's used, there are areas for improvement. So the elephant in the room to us isn't the emissions, it's the business model. Okay, so we take a innovative business model and we pair it with technology. Okay, and so let me stop right there. So because the business model is the origin of risk in an operation, we take every effort to reduce that risk as much as possible. And the only way that we can do it in the job that we're doing right now is with technology. Okay, so technology enables the business model. So Bronek made some statements earlier that just really resonated with us, and it's basically the basis of our business model. We're taking the insurance underwriting process and we're embedding the development of the carbon credits in that process. Okay? What you end up with is, we also use process engineering. Every step of that development process is date stamped, timed, with third-party validators on every step. So you start out with the story. Once upon a time, there was an idea, to sequester carbon, and then all the way down to it's tracked all the way. Embedding that in the insurance underwriting process, first of all, you end up getting a property asset out of the arrangement, but then you also, it's 100% insured, but it's a fiduciary asset. And that's something that does not exist in the voluntary carbon market right now. It is fiduciary governance. And so we created a fiduciary governance model. And what happens, the outcome is, besides it being a fiduciary property asset that's insured 100%, is enforceability. If somebody tampers with the data, tries to double sell, anything to do with that carbon credit done in this process, that is insurance fraud, okay? That is insurance fraud, and it's punishable in every jurisdiction in the world. Everybody knows what that is. And I am not a voluntary carbon market expert, but I would like to ask a question. Does anybody in here know of anyone who's gone to prison for scams in the voluntary carbon market? Okay, so we now have something that's enforceable, and this is the model that we're pushing forward with Blue Clarity. And so we start with new data sets. Okay, everything that we're doing, we have more data than we've ever had before. And this data allows us to do things dynamically in real time. One of the problems in insurance and in voluntary carbon market is linear quantitative methods are being used to quantify nonlinear risk, right? That's, in fact, the oil and gas business model is ultra short term, extracting resources, right? Without thinking about the long-term infinite risk that goes along with that. So, we start with this new data set. We have a process engineered underwriting scenario. The process engineering that we're using was born in NASA and is currently being used in the Mars mission, right, for process engineering. And you end up with a number of customers, including capital markets, carbon markets, regulatory and compliance, and the actual customers buying the carbon credits. And the colors on this didn't turn out the way it was supposed to. But the bottom line is we're taking a lot of unstructured data, and through the use of technology, we're able to create structure and make that data useful. And we have everything that we do is based on deterministic fact. There's no probabilistic analysis. Everything is a fact. It's real time, and we have long-term monitoring. So we're not promising something, we're proving something. And we believe that that sort of fiduciary governance model is helpful to the industry. And yeah, so that's it. Are there any questions? Okay, thank you.
Okay, and on time. So thank you very much to all of those speakers. It's fantastic to see data coming together with what's possible in the carbon market. And I also think it was fantastic to get a proper Texan up here with a hat as well. you know, us Brits, we just love Americans, and you turning up to a conference in a hat is one of those reasons. So thank you for adding some humour to proceedings and for making it real, right? I think that was you know, fantastic to hear. Now, I can see around the room people are falling off their chairs, eager to absorb some caffeine, so you'll be happy to hear that we have a coffee break. We're going to be back here for the next panel at 11:15. So see you then.
Exclusively focus on climate decommissioning as well.
Okay, you send that to me.
Isabel, can you hear me? Was that a bit too loud? Sorry guys, we are doing a test.
Yes, I can hear you, yes.
So you can hear me?
Yes, I can hear you.
Yeah, Richard, Connor, all good? Yep, no. Okay, stay there, Isabel, don't go anywhere yet. Please.
Isabel, can you speak for us, please? Thank you. We can't hear you. Could you unmute your mic, Isabel? Thank you.
I don't think she can hear us, Richard.
Isabel, your microphone's on mute. Can you unmute it, please?
Hello?
That's better. Thank you.
Isabel, Richard, can you ask Isabel to move to a quieter area? I think that there's too much background noise.
Isabel, can you move to a quieter area so we can hear your microphone clearly? Thank you.
Quieter area. Hello?
That's better. We're hearing
Is this better?
So good at being like contacting me straight away. Getting really time.
Yeah. For some reason, we're getting another feed as well on sound. We don't know from where. We're just checking to see if anyone else is on the call. Anyone else on the call? Okay, Isabel, can you try again? Can you speak for us, please?
Hello? Can you hear me?
That's much better. Yes.
Perfect. I think I can hear myself, so.
Okay, brilliant. All right. Thank you very, very, very much for that.
Thank you. Is that all? Do you want me to leave?
You can go. Thank you.
Thank you.
Bye.
Okay, if everyone can take their seats. I'm sorry to put an end to your socialising. Aditya Sangvi, you're employed by me, so you have to sit down. Come on. Unbelievable. Okay, good man. So hope everyone had a good coffee break. We're moving swiftly on into our next panel session, which is on high-integrity carbon markets moving beyond offsetting. And that's going to be moderated by Frank Watson, who is the Deputy Head of Content at CarbonWise. So if Frank is here, I'm hoping he is, please come up and introduce your panelists and get started.
So good afternoon, everybody. Morning, sorry. Welcome back. I'm Frank Watson, Deputy Head of Content at CarbonWise. CarbonWise is an independent multimedia information and knowledge hub designed to educate and train people on carbon markets. So if I could have our panelists up and join me on the stage. This next section is a panel debate on high-integrity carbon markets moving beyond offsetting. We have an excellent lineup of speakers, distinguished and experienced figures in the carbon market. So on the far left, Mark Kenber, Executive Director of the VCMI, it's a Voluntary Carbon Market Integrity Initiative. Next along is Guy Turner, Managing Director of MSCI Carbon Markets. And last but by no means least, Maria Eugenia Filmanovic, co-founder of Abatable. So we're talking about high-integrity carbon markets. Why does integrity matter? It matters for a couple of reasons, and it matters on the micro and the macro level. It matters on the micro level in terms of organizational level. If you're a company purchasing carbon credits in good faith for the purpose of achieving and demonstrating progress towards sustainability targets, the last thing you need is for those credits to sort of blow up in your face, as it were, because serious questions are being raised about the underlying project behind the credits. So integrity matters at that level. It also matters at the macro level, because getting to net zero by 2050 matters. We will still have very significant greenhouse gas emissions by 2050. I've yet to meet anyone that believes we can get to actual zero. And that's where the net comes in. And so the people involved in this market are building what should be a very extensive pipeline of projects, such that by 2050, that pipeline can offset whatever is residual emissions by that date. And that's an enormous task. It's going to require enormous amounts of finance, and without the quality, you don't get the confidence. Without the business confidence, you don't get the investment flows that people are talking about. So that's the sort of backdrop from which we're going to sort of have this discussion. So perhaps I can ask each of the panelists to speak just for 3 or 4 minutes at the most. Perhaps give us a state of play on the voluntary market and the market for carbon credits. Perhaps, Mark, can we start with you? Give us your perspective from your own position within this sector, and what are the key developments that you're seeing?
Sure, thank you, Frank, and thanks for inviting me here today. I would challenge the initial sort of the framing of the question. You talk about the state of the voluntary market, and I think that's something that others will echo, perhaps, that the idea that there is a voluntary market and then there is a compliance market and never the twain shall meet may have been true 10, 15, 10, 20 years ago, but certainly isn't the case now. So I tend to talk more about carbon credit markets to distinguish them from emissions trading schemes or other types of compliance mechanisms. And there's what has emerged, particularly since countries finally agreed on the rules for Article 6, is that there are a range of use cases that do span from the pure voluntary, by which I think the words in the title about offsetting, where companies buy carbon credits to compensate or offset some of their emissions to make, broadly speaking, a reputational or brand-enhancing claim, from that extreme to the other, where you could imagine that companies would be required by some jurisdictional government to buy a number of carbon credits. And then there are a whole bunch of use cases in between, the use of carbon credits in emissions trading schemes or in carbon tax, and other possible mechanisms. So whether they are credits that come from what has traditionally been the voluntary carbon market or from Article 6 or former CDM projects. It's the use cases that matter, and the integrity of those credits across the board. And with the Article 6.4 rules emerging and the ICVCM's core carbon principles, while we haven't and never will reach perfection, I think there's growing confidence in the quality of the credit projects and the credits that they generate. So when we look at those use cases, the other big change that has happened is that pure voluntary case, which probably started 20, 25 years ago, where companies would take some part of their operations, it could be their headquarters or it could be their whole operations, and then bought carbon credits to offset them and declare themselves carbon neutral or something similar. For many reasons, but two in particular, the business case for that seems to have disappeared or certainly shrunk significantly, and that's because of, on one side, questions about the quality of the credits, whether each credit purchased and retired really represents a ton of CO2 emissions, reduced or removed. And none of you will be unaware of all the criticism that surfaced in the press in 2022 and 23. And so where a company says it's offset a ton of its own emissions with a carbon credit, doubts about whether that really adds up. And then, of course, whereas 20 years ago, buying a bunch of carbon credits and declaring yourself carbon neutral was leadership, nowadays leadership is about reducing your own emissions first, looking up and down your supply and value chains to see where you can decarbonize there, and then using carbon credits to complement that. And for both that latter reason, which, the wariness about being accused of greenwashing and the quality of the credits, I think most businesses would say the business case for making a purely voluntary claim in the public doesn't really stack up anymore. And you'll see, we will have seen that very few companies are shouting publicly from the rooftops about their use of carbon credits. However, we've completed 4 months of market research across 20 countries, and there is much more latent demand for carbon credits than I certainly imagine. I imagine you would have imagined too. And it's in large part because companies want to be able to use carbon credits as part of their corporate climate transitions, to meet some part of their targets, or to take responsibility when meeting their targets or being on track for their targets is not feasible. In other words, where they face barriers that in the short or medium term are insurmountable. A technology doesn't exist. The available abatement options are just too expensive. And therefore, companies are saying, rather than say, we failed, they want to be able to disclose what those barriers are, how they're investing and improving them, and then use carbon credits and other mechanisms to bridge the gap or take responsibility. And that's at the heart of VCMI's Scope 3 Code of Practice, which is a guidance tool for companies to do precisely that, to do everything they possibly can to reduce their emissions, and then where they can't, fess up to it, so to speak, and use carbon credits to bridge the gap and say, yes, we accept that we're not on track or we haven't met our targets, but we are taking responsibility. And that goes to both the micro point and the macro point that Frank said. Companies want to be seen to be doing the right thing, and waiting and doing nothing is no good for the planet. I'll leave it there.
Thank you, Mark. Yeah, sort of a natural evolution of the market, perhaps, as markets sort of develop solutions to some of the problems that have come up. Guy, perhaps we can turn to you. Can you give us a snapshot of what you're seeing in the market for credits?
I can, but I'm not going to. I'm going to do what Mark did, and with the power of the microphone, I'm going to challenge the question, which is moving beyond offsetting. Because my challenge would be, why would you want to move beyond something when you haven't actually reached it? Because I don't think we've even scratched the surface of the potential, or even how they should be used. And let me throw some provocative statements out. Are we under Chatham House rules here? No. Anyway, what the heck?
Well, we have press in the room, so.
You only live once, right? My contention is that there is a lot of misunderstanding about what sort of climate targets actually mean, and how effective they will be. The work that we did for the VCMI said that the companies with climate targets, all the companies that have climate targets are going to be about 2 gigatons off track by 2030, and just including scope 1 and 2. And when you include scope 3, they're going to be about 7.5 gigatons. That's 20% of world greenhouse gas emissions. So if we think, great, we're going to mitigate, we're going to reduce by 90%, and then we'll just offset the last 10%, we are self-deluding. Okay? You've seen this play out politically with the change in administration in the US. You've seen in Germany, even in the UK. The net zero mantra has sort of been watered down. We've got opposition politicians, Kemi Badenoch, as well as sort of government decisions going the other way. We're going to be expanding Heathrow. We're going to be expanding Luton Airport. We're going to be expanding Gatwick and building more factories, more houses, more roads. This is sort of, a lot of these developments were somewhat curtailed by planning considerations. This is now not just unique to the UK, it's other countries as well. And there is a way to have that growth. If you want to try and constrain, in terms of the mitigation hierarchy, you avoid, you mitigate, and then you offset. We've tried to avoid, and politically it's not working, right? You try and tell people they're not going to be able to build houses, and when the cost of living is too high in London, you're going to end up with problems. Economically in Germany, they need to rebuild their industrial economy, and that's going to require more gas-fired power stations, more nuclear power stations. Chancellor Merz is doing that and was voted in on that. So you can't stand in the way of this sort of societal trend. Let's go for mitigate. Well, the world is getting more efficient in its use of carbon by 1.5% a year, with tons of GDP per carbon, tons of carbon per unit GDP. And they've been doing that for the last 10, 15 years. Trouble is, the world's growing at 3.5% a year, GDP. So net, the efforts to mitigate at a global level are not keeping up with our desire for economic growth. So we're putting more carbon into the atmosphere every year. And if you think the companies who have all got net zero targets are going to be able to magically achieve them, try and compare that with NDCs. So a company can only buy its power from the system. Vast majority of companies can only buy their power from the electricity system. Governments across the world, the median temperature increase from an NDC is 3.5 degrees by 2050. So you can't be, as a company, you might have a direct wire or power purchase agreement to an individual solar or wind pump, but in most cases, you're going to take the power off the system. So if the country you're based in has got a target which is going to have a 3.5 degree warming target, you have very little chance, if you're an electricity consumer, of achieving anything less than that. So we're trying to mitigate, we're trying to build electric vehicles, we're trying to use them, but we're not doing it fast enough. So you go to the third level of the hierarchy, which is compensate and offset. And this is where I think we need to focus, because it provides globally the most cost-effective way of allocating scarce resources to achieve the best climate outcome. And my contention is, rather than say how many times can we replicate the net zero target, and then once we've got a target, a company sets a target, we can all go on holiday because it will magically be achieved. I think that is the wrong question. And we're deluding ourselves if we think it is. The correct question is, A, how much money are we willing to spend on this at an individual, a company, and a national level? And then secondly, how can we get the best climate outcome for that expenditure? Because it's not infinite. And I was around when the Stern report came out in 2005, was it? And that report said that the benefits to the benefits of reducing climate impact are 20 times the cost of doing it. Now, I'm an economist. There are a lot of assumptions in that model, and that may be the case. That collectively across the world, but the challenges of getting there when you've got 9 billion people on the planet and growing, and disparities in historical emissions and wealth is really, really challenging. So I think we can't as I said, we can't ignore the politics of society and what they want. And coming back to this question of, let's put the money on the table, let's agree how much we've got, and let's put it to our best use. You then open up the market, and the work, again, we did with VCMI last year, said that the cost of reducing emissions inside most industrial supply chains is in the hundreds of dollars a ton, typically $500 a ton, 2, 3, 4, 500, depending on which industry you're in. The cost of a high-quality carbon credit, pick a number, $50 a ton, 10 times less. Now, you can't fully decarbonize the world by just having offsets the whole time. You have to reinvest in your automotive supply chains, your buildings, your infrastructure. But do you want to do one or the other? No, there's probably going to be a blend. And the question is, what is that optimal blend of how much money do we put in to invest in industries of tomorrow, the clean industries, versus decarbonizing quickly and cheaply today? And let's work that out. And that, to me, as an economist, is the most effective outcome we can produce, rather than pinning our colors just to the net zero mast and saying, well, once we've done that, job done.
Yeah, that's a good, excellent point. And to answer, I suppose that's what markets do, isn't it? If you have transparent pricing, the price tells you what needs to be done. So you create the demand and supply. Thank you, Guy. Maria, can you give us a perspective on all of this from the abatable point of view?
Yeah, sure. I think in a similar vein to what Mark and Guy have mentioned, in a way there is a perception in the work we do, in the corporates we work with, that there is a hierarchy, right? However, I think increasingly what some of the engagements we have with corporates are looking at the carbon credit market as an instrument to actually get them faster to mitigate and compensate. And I think, the framework that is certainly on top of everyone's mind somehow, if you've been close to the SBTI dialogue, is really this concept of within value chain and what is beyond value chain. And often offset has been a topic that's really been pigeonholed into the offset bucket. And so with that comes the fact that, it needs to be happening after you've done everything you could to reduce and mitigate. However, what we realize is that there's no real incentive for corporates now to really engage with this concept of beyond value chain. I think the SBTI feedback has been given to them. There's a consultation in process, and we're certainly part of that process. And one of the things we recently observed, which is, I think, a good news, is that potentially carbon credit could also be used in the context of indirect within value chain mitigation activities. So that's an important development because ultimately there is a recognition of the fact that some of the projects and the project developers' work can also be used for corporates' acceleration of decarbonization plans. However, there is a real big challenge that we see right now, which is how do you define what is within your value chain and what is beyond your value chain? And there's a whole debate as to where the corporate boundaries are of your activities. This is some of the work we're doing to help corporates navigate this in a pragmatic way. One of the things we've observed is that often, on a very myopic basis, a corporate would use the credit that comes from on-farm activities. It's very reductive. If you think about companies that have very complex value chains, often they don't even have traceability and visibility as to where that on-farm activity is. And so there's some level of corporate interest in potentially thinking about what are near value chain or supply sheds. That's a kind of term that's been used also in reference in the SBTI guidance, which is essentially taking a landscape-based approach and recognition of the fact that if you have an impact in this ecoregion where you're sourcing your, let's say, palm oil from, you could contribute to forest conservation in adjacent fields next to where you source your commodities from. That potentially could lead to a huge amount of demand for carbon credits. That's certainly something that we're closely monitoring and could be quite encouraging if corporates do approach it in a pragmatic way. And it could contribute directly into Scope 3 targets if SBTI were to recognize that. So that's maybe on the point of kind of beyond offsetting and what we see. More generally, in terms of the historic retirement activity, what I can mention and kind of echo some of the remarks from previous speakers is that if you look at the retirement, we've actually done a study at Abatable where we recently looked at retirement activity that's happening, analyzing the retirement note and what is the motivation behind those notes, and classified them into broad bucket. And what is interesting is that actually roughly we estimate 30-40% of the volumes to be related to compliance use cases or near compliance, so sort of like compliance preparedness. And that's quite interesting because to Mark's point, I don't think we can speak about voluntary offsetting anymore. It's almost a level of, regulatory drivers are driving retirement activity in what are carbon credit markets. And similarly, I think we'll be able to see potentially the codification of things like the SBTi guidance coming up. It's potentially driving insetting activity versus offsetting activity. So that's from our perspective. Of course, needless to say that this is a very complex sort of framework to navigate for corporate, that it's less sophisticated. And so there's an educational component that we are actively working on, and also policy advocacy that needs to be shaped with the right working groups. And, on the topic of insetting, what I can mention is Abatable's contributed on a paper trying to codify this with Conservation International, the Nature Conservancy, and a lot of corporates like Tesco, Starbucks, and predominantly relevant for the food and ag sector that's looking at this topic quite closely.
Wow. So just within the opening comments, we've already got a ton of potential themes to dig into a little bit more, so that's excellent. So let me throw some questions at you individually, perhaps, and perhaps some of them could be answered by all three. Guy, let's start with you. I think you had a quite interesting piece out early in the year about carbon credits, and you talked about a sort of freezing over of the market, as it were. We had very strong year-on-year growth up until around about 2020, and the last few years we've seen this sort of cooling off. Can you talk to us a bit about what's driving that? And I think you talked about a potential for thawing as well, so maybe a return to growth again. Tell us what the thinking is behind that, and what are the factors that are driving those dynamics in the market?
Yeah, sure. So the market was sort of experiencing 70-80% growth per year from 2018 up to 2021. And, it was like a classic ski ramp of any market. It was fantastic. And then in 2021, 2022, it kind of plateaued. 180 million tons a year is the golden number. And it's been remarkably consistent in terms of global use of carbon credits by corporates, vast majority by corporates. And, some people say, well, that's a cooling off. But I think if you were to not be in this market and just read the news headlines and go to any news outlet, BBC, CNBC, Guardian, or whatever, and you did a sort of an opinion poll of where the market was, reading those over the last 2 or 3 years, you'd probably thought the market had collapsed. And it hasn't. It is there. Companies are still using credits. And the other sort of thing that is sort of the pattern is sort of a multipolar carbon world we're seeing evolve. So previously it used to be sort of with the exception of perhaps Microsoft, the sort of the big sort of sources of demand in Europe and North America are sort of being replaced by a much more fragmented, distributed sort of use of carbon credits, Middle East, South America, Asia, and so it's more distributed. And the other thing is, particularly in the light of the sort of anti-ESG climate backlash in the US, what we're seeing is companies still doing good stuff, but not shouting about it in the same way. And if you look at the sort of the anti-greenwashing directive in Europe, it hasn't really affected European action so much, but it has changed the way they communicate it, just to sort of be on the right side of any potential sort of legal claim. And in terms of the thawing, I think we're sort of, my first point, which is that the basic economics will start to play out. And when companies start to realize that achieving their targets is going to be perhaps more costly than they first thought. And the international markets provide a very effective way. And we're doing a huge amount of work on the supply side to improve the credibility and year on year, we at MSCI, we rate the quality of over 5,000 carbon projects. And the use of those, the high quality ones, is increasing year on year, and the use of lower quality ones is reducing year on year. So the market is driving, there's ICVCM, there's a number of sort of initiatives that are improving the supply of high quality carbon credits. That is sort of building more confidence. And then as you start to move towards 2030, other sources of demand start to come into view. So we've got governments under the Paris Agreement. We've got CORSIA in the international aviation industry sort of starting to play. We've got compliance schemes. So some countries like Korea are going to be allocating the responsibility for the NDC to their corporates, Japan as well. And so these other sources of demand are now starting to sort of take effect as well. So that's sort of the thawing. So, I think we could see a sort of a resurgence in this space. If I'm taking my glass half full approach this morning. Might change tomorrow, but that's kind of how I see it today.
All right, thank you. Mark, you've got a point to make.
I agree with everything that Guy's just said. I would add that, and I would invite the members in the audience to try and answer the question, but I haven't, and nobody I've come across has yet found a way to channel significant volumes of private sector finance. And we're talking about a gap of about $1 trillion a year between what governments pledged at Baku and what the climate finance community says developing countries will need each year by 2030. And I haven't discovered another way to channel large volumes of private sector finance to activities anywhere, but particularly in the developing world and emerging markets, to activities that are not immediately bankable. I mean, one of the facets or the basic elements of carbon credit markets is that projects and credits should be additional, i.e. they wouldn't have happened otherwise. And the fact they wouldn't have happened otherwise probably explains why companies aren't investing in them. And so people have tried different forms of result-based payments approaches, and none of them seem to have had an awful lot of traction. There are, as Guy says, huge opportunities to reduce and remove emissions at reasonable and fairly low cost with increasing quality standards, but we haven't yet found a way to bridge that finance gap, which is largely going to be filled by private sector. And so if someone else can come up with the answer, that's great, I can retire. But until then, I think we need to have confidence that these markets are improving. I think there's going to be a thaw for the reasons that Guy's mentioned, but also because, this goes back to partly of your original framing, Frank, that you said, we hope that there will be a big pipeline built up so that in 2050, I would challenge that. I would need a pipeline in 2026, 27, 28, because we can't wait till 2050. Otherwise, we really will have gone past 3 degrees.
Sure, the work's starting now in order to try to get to that point. I suppose, Mark, you're making the point there's a problem with finance, attracting the finance. But are you still seeing a trend towards in the right direction in terms of corporates setting targets? Is that cooling off, or are you still seeing more of those coming through and actually engaging with this?
No, I think more and more are coming through, and for 2 reasons. One, you can see evidence from SBTI that the number of companies, MSCI track this better than we do, but more companies taking on more net zero aligned or similar targets every single year. Guy can tell you in a few seconds exactly how many there are as of yesterday at 5 p.m., but it's growing year on year. Close to 10,000 who have publicly made commitments beyond their compliance obligations, and then more and more countries are putting some kind of policy in place that requires corporates to take action, whether they are sort of highly ambitious things like the EU ETS or starter schemes that are happening in emerging economies. There's only one direction. No country is putting in place the beginning of a mechanism with the idea of phasing it out in 2028. So through both voluntary action and compliance obligations, more and more companies will be stepping up, whether they like it or not.
Mm. Sure. Yeah, Maria.
Maybe I can also comment on this. I think, Guy mentioned it's only 100 million tons that we're transacting in the market every year. So I think just to put things into perspective, it's a really modest starting point relative to everything that, there's from a perspective of SBTI commitments. And the market is highly concentrated. Something like 50% of the retirement are only from 200 corporates that are engaging, some of which come from energy sectors and often regulated income for motivations that are not purely discretionary necessarily. So I think the demand is is yet to come. I think that the reality is a lot of corporates that we work with are waiting for decisive guidance from the SBTIs and the likes, GHG protocol, to just really understand what is their room for operations and margin for operations and what they can buy. And there's certainly been some very encouraging signals from the perspective of the SCVCM working on supply side integrity. That's really been codifying perhaps the way a corporate can assess and due diligence a carbon credit. But I think what the SCVCM doesn't necessarily do is give them the toolkit for understanding risk from an investment standpoint. So things like the risk of the operator that you're giving money to, the risk of the policy and the landscape that they're operating within. So I think there's still some tools that the market and the corporates are getting up to speed with, in a way that they could feel more comfortable to a point where they could allocate prepayments that are required for project developments to kickstart today. Even when we do work with, let's say, intermediaries that have that risk appetite and are ready to move because they're educated, I think now the intermediaries are waiting for the corporate signals for when specifically kind of locking future market prices. And in the absence of forward offtake agreements, intermediaries don't really have a strong appetite to put the capital down today. So I think we're a little bit in a kind of chicken and egg in a particular inflection point, but I think the tools are getting there. Corporates are getting a little bit more comfortable and operating, and I think the intermediaries are getting ready to potentially support prepaying some of the future offtake agreements from the corporate side. And we've seen this year big names like Amazon coming into the market, and they have very strong ambitions despite everything that's happening in the US as well.
All right, Maria, perhaps staying with you, can you talk to us a little bit about offsetting and insetting? I know you've been looking at this a little bit. I'm guessing insetting really is relating to Scope 3 emissions, so it's within supply chain emissions that are not within a company's own boundary, so upstream and downstream. Talk to us about insetting, and why is it important?
Yeah, for sure. I think at a very basic level, corporates can inset or offset. Offset tends to be everything that's outside of the boundaries of their value chain, and inset is something that it's within the value chain. I think I alluded to on this in my opening remarks. I think the challenge is really in defining the boundaries of what that means. And so far, the guidance from SBTI doesn't, it's quite strict on the use of credits for only offset. However, there's openness to consider also use of carbon credits for insets. This is actually a topic that's quite relevant when we interface with corporates in the food and ag space. Reason is they tend to have quite large exposure on ecosystems. They have increasing nature-related disclosures requirements that they need to go through from a reporting perspective. For example, the EUDR, so deforestation-free products, is something they're impacted by, as well as increasingly TNFD, which is a task force for nature-related financial disclosure. That's just in the adoption phase right now and likely to come into law in the future, similar to the TCFD. And generally kind of pressure from stakeholders because they're getting increasingly impacted by climate change impacts. If you kind of think about price of cacao and other commodities, it's hugely volatile. And so it's important for corporates to start making investment into building resilient supply chains. It's a topic that's increasing. So they're looking at all different ways they can channel investments into climate action linked to those activities. And there's an increasing subset of corporates that are looking at carbon credits and the project developer ecosystem that already exists within the VCM as potentially allowing them to do project development implementation that could serve those goals as well.
Thank you. All right, perhaps a question to all three. Near-term future, out to 2030, how do you see the world evolving for carbon credits? I mean, there's been a lot of discussion around demand and how you create incentives. And clearly, we're moving from a voluntary system to some of these other markets like CORSIA, which are sort of, traditionally we've had cap and trade systems that are legally binding from the top down, and we've had the voluntary market, which is a sort of bottom-up market that's evolved on its own. Now we're living in a world where we have these other, almost, I hesitate to call them hybrid, but they're sort of markets based on project-based credits, but with a legally binding element like CORSIA. How important are those, do you think, for this market to develop, for project-based credits? Anyone would like to volunteer to take that one?
Yeah, I think it sort of goes back to my earlier point, to sort of a more fragmented, multipolar world in many ways, geographically, but also sort of project-wise and use-wise. And I mentioned sort of compliance demand and sort of sovereign demand and CORSIA demand sort of starting to ramp up towards 2030. In Europe as well, the CRCF for removals, the carbon reduction for community for farming, and the focus on removals and so the bifurcation of the market in that sense, and just sort of I think it's just general appreciation that the cost of sort of scope 1, 2, and 3 decarbonisation is quite expensive, and so adding all of those things up at a global level, I see sort of steady, modest growth towards 2030. I don't think it's going to shoot the lights out like 100% a year like we had in 2018, 2019, 2020. But that's sort of our crystal ball is sort of starting to tell us that's the trajectory over the next 4 years.
So I think, a lot will depend on, and others have mentioned this already, sort of the frameworks that corporates are enabled and required to operate in. So those who are taking voluntary action, and I should just add that the fact that we're talking in 2025 about voluntary action at all is testament to our collective failure to get proper policy in place over the last 35 years. But that said, for those who are still taking voluntary action, they are looking to see whether either SBTi or ISO or any of the other target or corporate transition plan frameworks, to what extent they allow the use of carbon credits and other mechanisms. And this is something that we hear talking to companies around the world all the time. They want to use carbon credits to, as I said earlier, take responsibility, bridge the gap, meet their targets, but they're waiting for clarity, which they haven't had for many years, on whether they can or can't. But that should increasingly be superseded by policy and regulation. And in the market research that I mentioned, the number one thing that companies said they wanted was a clear signal from governments that they can and should use carbon credits as part of their corporate climate transitions. And that can be anything, some of the mechanisms we've talked about. It could be a direct mandate, or it could be at one end, and the other end it could be a seal of approval. Government X says you are good if you do this. That's not usually strong enough to make a business case. But then you can think about some of the policies that are already in place around carbon taxes, which allows some offsetting of the tax liability with a carbon credit. Colombia, Chile, Singapore. You could possibly think about allowing carbon credits of some kinds into emissions trading schemes. And that doesn't have to be the thing that scares the living daylights out of people, that it's a loophole, because if you're reducing the cost of compliance, then you can make the target a bit tougher as well. And so you probably get more mitigation and the efficiencies and cost savings that Guy was referring to. So I think what will drive it is clear signals to corporates about what they can and must do. And at the moment, that's a bit unclear. But I think it'll emerge over the next year or two. You've got the SBTi corporate net zero standard process going on, got the ISO process going on, and you've got a number of governments. The UK government, for example, has a consultation out about how carbon and nature credits can be used by corporates, and so others will undoubtedly do the same.
All right. We haven't spoken about Article 6.4 yet under the UN. These are sort of new markets emerging. But they sort of demand from Article 6.4 will sort of be determined by what governments sign up to. So I suppose the demand is a bit linked to how stringent you make your NDCs and so on. But how do you see that intersecting with what we already see with credits? That's anyone who might want to answer.
Yeah, so I mentioned the three sort of like growing sources of demand, all of those dependent on Article 6.4.
Yeah.
Sovereigns, sort of corporates under compliance schemes, and CORSIA. And, we track the Article 6 readiness of nearly 100 countries. And you're right to point out that the quality of an Article 6.4 credit with a corresponding adjustment will differ depending on the country where it's based and the approach of that country to its NDC. So that's another thing we do, is we rate the quality of an Article 6 credit, because whilst they are effectively seen as a sort of compliance sort of entity, there is going to be variability. So in the worst case scenario, a country issues a corresponding adjustment to release the export of its credit, and it has no intention of achieving its NDC, then you're kind of thinking, well, what does that piece of paper actually mean? And you consider another country where, oh crikey, we've issued a release of we've correspondingly adjusted our domestic emissions, that pushes us further away from our target, which we're really keen to achieve. We're going to have to put more money into achieving our target because the release of the credits made it more difficult. Those two are very different. So it does matter that you look at the source of that Article 6.4 credit. And we've seen some of this with airlines. There are some that say, just find the cheapest way to achieve my CORSIA credit. And others are sort of going, well, okay, I see that that's got a corresponding adjusted. It's probably got Article 6.4 legitimacy. But then there's the court of public opinion. And if some Guardian journalist sort of starts sort of like crawling over the source of that credit and sort of comes up with something untoward, do they want to be in a situation and have to defend themselves in public that, yeah, I know that it was signed off by the government and it was authorized by whoever, but there's still a case to be made that it wasn't, what they thought it was. So I do think you do need to look underneath the hood, and I think it's a very useful point that, caveat emptor, even under Article 6.4.
Yeah, sort of buyer beware. And in a sense, the free press that we do have probably should be welcomed in the sense that it helps to highlight things. So a well-intentioned critical piece by a journalist is probably a good thing in the long run, rather than a sort of ideologically sort of rooted attack on the market as a whole, which is probably a bit less helpful and not really being very sort of selective.
I think on this point, I think the most immediate market is CORSIA, as Guy alluded to. I think it's quite interesting. I mean, CORSIA has been set up by ICAO, and so there is an element of codifying what high integrity means under the CORSIA scheme, which is slightly different than what the ICBCM has done. So it's essentially, in a way, government-led body from the UN, defining something different from the private sector that's been operating in the voluntary carbon market. And that nuance is important because it's codifying really what are high quality principles, but then the operationalization of those principles in the context of specific project developer may have different nuances of how it's perceived by the media, to Guy's point. So I think it's one that we're looking at quite closely. There is a compliance need and there's an eligibility window, criteria box that the corporate airline in this case needs to meet, and that's going to be the minimum threshold. But what we're starting to see, some airlines also ask deeper due diligence questions as well on top of that. So there is some level of awareness from their side that they can't really rely on the guidance that's been provided, even though they understand that it's the kind of the process for how ICAO got there. So all to say that, when we talk about Article 6 countries, 6.4, or in general kind of standardization of criteria in the market, there's a sense that you can kind of build very large liquidity pools, and there's going to be some sort of reference prices and things like that is yet to come. And from the perspective of signaling and how the airlines really are going to be thinking about due diligence criteria as part of this.
Okay, I'm conscious that we're rapidly running out of time, so could we open the floor to the audience? Any questions that you may want to put to the panel?
Hi, thank you for being here. Sherry Hickok from Climate Impact Partners. I have a question for Maria on insetting versus offsetting. And I think it's as we start to talk about supply shed, so actually you're not truly in the value chain per se, what is your view on the reality of insetting versus offsetting? And is it really different, or is it just a different term when we're thinking about our pathway to a global net zero?
Yeah, that's a great question. I think the reality is similar in the sense that, you're doing a climate mitigation activity, and you quantify it, and you issue a certificate that someone can claim. So in that sense, it's exactly the same, and you're leveraging exactly the same capabilities that developers have. It's just the location that's different. But when you do it, offset is pure discretionary. The developers would go and find the perfect location for them to develop. Typically, in an in-setting conversation, they're guided by the corporate as to where they would want that activity to be, because they need to have some level of credibility to say that that location is within or near a value chain that they're impacted by. So that's really the main difference. The cost as well is slightly different. So what we see is some corporates in the context of offset, they don't inset, they don't necessarily need to go through a very rigid Verra certification process. They could potentially use some ISO certifications or things like that. So far, when inset has been done, it's really been done in the context of kind of bilateral conversation. That may change as there's going to be more scrutiny and guidance as to what high integrity inset will be in the future.
And that's all we've got time for, sadly, so we've got to call it to a close. But so do you want to close a comment?
Yeah, thank you very much. I'd just like to thank the hosts and the three panelists for an excellent and insightful discussion. I suspect you could speak about this for days and days on end and still not get to the end of it, so it's a complex space. Just a shameless plug, if you are interested in finding out more about CarbonWise, please do come and talk to us. Our CEO, Sylvia, is here as well. We'll be around for the rest of the day. So if you're interested in collaborating or talking to us and learning more, please do come and say hello. Thank you very much.
Thanks very much, guys. And another fantastic panel. I was struck by Guy's comments around the feasibility of mitigation in the avoid, mitigate, and then offset kind of troika. The practicality of getting through avoid and mitigate to the extent needed. You can escape, by the way, guys, if you want to go back. And the irony of that, if you really want entities to avoid and mitigate, it's likely you probably need to introduce a mandated requirement to buy project-based credits, almost operate as a penalty mechanism, right? The best motivation for action is going to be to make the cost of obtaining credits to get to a net zero position painful, and that feels somewhat inevitable. I was also struck by Mark's comments, around the need for credits to be seen as almost a last resort after those two steps. It'd be great to get Bronek together with Mark to debate that, given Bronek's commentary on perhaps not viewing credits as last resort, but something that should be looked at more holistically. The last thing I just want to comment on is the need to keep so-called avoidance credits in the mix and at the table, because there is no amount of so-called CDR projects that will replace the loss of our natural assets. If we disincentivize avoidance projects, we remove the economic incentive to protect them. And it is possible to have high-fidelity avoidance credits. I would point towards the very great work of Permian Global, who are present in the room today, as an examination of the art of the possible within that space. So with that, we're ready to move on to our next panel. The panel is entitled The Impact of Evolving Regulation and Policy on the Development of the Carbon Markets. So this is a really good one to have pre-lunch. And the moderator is Carlo Di Giacomo, who is Head of Commodities at the Association for Financial Markets in Europe. So if we get Carlo up here with a round of applause to encourage him, he'll then introduce his panel.
Hello, everyone. Good morning. I assume this is the moderator spot. So I'm Carlo Di Giacomo. I run the commodities division at AFME, the Association for Financial Markets in Europe. We like to say about AFME that we are the voice of European wholesale financial markets, and that's because we represent leading global banks and European banks, as well as other capital market players. Now, I've heard from the panel before that what corporates and companies want the most is clear regulation. So this is a timely panel to follow, as we'll explore the impact of the evolving policy and regulation on the development of carbon markets. I'm joined today by three expert panelists, each of whom bring a unique and I would say complementary perspective. So we have Hugh Salway from Gold Standard, we have Richard Barker from the ISSB, and Jeff Schwartz from BP. a special thank you to Richard, who I understand is in the US, so he's joining us at a very early hour in the morning via virtual link, via Zoom. I would like to welcome my panelists on stage. We have Richard, yes. So I'll leave the introductions to you. So I would briefly ask you for a quick introduction about yourselves and your role in carbon markets. Start with Hugh, who's right next to me.
Great, thank you very much. And hello, everyone. So my name is Hugh Sarway. I'm the Senior Director for Market Development and Partnerships at Gold Standard. So Gold Standard is one of the standard-setting bodies which serves the carbon market, not the voluntary carbon market, the voluntary and compliance carbon market. We've been playing this role for over 20 years now and have over 3,500 projects registered with our standard across over 100 countries globally.
Hi, good afternoon. I'm Jeff Swartz. I'm the Vice President for Regulatory Affairs for BP Supply Trading and Shipping. So BP Supply Trading and Shipping is the market-facing function of BP. We are BP's face to market. So we provide the merchant supplies that BP produces itself to the market, and then we trade around those. We're a trading house within BP, if that makes sense. I'm based here in London. I've worked in the carbon market for more than 15 years, the last 5 at BP. And my team is really responsible for how we engage in the carbon market. So putting together our strategy, putting together our advocacy when it comes to carbon market changes, and also helping manage our compliance obligations. We have compliance obligations in more than 10 different carbon pricing systems.
Missing Richard.
Yeah, hello, I have no idea why my screen is coming across as pink or red, or certainly that's what it looks like. It's not that colour in the room, but anyway, hello. Richard Barker, I'm a board member of the International Sustainability Standards Board.
Fantastic, thank you all. And we've seen a lot of movement from the UN bodies, IOSCO around regulation, and also national governments such as the UK now. So my first question would be for you, Hugh. How are these emerging frameworks shaping the supply dynamics, and to what extent are they creating additional clarity or perhaps even confusion in the market?
Yeah, thank you. So I mean, just focusing on the supply side, because I think there's kind of different answers and different considerations on for demand and then for the kind of middle of the market as well. So acting as a standard setter has certainly become a more complex role to play in the market over the past 5 or 6 years, but just kind of increasingly, I think. And I think it's kind of increasingly complex to operate projects as well as new demands come through. And as Gold Standard, we've kind of always said that integrity is our North Star as an actor. And if you look now at kind of the regulatory frameworks which we have coming through, we kind of have several different stars that we have to follow if you're kind of acting as a standard setter looking to represent best practice in the carbon market now. You have the ICVCM, which is there as a voluntary standard to try to set the benchmark in the carbon market. So looking at how do we comply with and make sure we are consistent with, but also go beyond ICVCM rules. We then have CORSIA, which has kind of set itself up as well, in a way, as a kind of benchmark for quality. So it's there to provide quality criteria for CORSIA units, but it also is kind of seen as playing that role more generally in the market. And then we now have the new standard under Article 6.4 as well. So Gold Standard's origin was as a label on the clean development mechanism. We've always looked at the UN mechanism to make sure that we are aligning with what is there, but also where we can going beyond as well. And so now we have more clarity on what quality looks like under 6.4 when it comes to additionality, baseline setting, etc. We're making sure that we are aligning there. So in a way, as a standard setter, if you have integrity as your North Star, you kind of have north, east, and west between these 3 different frameworks, which we're looking to make sure we align with and we're harmonized with. And really, kind of fundamentally, why you do that is to make sure that your projects and the credits which they deliver can access as many markets as possible and be seen as kind of high integrity in as many different markets as possible. And if operating with just those three, things are kind of fine, complex but fine. But what we have now coming through is national regulation in supply-side countries as well. And we've kind of heard this, I think, from other panels. This isn't coming through always in a harmonized way. We're seeing fragmentation in how different governments are looking at how they want to regulate the market. So I think, big picture, it's very useful that we're seeing governments introducing Article 6 frameworks, as they do so thinking about how they want to manage and regulate non-Article 6 units as well. But kind of in the minutiae of this, it gets a bit difficult if we're managing different regulatory frameworks in different governments. And so just to kind of illustrate, as a standard setter right now, we are kind of engaged with and speaking to governments in kind of multiple different continents. So Zimbabwe in Africa, for instance, Indonesia in Asia, Ecuador in Latin America, and the EU here in Europe. And the good thing is that all of them are seeing a role for standard setters which have kind of exist in the international market. So in all of them, there is a recognition of the role that international standards can play. But all of them are going about it in a slightly different way. And I think this will be the really key thing over the next 5 years. Can we have national regulation that comes through in a way that supports an international market and really allows supply to be developed in a way that's pretty consistent and where an international market can operate? Or are we going to see more fragmented regulatory requirements in different countries, which mean that an Indonesian unit is kind of possibly not sort of eligible in the same markets as others? So that's the big question that we're looking at, and I think is really important for how the market develops.
Thank you, Hugh, and that's a very interesting diagnosis of the supply side. But looking at the other side, because of course you've mentioned there are more sides to the same coin, on the demand side, what policy levers would help increase trust and participation by buyers, by corporate buyers?
Yeah, I mean, so I think Chris talked about this really well earlier when talking from the perspective of the UK government. I mean, it's more complicated than this, but there's fundamentally a few simple questions. What can I buy? What can I say? And is there an incentive for me to do so? Like, those are kind of three of the key things which I think you're looking at, and which has kind of been lacking a bit in the market kind of over the last 5 years. And this is why you've had important initiatives like the ICVCM, which is looking at the question of what can I buy? You've had the VCMI looking at what can I say? But I think we're at a point where government action, government recognition of some of these schemes, ideally coordinated government action, can play a really important role in making sure that there is a driver behind some of these efforts which are going on to answer those questions for companies.
Thank you very much, and we've just heard about the supply and policy signals. So I'd like to turn to Jeff and discuss about the corporate viewpoint. Just as a background, I've recently read a statistic that around 45% of Fortune 500 companies have, of course, their net zero targets, but 60 of these plan to use carbon credits to meet those targets. So the question is, from BP's perspective, as a company with compliance obligation, how do you view the role of voluntary carbon markets in meeting those targets?
Yeah, sure. So in 2020, we set out a strategy, and that strategy included a net zero ambition by 2050, if not sooner. And then we also set net zero commitment goals, or goals towards meeting that 2050 target for 2025 and 2030. And at the time, we said we would not rely on the use of carbon credits to help meet those goals. So as a company, we haven't been using carbon credits to meet our interim goals, but we know that just like the previous panels have said, there's no way we're going to get to net zero residual emissions without some form of use of carbon removals or reduction credits. So certainly for us, we're trying to understand the market well. We're trying to understand, you know, what does good look like, and, you know, should we decide to use carbon credits in the future, we want to make sure that we're using carbon credits that meet our own internal definition of high quality. So my team and I have been working on that over a number of years. So we actually have our own integrity framework. When we look at carbon markets and carbon credits, we set our own criteria for what we think constitutes good quality quality. And when our trading teams go out and engage with other market participants and we sell carbon credits, we want to make sure that we're selling carbon credits that we think meet our own internal benchmarks for high quality. And that's just because we would do the same thing for any kind of product, frankly. You know, we don't want to sell any other energy product that we don't think is high quality. When people, you know, go to a BP petrol station and they fill up their car with petrol, they don't question whether or not that petrol is good. They know it's good. So we kind of take the same approach when it comes to products or environmental products like carbon credits. And that's why, as a company, we're being pretty cautious when it comes to the use of these credits. And certainly it's not our first thing. We try and follow the mitigation hierarchy as much as possible. And, you know, the way that we've engaged in meeting our 2025 targets and the way we intend to meet our 2030 emission reduction targets will mainly be around portfolio adjustment and you know, different types of things that we can do within our own value chain before we would go out and look at using voluntary carbon credits. Now, saying all of that, I mentioned before in my intro that we participate in more than 10 different compliance carbon markets. And so for us, participating in those compliance markets is an obligation. It's not a choice. So that obligation comes on us, and it's our job to make sure that we comply with that obligation in the most safe way and in the most compliant way as possible. And on top of that, when we look at those obligations, we're also very much concerned with cost. So the cost of meeting those obligations, particularly here in the UK and in Europe, has increased in recent years. We have reduced free allocation when it comes to meeting our compliance obligations in the EU emissions trading system. We operate 4 refineries in the EU, and so we have 4 different obligations. And then we're an operator in the North Sea basin, so we are subject to the UK emissions trading system. Now, the cost of complying with those carbon pricing regulations is something we pay very close attention to, and that's why, as a company, we're very supportive of any change in the regulation that would allow us to meet those compliance obligations with high integrity, Paris-aligned carbon credits. And so we very much want to participate in that kind of a discussion, because it's about how can we meet our compliance obligations in a safe and compliant way, but also in the most cost-effective way. So very interested in understanding, how the work that Hugh and his team are doing to help bring to market high-integrity Paris-aligned carbon credits could also be potentially used in compliance carbon markets in the future.
Thank you, Jeff. And this leads me to a follow-up question that I have here, since this overlap between compliance and voluntary carbon markets is becoming more of a focal point. One question that I have is, we're also seeing proposals to integrate credits into compliance schemes, but what is your take on, for example, the use of international versus domestic credits? And also when it comes to not competition, but ensuring, let's say, a level playing field between companies that are subject to different regulatory obligations in different jurisdictions?
So I think, in order to answer that question effectively, we also need to understand a little bit of the historical context, right? And so, when we had the Kyoto Protocol, most of the emission reduction projects were located in the global south. They were not located in places like Europe or the UK. So now, fast forward to the last 1-2 years, and we're, seeing proposals from the UK government to consider opening the UK ETS to greenhouse gas removals. We're seeing, a new carbon reduction, the CRCF. Sorry, I can't remember what every letter stands for, but I think everybody understands the CRCF, and from the European Commission, and all of that attention is on domestic abatement, so or domestic mitigation, and we don't have a fleet of emission reduction or removals activities ready to go here in Europe and the UK. I know a lot of things are starting, and there's a lot of exciting opportunities that are emerging in the UK and in the EU when it comes to removals. Just this morning, I read an article in The Guardian, actually, about soil carbon and regenerative agriculture, which was fascinating. But the scale of that reduction and removal opportunity within the UK and Europe is limited because of that historical context. We don't have the fleet of projects, we don't have the fleet of developers, we just don't have that industry. And so when we look at the price of those domestically sourced removal or reduction activities in Europe or the UK, it's at a much different level than what we would consider seeing from places like Kenya or Paraguay or wherever it might be in middle income or countries or the global south. So as I said before, we're very concerned about the cost, and I think policymakers need to study carefully if they are going to open up a market like the ETSs to international credits or to domestic credits. What is the abatement cost for domestic versus international, and what is the incentive that an obligated entity would have to go out and source domestic removals when those removals might not be priced even at the cost of the allowance. So by that I mean, it's interesting for us to talk about removals within the context of Europe, but if those removal costs are higher than the prevailing EUA price, then there's not really an incentive to go out and source it if you're thinking about it from meeting a compliance obligation. So that's why I think the conversation also needs to include the scope of international reductions or removal credits as well. But again, those international reductions and removals would need to be Paris aligned, absolutely, first and foremost. And certainly, there's a lot of opportunity that the UK or the EU could do when it comes to the soft diplomacy that comes with engaging with other countries on carbon markets. I think we're just scratching the surface of that at the moment.
Thank you very much, Jeff. And I think you wanted to come in on this and add, maybe to unpack what's happening in the UK and the EU with the carbon, the CRTF, and the UK recent consultation on integrating removals. And one thing I would like to add to this debate is that now we've all heard about the recent announcement, which is of course a major announcement about the linkage of the EU and UK ETS, or at least the EU and the UK government working towards that link, which is definitely a major announcement and a positive development, given that it will allow for major additional participation by buyers and sellers, improved price discovery, hedging opportunities, possibly ensure that UK exporters of high-emitting products are exempted from CBAM. But then again, back to the questions on removals. Will that become a bit of a hiccup since the UK seems to be more advanced in removals and the EU is only meant to come out with a report of integrating removals in 2026?
Yeah. So just starting with the last question, then going on to this afterwards. So I think, there is the kind of carbon market question when it comes to kind of the integration of credits into the EU ETS, which is, so taking a step back again, sorry. I mean, I used to work in the UK government, and one of the things that I think is always important for us to keep in mind when we're talking in carbon market circles is the politics around kind of use of Article 6 is different in different countries. So this is kind of saying, we will not meet our target entirely internally. We will meet it kind of through supporting financing projects elsewhere, and that will help us to meet our target. And I think that's really different in different places. So if you look at Singapore, Article 6 is kind of built into the model because it's a small jurisdiction. There's kind of more limited opportunities for abatement there. The EU, when it went to set its last target, the politics was very different. This was about a domestic target. And it will be interesting to see what comes next as well. And I think as gold standard, we're not always in the position that international credits must be in markets. Sometimes that's the right choice, sometimes maybe it's not the right choice, given the kind of whole overall landscape. But when that decision is made that credit should be in markets, I think we're very interested in making sure that this is done in the right way. And that's in terms of the design of how credits are integrated into the market. And then also the quality of the credits as well. So the point that was made earlier, I think that's essential. And looking at the UK and the EU, it kind of goes back to the point which I started on of kind of regulatory frameworks moving in different ways. I think the UK and the EU have different pieces which are there. So the UK has kind of moved further on consulting already on the integration of credits into its ETS. So that policy signal of looking at that integration is already there. But work is maybe slightly further behind, I think, on developing the standards of how this will work. Whereas on the EU side, you have the CRCF, you have work already underway to develop the detailed methodologies, looking at how standards like gold standard, others as well, could be recognized and eligible to supply credits. But that question's not been answered of whether these credits will be integrated into the EU ETS or not. So kind of they've got different parts of the picture, and that will come together at some point over the next few years, I think. And I think it will be interesting to see how these do come together if there is this question of linking, because the frameworks are slightly different so far. They're not incompatible. I think it could come together, but we'll have to see how that works. I mean, we as Gold Standard are very excited about the EU's efforts through the CRCF. I think the point that Jeff made earlier is completely right, that there is this question of what price these credits will be available at. And so would it actually work to have them integrated into the EU ETS? Would the price be higher than the EU price? But I think having that kind of regulatory framework for carbon removals, provided it's linked to a financing mechanism that can really work to support financing, I think that's really exciting.
Thank you very much. And we've touched upon, of course, the integrity of credits or transparency, and that literally is the foundational question. So that the question around transparency that everyone asks us. So Richard, I'm finally coming to you, and I wanted to know what the ISSB is doing in that market, and particularly to provide investors with the necessary information about carbon credits and their use in the most transparent way.
Thank you. Yeah, so let me just make comments on a couple of broad themes here. One is what the role of the ISSB is in setting standards in this space, but also a theme you'll pick up as I'm talking is a gap between that world and what we've just been, what the panel's just been discussing. So for those who are not familiar, the ISSB is part of the IFRS Foundation. The IFRS Foundation sets accounting standards in more than 140 countries around the world, including much of the discussion just now has been UK and Europe. So across European countries and in the UK, IFRS accounting standards are used. The ISSB has been created to set sustainability disclosure standards that complement those accounting standards in financial reporting. The current rate of it, we're relatively new, but the current rate of adoption, there's about 40 countries around the world that are in the process of adopting ISSB standards. The UK is about to start its process of endorsement. So we are not a policy body, right? So the idea of the IFRS Foundation is not to be an instrument of public policy, but its public interest role is to ensure transparency in capital markets. So to ensure that the information is there for investors to make the decisions. Now, in order for, and that's obviously critical in the sort of net zero transition and so on, in order for there to be material information for investors, there needs to be a risk or opportunity that affects the financial prospects of the entity. And so there has to be a business case. You know, it's very easy talking about net zero carbon credits and so on to be drawn into them as an end in themselves. You know, net zero as an end in itself, as a sort of public policy target, as it were. But from a capital market point of view, it's a business case. So the entity is making a business case for why carbon credits form part of its transition plan. So in that context, we require entities to explain the climate-related exposures that they have, whether they're risks or whether they're opportunities, and how those translate into financial effects for the entity. Those financial effects could be through capital expenditure, they could be through lost revenue, it could be through gain in revenue, they could be through affecting cost of finance or access to finance, whatever it happens to be. But that's the framework, is to articulate the impact on financial prospects. Now, when it comes to credits, all that we say in the standard is, first of all, if you have target, then explain them to the market. So the requirement is not even you must have one or that you must explain what it is. It's if you have one, explain it. if you use credits, so if your target is net rather than gross, if you use credits, how do you use them? Explain the quality, describe them, explain the quality of them, and so on and so forth. Now, it's not really possible for us to go further than that at this stage for the reasons that have already been described, that this is, I'm now getting to the gap, right? That this remains a fragmented market. So on gross emissions, what we do in the standard is we say you must use the Greenhouse Gas Protocol. Now, that in itself, that's a much vaguer statement than it sounds like, right? But nevertheless, it's possible for us as a global reporting standard setter to, in effect, report to another standard that is an input into our standards that is widely used. And there is no such equivalent in the space of credits that we are able to point towards. So what you see is a gap between the development of this world and the reporting that takes place. One more thing to say. For investors, there are two issues that are important. One is there information that is material to making investment decisions or not? So does the entity have a net zero transition plan? Is it credible? Does it make sense for the entity? Should it be financed? And what does it look like? And so on. The other element is, do the investors understand, right? And in order for investors to understand, there not only needs to be global standards and comparability, but it needs to be simple. And that's not to sort of dumb down financial markets, but understanding how credits work is a small component of any portfolio manager, any investor's role and responsibility. And so unless they have clearly comparable metrics that they can compare and understand one entity's use of credits against another, we're not going to get very far. So there's a lot of work to be done in consolidating that world in order that global sustainability reporting standards that we're in the process of setting can be more effective in this space. So let me hand back at that point.
Thank you, Richard. And you've noted that the ISSB doesn't directly shape behavior somewhat, but can better disclosure itself shape the quality, the integrity of those markets, perhaps by, I don't know, making good practice more visible and bad practice a little more difficult to hide?
No, absolutely, and there is an endogeneity here. Right? There's a theory of change, right? That if you have a requirement for disclosure, and the requirement is that disclosure is complete, comparable, high quality, audited, there's assurance and so on, then inevitably you get market pressure for increasing quality in the underlying data and the quality in the underlying activity that the data are representing. And so the evolution of global market practice goes hand in hand with the evolution of transparency about that. So from our point of view, a starting point is report credits if you have them, and then it will evolve over time. In a sense, we were already seeing this with sustainability reporting as a mandatory activity is relatively new. Reporting financial performance is not new. Reporting on information that's material to investors is not new, right? But as the infrastructure around climate has developed, so the capacity to report has improved, so transparency has improved, and in turn that feeds back onto accelerating the capacity. So an implication of our standards coming into effect is that there will be massively improved data systems and data quality and control around reporting on both gross and net climate targets. So these things are mutually reinforcing.
Yeah, thank you very much. And we've discussed frameworks, market strategy, standards. I believe we have around 10 minutes left of the discussion, so I would like to open it up for questions from the audience, if any. So I see a first hand over there.
Hi, everyone. First of all, thank you so much for your panel. Great discussion. I'm Shraddha from Turner & Townsend. I've written down my questions so that I don't forget the details. So a lot of our discussion has been around, the bottom-up approach for carbon markets. And as you know, countries have NDCs with climate goals and targets. And Hugh mentioned that there are some upcoming regulations, particularly in the supply side of emerging markets. So the targets are fast approaching as per NDCs, and the speed at which the regulations are being introduced are not the same. This is probably an open question to everyone. What, according to you, is the next action for corporates and policymakers alike to bridge that gap in speed that will benefit the development of carbon markets? Because we have a lot of, COP30 coming up, the 60-second SB is coming up in a few weeks. So there's going to be a lot of corporates, external stakeholders, and policymakers in these conferences where everybody's going to sit around a table, talk about the problems, and then not get a solution. So what would be your recommendation in terms of next action that both policymakers and corporates can take alike for this? Thank you.
Wants to take this?
You go first. So I agree with your question. I agree that this was pointed to by Guy earlier when he pointed to the gap which we have right now between how far off track companies are. There are some promising signs though. So in the UK, you have this consultation which is ongoing right now, which is looking at the steps that the government could take to support the carbon markets. You have that step there. If we look at lots of the countries where we work on the supply side, we are seeing, in the lens of the carbon market, we are seeing regulations which are coming through. So we're seeing the regulatory frameworks which are coming into place. Everything is too late, as you say. So all of this should have been put in place 4 or 5 years ago, partly delayed by Article 6, partly delayed by other things. So it's all coming in later than it needs to, and we know that. I think thinking specifically about carbon market regulations and thinking more about the supply side, the next step on implementation is really key. So we're seeing regulatory frameworks coming through, but we need to make sure that the capacity is there to be able to implement them well. So it's not enough just to have regulations in place. And we see this as a standard setter. So one of the questions which we've always been looking at in the past on additionality is, can projects be additional if a regulation is in place if it's not enforced? And that's there because there are lots of regulations which just aren't actually enforced. And so having application of regulation is just important as having it there in the first place. And I guess it's also important more on the demand side to think about the wider context in which we're operating right now. Clearly the politics around climate change has changed. And so I think seeing that continued commitment from companies here in the UK, elsewhere, supporting strong regulation for climate action, I think will be really important because we're at a point where there's a real risk around that.
Yeah, it's an interesting question and a difficult one to answer. But I've always said in my role that I am in now and in previous roles, I'm a big proponent of carbon markets with regulations in order to be set up for that critical finance to flow. So I'm always in favor of the voluntary carbon markets, but I just don't know how resilient they are. And I think the last few years have shown quite a lot of lack of resiliency in the voluntary carbon market in terms of being able to sustain the critical financing that a lot of emission reduction and removal projects need to keep running. So for me, it's about what are the regulations that are in the pipeline, the policy pipeline, if you will, that will unlock that critical finance to flow to projects wherever they might be. But hopefully they're projects that I think Guy said earlier, give us the biggest bang for the buck. We have CORSIA. Hopefully, that will continue at pace. We also saw recently a market-based measure for the IMO. How carbon finance and carbon credits play into that, I think, are interesting. And then this whole conversation around, opening up ETSs to the role of carbon credits, I think, is a really interesting one to get to your point about where's the money going to come from, because I am concerned, that the money isn't going to come from the voluntary carbon market. So how we all as a community can keep pushing on that message, I think, is really important if we're all united in trying to raise that funding that we need to close the funding gap. I think linking it to regulation is probably more resilient than hoping the voluntary carbon market comes back, although I hope it comes back, at the same rate it was in recent years. I think the other thing, I know you asked for one thing, sorry, but I mean, the The other thing that I think is really interesting is the work of the ICVCM. I know, they got off to a rocky start, but I think the ICVCM has done so much to build trust again in the carbon market. And I think the ICVCM's role in being a sort of stamp of quality that governments can then just sort of lift and shift from is also really interesting for me, because if governments are going to allow corporates to use carbon credits to meet compliance obligations, that's going to take a lot of work for a government to wrap its head around deciding what is high quality and what is good and bad in this market. And I think the work that the ICVCM has done has sort of built that trust. And if governments can incorporate that work into their regulatory frameworks, I think that can speed things up as well, and that can accelerate the finance flows. So that's also an interesting thing I'm watching closely.
Any other question? No? Well, just building then on what Jeff just said, one thing that we should always keep in mind is that just 17% of global emissions are now covered by compliance markets, and therefore, while we are strong supporters of the expansion of these markets, voluntary carbon markets are right now a necessity if we want to achieve our net zero targets. So they're not just complementary to ETSs, but really necessary. And I think now there is a bit of a positive momentum around voluntary carbon markets. It is true that they just sit at less than 2 billion globally, but the projections are quite encouraging, around 10 to 45 even billion by 2030. And I was reading this morning on the Financial Times around 250 billion by 2050 if everything goes as it should. So it is very important to get this right going forward. Well, if we don't have any questions, one thing that I would like to end the panel with is by asking each of our panelists in the next, what would you like to see in the next 12 or 18 months as a regulatory change that could somewhat support the development of these markets and really ensure integrity? What would that be? Maybe I'll start with Richard. I'll start with you on screen.
Yeah, sure. So finance is not going to flow in the absence of there being a business case and in the absence of there being information that investors feel they understand and that they can trust. And critical to that trust is quality and comparability of underlying information. So what I'm hearing is steps in that direction, but we're a long way off. If you think about the development of corporate reporting in recent years, sustainability reporting has always been voluntary and therefore not managed by the central sort of corporate reporting and compliance functions, and largely of relatively low quality and therefore largely not particularly reliable from an investor's point of view. What we're now seeing is corporate finance and control functions taking ownership of sustainability reporting because it's become mainstream and because they're having to explain how it relates to the economics of the business to their investors, and there will be assurance and there'll be necessary controls and so on and so forth. So getting towards that stage, shifting from voluntary to a more regulated environment feels really important.
Thank you. Hugh?
Yeah, I think for me it's international cooperation around two key questions. One was kind of it was the conclusion from the panel earlier on common standards. So Jeff just talked about it there with the ICVCM. So when we speak to governments on the supply side, we're always encouraging them to look at the ICVCM. So if there's governments looking at what kind of criteria do we want to look at for project approvals, we're trying to provide that encouragement towards the ICVCM. So you have this common standard which is recognized globally. And I think regulatory recognition of that can play a really important role. And then the next bit where I think international cooperation is really important starting from now so we don't go on the wrong path is around the infrastructure and how it all ties in. So we're seeing registries built across the world by standard setters but by national governments as well. And not enough thought is going into how these are interoperable and how these all connect together. So how national registries connect to standard setters ones, how data is consistent across them, and having a starting point now where this is really being thought through as all of these things are being built will be really important.
Perfect. Thank you very much. And I think the UK government in this sense is going in the right direction by recognizing in their recent consultation the work that the ICBCM is doing. Jeff, I turn to you.
I'll be watching the NDCs really closely. I think, it's a really interesting time in the world when governments are really focused on competitiveness and cost. And so I think there's a nice way to link carbon markets to the NDCs that need to be set and thinking mindfully about how to meet those NDCs in the most cost-effective way, hopefully with international cooperation, and that really paves the way for Article 6 cooperation. So I think the first one up will be the EU's 2040 target, and how they set that target, what role they'll allow for international credits. I think is something I'm going to watch really closely, and then see what other countries follow that. And hopefully we see a new set of NDCs that really has Article 6 and international cooperation at the heart of them. I think that'll be really good, and will also enable corporates to breathe a little bit easily when it comes to engaging in carbon markets as well.
Perfect. Thank you very much, all, for the rich, the thoughtful discussion. If I think one theme stood out is that regulation is not just about compliance, but really about enabling trust, investment, and even long-term value into carbon markets. So I'd kindly ask you to please join me in a round of applause to our panelists today. And we're, of course, happy to chat over lunch.
Thank you.
Great. Thanks very much, Carlo. Thanks very much, guys. So look, that brings to a close the morning's proceedings. Thanks very much to everyone that's participated. Thanks for the great audience involvement. I'm sure you're all keen to get to lunch. You're going to be pleased to know that you have a new chair in the afternoon, but less pleased to know that you're going to be hearing from me straight after lunch. So look forward to chatting to you all later on. Thanks.
Thank you.
And we're going to be back in the room at 13:35, okay?
Let's tell people. So I think we're going to get going with this afternoon's session. We were just waiting for a few stragglers from lunch. Okay. So I'd like to welcome everybody back from lunch, those in the room and those also online as well, watching virtually. I think this morning's session was absolutely fantastic, very interesting to me. This afternoon, looking forward to delving further into those key levers that are going to enable us in this transformation, looking more into the technology, looking into the insurance side, of course, and also finance. And I think that in itself is what we need to be able to scale the credible carbon markets in general. Some of the questions that I'll be asking myself throughout this afternoon's session is how we are going to ensure that we can get the digital verification that we need. How is insurance going to bridge that gap between the buyers and the sellers of the carbon credits in order to enable that trust? And also, what role do the investors play? So recently I've taken part in quite a few conversations around energy, carbon credits, AI, etc. And one that always crops up is, are we trying to do too much? Are we trying to fix too many problems with one solution? And I would say, in my opinion, in this case, we are not. I think each piece of the solution needs to enable the other pieces, and that collaboration and convergence is what we need to really solve the problem. And then everybody within the loop wins. Each of the stakeholders will benefit from everybody taking part. So with that, I do want to remind you that there is a questionnaire on the table.
You do get to rate my performance as chairman of this session, so I will keep everybody on time because I'm sure people do want to get home on time and catch trains, etc. So just bear that in mind. And with that, I will welcome George Beattie back to the stand. Thank you.
Thanks very much, and I'm really sorry that you're hearing from me so soon after getting rid of me. And I can see the room's cleared out slightly, but we're left with the absolute cream of the crop, so I'm happy about that, right? Because I can concentrate on you guys. It's easier. So the objective of this session is really just to talk at a very high level about what we're doing at CFC to introduce insurance into the equation in the carbon market. The carbon market is, like the insurance market, prone to a lot of complicated language that can seem indecipherable to normal people, and it takes a long time to crack. So our big objective here is just actually to break it down slightly and talk about insurance in simple terms. Like, what is it for in this context? How do we get about doing it? And if there's one thing that I want everyone to take away from this, it's that CFC is open for business, and we're here to facilitate deals happening in this market, and we have good capital, and we want to get on it and help you to make this work. So let's start it off, and we'll have some time for some Q&A. If you can hold your questions, I know you're desperate to ask questions already, I can tell, but if you hold your questions until the end, that would be brilliant. So who are CFC? CFC is headquartered in London. It's an international insurance company. We have around 1,000 staff. We've grown about 20% organically year on year since 1999, which makes us quite unusual in insurance terms. So we write about £1.5 billion worth of insurance business, spread across about 65 different products. So the interesting thing about CFC, and I know it sounds a bit of an oxymoron to say interesting and insurance in the same sentence, but the interesting thing about us is that we do unusual insurance. So we do kidnap and ransom, we do cyber, we do transactional liability, we do intellectual property insurance. We do stuff that helps us to navigate dinner parties with our heads held high, a little bit more perhaps than the competition. And my team within CFC, this amazing innovative company, specializes in researching, launching, and then underwriting brand new insurance products. So this means stuff that the rest of the insurance market may not even have thought of yet. Or they might have looked at it and said, actually, this isn't possible due to lack of data, lack of talent, lack of access, lack of originality. The insurance market has got a problem with innovation, right? If you think innovation, insurance is not the thing that springs to mind straight away. Some of the reasons for that are really good. Like insurance, actually at its best, is kind of simple. The first insurance policy was a Sumerian bottomry contract, 3000 BC, still being sold today, possibly not in Sumerian hieroglyphics, but still the same product. So this is a long-standing industry, a lot to add, but it needs to get better at innovation. So my team's all about breaking the mold, ignoring the status quo, or at least ignoring unhelpful tradition, and trying to really get at the problem. So it didn't take us long, looking at the biggest question facing the planet today, which is climate, to hone in on the carbon market as an area of massive promise, but also one of incredible dysfunction. And when we looked at the dysfunction in the trades and why counterparties were unable to complete trades, we saw a lot of risk factors that the insurance market knows really well. And this market was struggling with them. So things like political risk. A lot of carbon market people that are not apprised of the insurance opportunities would say political risk is one of the big things holding back the market. How do we navigate this huge issue? It is preventing deals from taking place. The insurance market's been doing political risk insurance, so literally mitigating exactly that problem, for over 100 years. So the insurance market may have answers to some of these risk issues that could provide a lot of acceleration in the carbon market. So when we looked at this, we said actually innovation in this context is going to be, let's ignore all the existing insurance products out there, let's bring it together so that we can solve problems for specific entities in the carbon value chain and make sure our products are really easy to understand. So make our products so easy to understand to the initiated people in the carbon market who really know their stuff. We don't even need an elevator pitch. When we say the words that these products represent to the market, they'll understand 90% of what we're trying to do immediately. And that's what we've been trying to aim to do with our products. So, as I mentioned, our objective here is really to mitigate downside risk and to make deals happen. And I want to lead with that because I want people to understand in the room, particularly those of you that are trying to do deals, whether you're a carbon project developer or you're a buyer or an investor or a bank looking to lend, insurance at its best is about facilitation. So insurance being involved in these deals is not about us. It's about the deal and making the deal happen. So we try and be the easiest part of the transaction to pin down really, really quickly. And to do that, we've done a lot of pre-work in making sure our products make sense straight off the shelf and making sure that our ability to analyze projects is really cutting edge as well. And I'll talk a bit about that. So just to run through these products in a bit of detail, delivery insurance is pretty much what it says in the tin. This product wraps the forward purchase of carbon credits and protects a buyer against non-delivery arising from any cause. So think about it like a refund mechanism. A corporate or an investor or some other type of buyer is concerned they might not receive the credits they've been promised, and so we pay out an amount that is equal to the investment they lose. So if they put $1 million into a project, they get 50% of the credits they were promised. You guessed it, we're paying $500,000 back to that policyholder. This acts as a powerful wrapper of trust to enable them to do that deal better. It sits separately to their contract, okay, like a property policy. So all they have to do is show, I did not receive what I was promised, and then we're going to pay that claim. There's no typical adjustment process. We're not ferreting around in their legal process after the claim. We just have to do some sums, a sum, and then we pay them really quickly within 2 weeks. We can also offer this policy, by the way, to carbon projects, so we can kind of shift things around a little bit and we can offer insurance to the project that's worried about their yield of credits. So if, for example, repayment of a debt obligation is based on generating a sufficient number of credits and selling them at a certain price, we can insure them against deviance against that and therefore make them more creditworthy and make them more attractive. Cancellation insurance, post-issuance risk is ever present. So really this is about insuring the policyholder against cancellation of existing carbon credits arising from any cause. So whether it's invalidation or reversal, particularly in the case of NBS, we're there to essentially pay a pre-agreed amount per credit. So the idea is a portfolio manager with lots of credits they plan to resell, for example, will list out the projects they've bought from, will list the number of credits they have, and then we will pre-agree a value we're going to pay per credit in the event any of those credits go wrong. So again, we're not trying to prove what these things are worth after an insurance claim. We're not debating that. We are pre-setting the factors that go into this policy to provide certainty. And critically, this means that for an owner of carbon credits, they can start to look at that as an asset and not as a liability. Okay, because third-party institutional capital has come in and has agreed a valuation, which again is very important in this sector, right, where there is this question as to what is the value of these units beyond what we've paid, how do we know? CORSIA guarantee is the third one. So subject to us being granted eligibility as a private insurer, we will be offering projects that seek to sell CORSIA credits guarantee insurance. Those of you initiated into the CORSIA scheme know that carbon projects seeking to sell CORSIA credits must have a guarantee, which is basically a slimline political risk guarantee over corresponding adjustments. So the effect of this insurance is to say that in the event of a corresponding adjustment failure, the policy will step in and will obtain replacement credits to make sure that project developer has done its duty under the liability imposed by the CORSIA scheme. So this is very easy off-the-shelf coverage. It's based on a large part about country risk, so where the project is based and letters of authorization, these kinds of things come into that. But that'll be really exciting because actually the supply of CORSIA credits is set to be very highly affected by the availability of insurance, because insurance is probably one of the only really rational forms of guarantee that these projects can obtain. The guidance allows them to obtain a warranty or a guarantee, and it doesn't specify insurance, but actually insurance fits really nicely. And then the last one to mention is what we call carbon lender non-payment insurance. So despite having no history in credit insurance, we were the first insurer in the world to insure or to offer credit insurance to a bank lending to a carbon project last year. And some of you may have seen that. So we were working with Standard Chartered. They made a loan to a project called Undo, which is a fantastic project doing enhanced rock weathering. And with our involvement, they were able to get comfortable to disperse those funds. And now Undo is just absolutely flying. So if there was an example of the positive impact that insurance capital can have, that's a really good one. We've since evolved that offering into something that is Basel compliant. So if a bank is based in a Basel compliance area, they can obtain full capital relief on loans they provide by buying that insurance product. So that's really exciting for lenders because it kind of changes the game in terms of what the costs might be. And sorry, I'm remiss. I should mention that Willis were the broker on the deal, and the broker's actually sitting in here looking daggers at me. So kudos to that man for the Undo Standard Chartered deal. So really what this means is we have different solutions for different parties in the chain. If you're a buyer, we've got solutions. If you're a seller, we have solutions. If you're a lender, we have some solutions. Typically, the cost of our insurance is between 1% to 3% per annum. That means 1% to 3% of the insurance limit in the policy, whatever type of policy it is. But there's some changes on that depending on the exposure. We have $25 million of capital per project to expose, which is a decent amount of capital. It needs to grow, right? Sometimes when we talk to investment banks, if we're not coming loaded with $1 billion, they're kind of, laughing us out of the room. And we're trying to say, look, we're trying to grow from modest beginnings here. $25 million to put at risk per project is not a bad place to start, particularly given the nascent state of the market. When you're talking about supply of really high quality credits, the volumes are still relatively low. So actually $25 million goes a good way. Global project appetite. Doesn't matter to us where the project is based. They can be anywhere in the world, and we can make it happen under our Lloyd's licensing. That last point is really interesting. We trade using Lloyd's capacity specifically. Lloyd's of London is a global brand in longevity and trust, and it carries top-rated financial ratings. So I've just put up the S&P one there, but they've got them all, and they're all pretty strong. So these are some good competitive tools that we've got to come at the problem with. So what I wanted to do really quickly was just run you through, I think the slides appeared okay. Yeah, okay. Run you through a kind of typical transaction. And we've got a number of these that we're working through at the moment. And what's interesting about them is that when these deals go through, they will represent a significant portion of all the action in the market this year. And so we are really confident we're standing behind a lot of movement of capital in the market. Now, the effect of this is to outline to you that carbon delivery insurance, so the first product on that list, can be used to improve the creditworthiness of a developer seeking debt. So in this diagram, you see a flow diagram running from left to right. You can see the off-taker at the top, you can see the developer second down, and then financier, and then CFC at the bottom. Now, really, you could take out CFC at the bottom and assume that that transaction could run without our assistance, but the reality is it can't. So the bottom row is very, very important. And what you can basically see is that you've got a developer and financier agreeing or arranging funding. And the repayment of that funding is very much based on the value of off-takes and the ability of that project to generate credits of sufficient volume and to get sufficient value for them to repay. Because carbon projects are complicated in terms of the science, and banks have been struggling with that for some time because it feels kind of special situation type risk and a bit more like project finance. But the reality is that they're quite simple in the context that if the project does not produce the credits it expects to produce, if it cannot sell them at the price that it's pre-agreed or believes it can get on the spot market, it cannot repay the debt. And the implication of that is very, very straightforward. The banks are holding back from lending because they don't know how to deduce quality. So what we are doing in some of these transactions is stepping in and saying, okay, if there is a deviance in the number of credits that this project, the obligor, the debt, the debt taker, if there's a deviance in the number of credits they produce, then we're going to step in and reinforce their ability to have the cash to repay the loan. So the insurance goes to the project developer, and the bank looks at that and says, actually, on balance, you reinforce their ability to have liquid assets to repay the loan, and that makes us happy enough to engage in the deal. So very, very straightforward mechanic here. Some banks are even enforcing this as a requirement on the project developer to say, listen, if you want our debt product, you will buy this insurance because otherwise you are below investment grade and it's very difficult for us to do the deal. And again, some of these numbers are kind of ticking up. So the implication of this for the off-taker is, better funding prospects. More banks will talk to them. Very kind of simple headache facing the project market. They just can't get banks to pick up the phone. And that is changing, but it's still to some degree the case, which is disappointing. Basically provides a reliable backstop for delivery shortfalls. For the financier, it's investment protection, it's financial certainty, it's quicker deal cycles. These deals are still taking too long. And a lot of the main banks want to be making a dozen or more deals a year, and it's very hard to get there unless we start pulling in other kinds of capital. And then for CFC's part, look, it's all about fast underwriting. So it probably takes us a couple of days to get comfortable with the project risk, to confirm what terms we're going to offer, and that makes us pretty much the quickest part of the deal to be pinned down, at least in the formative stages, which makes a huge difference. If insurance can be baked in at the start of these transactions, things tend to go much smoother and much faster down the line. And again, just to reiterate, we're not looking for special insurance information to be put together here, right? We've all applied for insurance before, and it's pretty painful. Application forms, how long are your legs, all this kind of random stuff. We don't do that. We just take the information as it stands, all of which is fantastic technical detail, and we look at that with the same language that our counterparties use, and then we come to a landing on what the insurance does. it is super easy. And this will be proven out in the next few months when you see announcements around the deals that we're doing. So just a little bit about kind of how we appraise project risk, because this is often the big question. We take in about, I'm sorry about that blue section, that's a bit less clear. We take in about 100 different data points to try and appraise what good looks like. And this is really important to us because what we're not saying here is that this is insurance for everybody. And what we mean by that is we're really underwriting the projects, the carbon projects. That's where the risk lives, which is quite unique because normally in the insurance world, if you offer a policy to an entity, they are the risk, right? So if I offer a cyber policy to the companies you work for, I'm appraising your ability to respond to a cyber event. Whereas if you're a carbon purchaser, buying credits, and you're buying one of these policies, you actually represent no risk to us. It's all about the project you're buying from. So we pre-underwrite as much quality projects as we can. And we use that by taking in the best insurance data sources that we can find and the best industry sources. But we don't over-rely on any one facet. And what's really interesting about insurance data is we actually have really good data, and this surprises people in the carbon market. The insurance market is really good at natural catastrophe, so weather-related risk data. We've got amazing systems that help us to predict how that might affect an asset. So we take that in. We take in a bunch of other data from people like Allied Offsets, Solvera. We take in some pricing data from MStream. We look at political risk through AKE. We take the weather model from Unit Re, their Nathan model, which is fantastic, and we use QC Intel as well. We then kind of go through deal-specific modules relating to project risk. So we look at the proponents, we look at their history, we look at their promises made as a project. So based on the methodology, how many credits are they expecting or saying that they can produce? How does that reconcile against the historical record for similar projects? And then we basically work through towards a kind of final take on it, which is to say, okay, the rate is X per year. And that comes with absolute certainty, right? So we try and minimize the questions. But by running through this very kind of programmatic process, we can basically throw this against any project out there in the world and come to a single answer, which is really important. It needs to be rinse and repeat. Okay, no one wants to go to an insurer and have a different experience every time. It's got to be really straightforward. So this is work in progress, but we're really proud of where we've got to in the last kind of 18 months. And we think this represents pretty sensible estimation of risk. There's no such thing as perfect information. But what the effect of this process is that we think about 1% of carbon markets are insurable by us. That's the possible universe that we'll insure. And that's not because the other 99% are bad, by the way. It's just because the data might be insufficient, or the science might be insufficient, or they might be exposed to too much political risk, those kinds of factors. And what that ultimately gives us is a universe of about 500 projects that we think are good enough to insure right now. The point is that insurance then becomes a point of competitive differentiation for those 500. So we've got projects calling us up saying, hey, can you underwrite us? Because we want to put your letter in our deal room because we're starting to look different to the others because we don't have that. And that's valuable, right? Because insurance becomes a proxy for quality, not a rubber stamp. We don't want to do the thing the rating agency does, right? We don't want to do that. We want to be a proxy for quality because we represent third-party institutional capital backing an investment. Very powerful signal. If you're an off-taker and you're getting $10 million worth of credits and you get an insurance policy from CFC for $10 million to protect your investment, that is a very powerful signal to the market. So we're almost like a shadow investor. The more policies we write, the more investment we protected going into the market, and therefore the more facilitation we can say that we've enabled. Final point, I mentioned CORSIA. For those among you that are interested in this and are looking at how you can complete the compliance steps to be able to offer CORSIA credits, it's worth having a look at this link and logging your interest, and basically we'll come back to you in the next few months as things stand up and as we become hopefully confirmed as an eligible provider by the registries. This is going to be a very highly automated process, so we're going to be getting quotes out very, very quickly. Current providers of CORSIA guarantees have done a very honourable and difficult job, but it's too slow to get cover. And so we're going to drastically change that and shift down its head from moving quote times at the moment in the market from 12 months down to about 12 hours. So that should make a huge difference in terms of getting liquidity going. And just to remind you, to sell CORSIA credits, you have to have a provable guarantee for corresponding adjustment failure. So these insurance products will become very, very important in the short term. So that's it. That's all the slides I've got. I don't know how many minutes I've gone through, probably too many. But if there are questions, I'd love to take them. Stunned silence. Was the microphone on? Was it? Anything at all? Not even from the insurance brokers? I've bored you to that extent that you've got... Oh, here we go. Oh, thanks for asking that question. There's obviously a big debate around nature-based solutions versus kind of more technological-based projects. The issue is there aren't very many direct air capture, for example, projects out there, and so there's been a lot of concentration on things like biochar and ERW, kind of crossover topics where technology is being kind of interfaced with natural, science. There does seem to be a lot of incoming interest on ERW right now from some of the serious off-takers out there. So Symbiosis Coalition, Microsoft on its own right, do appear to be pulling into that, quite strongly. The other area of massive demand we're seeing is on kind of compliance crossover kind of use cases or regulatory use cases. So CORSIA is obviously going to be interesting. The only problem is there are actually no eligible providers of CORSIA credits yet for the reasons that we mentioned, but there will be in short order. The other thing is tax schemes. So quite a lot of interest on Singapore tax scheme, for example, based on emitters in Singapore. Same thing happening in Thailand, Taiwan, Korea, other places that are kind of creating this tax rebate link with the project-based credits market, which is very sensible from a demand perspective. And obviously, we'd like to see that elsewhere because it will create a demand driver. Those areas really. But there is still a lot of interest in high-quality nature-based solutions. A lot of big buyers looking in and around Indonesia, Malaysia, looking at some fantastic projects there, ARR projects there. Yes.
Thanks, George. Can you give us your take on payments in claims, whether it's in cash or in replacement credits, and what your position is and where you think that's going to move in the future?
Oh, nice. These 10 questions are really good, aren't they? So I owe you guys beers later. The big debate in the insurance market, which isn't particularly interesting to anyone outside of insurance but is relevant to the products, is do the products pay in credits or do they pay in cash? And our view at CFC is that cash is king and may always be king, but it's king right now because equivalence is really hard to discern. So, we all know in this room that actually in a carbon credit project is very different to the next one, even if they're running the same methodology. So the idea that as an insurer we can go off and source replacement units better than the policyholder can doesn't really stand up to scrutiny. So we think it's much better to pay cash to allow that counterparty to go out and solve the problem as they see fit. The difference would be with our CORSIA product, we are going to, with a partner, essentially take their claim, which is to find enough replacement units to solve the problem against the ones that have failed their corresponding adjustment. We're going to go off and source those and retire them on their behalf. Because actually a project selling CORSIA credits is not a buyer. They might not have the plumbing required to go off and find replacement units. So it's much better from a value prop perspective, from our view, to just go off and solve the problem for them, put them back on track, and allow them to crack on. Right? They don't really want to be receiving cash to go off and find credits themselves because they're trying to run the carbon project. So, but generally we would say that cash is king until we can say that there's equivalence in the market. At some point we might be able to say, okay, a AAA credit is the same across the whole market, and that would be brilliant for liquidity and other things. But we seem to be a long way off that right now. So we're just trying to reflect reality in our product. At the back there. At the back first, maybe, and then, sorry.
Thank you. It's on CORSIA specifically. So if you look at it from an airline perspective, the risk for an airline is to not have that CORSIA tagged project. Yeah. So, like worst case scenario, the cost of the replacement cost for them is the penalty they might be subject to in that country. So, just try to understand, how do you look at that replacement risk? And do you look at the penalty also in each country? And then how do you look at the regulatory risk, knowing that in some countries we know that there will be a penalty, in some others no. We have the Trump administration, the US, will they still be there or not? So how do you look at that?
Sure. So right now, the way we divide that is to say that to an airline, their main risk in regard to CORSIA label is on a forward basis. So if an airline is trying to find supply by buying forward against credits they believe will carry the CORSIA label, and bear in mind that there is no such thing as a forward CORSIA credit. It becomes a CORSIA credit when it's issued, and only then. So an airline is exposed to loss of that project's ability to generate a CORSIA credit, and that might undermine their forward investment thesis. So our delivery product would be a great product for an airline to buy to cover off that forward-based exposure of the project mid-flight failing to be able to attach the CORSIA label to those credits when issued. And what that policy would enable them to do is to go off and replace that forward investment with another eligible investment somewhere else. But again, we're paying cash ahead of time to allow them to do that. When CORSIA credits are issued and used by the airline, based on current regs, there is no ongoing exposure to them of the project losing their CORSIA status because the credits have been used and they've gone on. So actually, from an airline perspective, the exposure is almost wholly about forward exposure and buying. And so we've thought really carefully about that, and we're kind of ready to respond to demand on that basis. And we have got some really good airline conversations going on, but our sense is at the moment the airlines aren't perhaps as organised as they might want to be in very short order relating to the CORSIA scheme, but they're not helped by the fact that there is minimal/no liquidity in the CORSIA credit market right now because of the infrastructural issues that are being worked through by very sensible and hard-working people that have been in this room. Yeah. Is that an okay answer? You're nodding, just for people on video, she's nodding, so. Okay. Cool, was there someone, yeah? One more? Okay, I'm sorry, I can see you had your hand up. I'll come to you sometime later on and get your question, yeah.
Just a general one, I think this 1 to 3% range for the premium sounds too narrow for the range of like diverse risks that you're underwriting.
Yes, thank you. It's very cheap, yeah. Yeah, it is narrow and it is competitive, but it's probably a little bit less competitive than it sounds on face value, because the reality is that if you're looking at a forward contract, we look at the proportion of credits sold forward as a proportion of total yield expected. And the reality is that on a really good deal, a conservative estimate on a good project would be they're not selling forward more than 20 to 30% of a first issuance, which means you have an 80 to 70% performance buffer before the forwards start getting hit. So yes, on face value, it sounds really narrow, and I'm glad you said that, thank you. Haven't offered you a beer, but I will. But the reality is that when we look through the transaction details, it turns out to be quite fair. The key is getting that cost weighed in early so that it's not a tax at the end of the transaction. So for this insurance to be a facilitation, it has to be integrated in the economics early. But we're finding that the counterparties of the market are very, very accepting of that kind of cost basis. And by the way, there's no such thing as perfect pricing in insurance. No one really knows, otherwise no one will pay any claims. What we need to discern is what a good risk looks like versus a bad. What the right pricing is really a question of pushing the demand curve and being of value and working out what people are willing to pay. So that's what we're currently doing right now. But at that kind of price point, we seem to be getting quite a lot of traction, so we'll see how it works out. Okay, thanks very much. Thanks, everyone.
Okay, so we did start a little bit late, so I'm going to try and keep us on track. So I'd like to welcome Richard Foland, who will be the moderator for our next session, that is Carbon as a New Asset Class for Institutional Investors. Welcome, Richard.
Well, first of all, could I invite my fellow panelists up to the stage, please? And we will kick this off. And let me just... George, thanks very much for that. It's fascinating with audience questions, actually, isn't it? Once you get one, then you get a whole load like London buses. But that was a really interesting presentation. We have another CFC panelists now, so we may well hear more about their products. So first, to get the introduction out of the way, I'm Richard Foland. I head policy for Carbon Tracker, the financial think tank, and in terms of my background, I was a long-time British diplomat, head of international energy policy for the British government back in the day, 20 years or so ago. And that was at the time, in fact, when Nick Stern published his Economics of Climate Change, a seminal study, in my view, which remains a foundation stone for carbon as the pricing of carbon as a policy instrument. I was then JP Morgan's European Energy and Climate Policy Advisor for quite a long time. So I've seen the ups and downs of the carbon market, both in the compliance market and in the voluntary market as well. But enough of that introduction. We've assembled here a stellar panel of experts, I should say, on the topic which we're going to address. But maybe if I just explain how we're going to run the panel now. I'm going to turn to each of the panelists in turn. They're going to introduce themselves and their organisation, and in particular their interest in this topic of carbon as an asset for institutional investors. Then we're going to have a second round of questions then, and that's going to be looking more at opportunities here that each of the panelists might look at for themselves and their organisations. And then we're going to have a third round, so we'll have looked at opportunity, but also where are sort of barriers as well, as far as the development of this market is concerned, bearing in mind that it is an emerging asset class. And after that, I'm hoping we'll have sort of 15 minutes or so for questions for the audience. So if you can think, as the panelists are speaking, about questions that you would like to ask, this is a new theme. I'm looking forward to learning a lot from the panelists here. And I hope we can really sort of dig into some of this. So let me go first of all to our first panelist, if I can ask Adi, who is from CFC, who's going to introduce himself, and perhaps not such a long introduction on the organisation, having heard from George. Thanks, Adi.
Sure. Thanks, Richard. Great to be here. I'm Adi. I'm Innovation Manager at CFC. I'll skip the introduction about CFC, given we've spoken about it, but in terms of our interest in the carbon markets and our role, our main goal is to use insurance as a tool to facilitate the flow of hundreds of millions of potentially billions of dollars of capital towards high quality projects. So we're here to work with stakeholders across the value chain, project developers, financiers, investors, lenders, commodity houses, corporate buyers, to understand their risk exposures and to give them bespoke solutions that address those risks. And that's really what we specialize in terms of addressing those emerging risks where traditional carriers might not be able to. The carbon market is littered with risk. There's project risk, there's counterparty risk, there's political risk, there's natural catastrophe risk. And the solutions we're building will enable owners of carbon assets to truly treat it as an asset because it protects the value of their investment. So that's the nature of our interest in this topic.
Great, Adi, thanks very much. And I think that builds very helpfully on George's presentation earlier, and we'll hear more. So next I'm going to turn to Julia Kaszniska, who is Investment Manager of Climate Asset Management. Julia, over to you.
Hello, everyone. It's a pleasure to be here. As Richard mentioned, I'm working for Climate Asset Management, and we are a natural capital fund. So we were set up as a JV between HSBC and Pollination to purely focus on natural capital. At this stage, we have about $1 billion of assets under management, and I would say about 60-70% is pure carbon. And we we play with the carbon in different shapes and forms across our fund products. Some fund products having carbon as a sort of add-on revenue. In other funds, it's just pure carbon money and carbon out. And obviously, when the firm was set up and the way we were thinking about carbon as a new asset class, we were thinking about, okay, how do we address the gap, the funding gap in the sector? How do we address the question of demand? And this is when the product was built. And the way we built it, in the absence of tangible demand, we decided, well, we're going to invest against the stream of carbon. So we are investor and off-taker for many of these projects in sort of one product, fund, person. And it did help us to aggregate demand for this and also tap that gap that we know exists in the market. Obviously, we as the world are still way to go to close the gap. We know that it's billions and billions. We already know that we're super short of NBS removals and tech removals, to be honest, in 2030. But I suppose every little helps, and it's great to see how over the last, I would say, 3-4 years, the market started institutionalizing. Probably much more progress has been done in the last 4 years than it has been done, you know, in 20 years beforehand. Thank you.
Julia, thanks. Interesting comment there at the end, the progress made in the last 4 years, and maybe we'll come back to this in terms of the emergence of carbon here. So next I'm going to turn to Simon Pouliston-Jones, and Simon is the founder and managing director of Emerald Carbon. Simon, over to you, please.
Thank you very much. Thank you for the opportunity to speak today. In terms of interest in the topic, climate change changed my son's date of birth in 2019, which is an unusual intro, but you can ask me in the coffee afterwards how on earth that's possible. But it does rather provide motivation to make a difference on the topic. On the institutional side, I've spent 26 years working with or for institutions and institutional investors. I started my career as a lawyer in 1999, setting up hedge funds on the legal side. I then spent the next 20 years in structured finance and derivatives, either as a lawyer, much of that time inside Barclays Investment Bank, and some of that time running a trade association in financial markets for derivatives. These days, I guess I'm probably best described as a Swiss Army knife of carbon markets, because I come at the market from a variety of perspectives, which I have the privilege of doing because I'm an entrepreneur, and I've got a habit of setting up businesses. So the businesses that I run today, some of them source project finance and or buyers for carbon project developers. I consult to Philip Lee, the law firm that's been voted the world's best law firm in the VCM for the last couple of years. And with that hat on, I'm mostly advising institutional investors on their financing of carbon projects or advising people on offtake. I also run a jobs board for carbon markets, so active in recruitment, and I've had the opportunity, which I've had to sadly decline, to be an insurance broker in carbon markets. And with the lawyer hat, I'm not only advising on project finance, but oftentimes, increasingly now, advising insurance companies, a range of insurance companies on a range of innovative projects. And because of things I was doing 10 years ago, I'm also increasingly still active at the intersection with digital assets, smart contracts, and all things blockchain.
Simon, that's great. Thank you very much. Well, fascinating array of perspectives that you've got here, and hopefully we can bring those further into the conversation about the growth of the market. So if I can turn for our fourth panelist to Nilesh Agrawal, who's the founder and CEO of Calculus Carbon. And Nilesh, if you can tell us a bit more about yourself, your organization, and your interest in this market.
Sure. Thanks, Simon, and good afternoon, everyone. Thanks for having me. So Calculus Carbon is a Temasek portfolio company. Our mandate is to kind of help fund managers in the global north to source assets across the global south. So that's South America, Southeast Asia, and Africa. Currently, we're working with 25 odd fund managers, and we run an array of mandates across structured debt, equity, and project financing. Our interest typically is the way we are trying to kind of build capacity in the carbon markets and in the NBS market broadly is to kind of layer up the capital structure. So, you know, we've seen that at different level of NBS or nature-based projects, we've seen a different risk return profile for what the project needs. And accordingly, we would want to kind of have the right capital provider get in at that stage and to bring them in. And I think just to kind of take a leaf from what George said, I think there is a specific sort of role that each capital provider plays, and we are trying to leverage that by kind of bringing them all together for each project developer, so that each project developer over the long term can be as sustainable and as bankable as it needs to be. Thanks.
That's great. Thanks very much, Nilesh. So having established your credentials, your interest in this market, perhaps we could dig a little bit now into this, looking at it for institutional investors. And the exam question here, looking at this, is with carbon emerging as a new asset. So really to look at that, concentrate on that, and looking at opportunities around that. So it'd be really interesting to hear what you've got to say here. So Adi, if I can turn back to you, please.
Yeah, it's an interesting question, right? Why now? Why is carbon being treated as a new asset class now? And I mean, carbon credits have been around since the 90s. So what is the pivotal factor at this moment? And Anecdotally, some of the things that we're observing in the market is, so we've been actively trading insurance products for over 12 months now, and there's been a stark shift in sentiment. So last year, a lot of the discussions we had, they had an undertone of caution, sometimes even pessimism. This year, a lot of the discussions we're having have a really strong tone of optimism. Deals are happening, capital is flowing. There's different factors for that. Maybe the climate emergency is getting worse. It most definitely is. Governments are taking action. Carbon credits are gaining utility. But I think one of the key factors here is the carbon projects are becoming bankable because the entry of long-term offtakes by really creditworthy companies, Microsoft, Google, Meta, are putting hundreds of millions of dollars, potentially billions of dollars of capital to work to lock in long-term supplies. And that actually changes the game from a risk-return perspective or a project financing perspective. Because if you think of a carbon project, there's two main risks. You have credit generation risk and then credit monetization risk. Previously, developers, financiers, investors were banking on prepayments or on forward sales. On prepayments or on the spot market to monetize their credits. But with these long-term offtakes, you now have a predictable, stable cash flow profile. It makes these projects bankable, lenders are coming in a big way, and that creates this sort of flow of debt capital, which reduces the cost of capital for developers, and just puts this virtuous cycle in motion. So, in my opinion, one of the big shifts that's taken place is carbon projects have become bankable due to these offtakes. And I think that's why carbon is slowly going to establish itself as an asset class in different manners. Maybe the carbon project becomes an asset first, carbon credits later on, but in some shape or form, it's going to give rise to debt opportunities and eventually even opportunities to hold a carbon credit as an asset on your balance sheet.
Thanks, Adi. I note there you talk about it's still slowly emerging, and maybe we'll get into this further with questions. What more could be done to accelerate the growth of the market, which sounds like it is going to be extremely necessary. As you were describing the depth of the and the gravity of the climate crisis, and actually be interesting when we get maybe to audience questions, if anybody would like to challenge this sort of more optimistic sentiment, shall we say. Julia, can I turn to you, please? So why now, really, for carbon emerging for institutional investors?
Well, I think the market is getting critical mass. What we see in the market, despite all this sort of ESG consolation, in fact, large corporates with SBTi and net zero commitments, they are still in the market. I think what they're really seeking is quality, which can be widely defined. Obviously, there is no definition what quality means. Each company defines quality based on their own perception. But it's not really a question now, okay, do I need to offset my residual emissions or not? They all know that we do need to. What's at the moment is sort of holding people back, I would say, is really that reputational risk. So this is where we kind of need a bit more regulation, a bit more push from the government, a bit better signal, nudge to the companies to be comfortable with carbon markets. But we definitely see demand for high quality NBS removals and tech removals. Obviously, as CAM, we do not invest yet in tech removals, but for high quality NBS projects, there is demand. Now, corporates are not skilled in investments, right? They're good to potentially provide an offtake for carbon offsets, but then this is where we sort of came in 4 years ago, is okay, well, we're going to add that institutional layer for corporates to make high quality investment decisions. And this is when and how the sort of climate asset management was built, and this is how we came up with the product, because there was that gap in corporates that we filled in to be able to, or enable them to actually take these investment risks. But that was only because there was no, back then, there was no really that sort of demand signal, oh, I'm going to write a long-term offtake and then the financier will come and will provide capital, right? Because there is a lot of moving parts, a lot of risks for many people, for many institutions. The market is quite new. But it's definitely gaining pace. And you probably have seen, recent announcements by Meta, Microsoft. They're all underwriting millions and millions and millions of tons for a very long term. And this is great to see. Obviously, there's still a lot of risks in the market, and I was quite amazed, I suppose, to see how the market self-regulated last year. The only sort of issue, I mean, not the only issue, but the issue I have is that everyone is sort of thinking, okay, how do we protect the buyers? But all of a sudden, everyone forgot about the financiers. And it's great that methodology are being rewritten, but I'll just say one thing. I mean, money likes certainty. And although I appreciate sort of the quality and self-regulation of the new methodologies, how they're improved, I mean, the more you start meddling in predictability and uncertainty, the higher the cost of capital will be, right? And we're here, in order to scale the market, make it affordable, you do need certainty.
Julia, thanks very much. Interesting there where you were talking, I think, well, about the growth in the market, and to some extent, so picked up on Addy's point, I think about a virtuous circle to some extent. Critical mass is the expression that you used, but also, maybe we'll come back to this, but whether, the self-regulating aspect of the market you talked about, that's because of the critical mass being achieved. Interesting, both of you have highlighted Microsoft as major players in this market, and again, perhaps are they outsized in that respect? But Simon, over to you. Really interested to hear what you've got to say on this.
Thank you. Just to pick up on a couple of comments already made. So, Addy, you started by saying it's not a new market, and you're absolutely right. What it is a market that has failed in 30 years to scale. And so what we've benefited from in the last few years, particularly the last 3 or 4, is a lot of new talent flowing into this market to try to figure it out and how do we scale. And there are signs that we're moving in the right direction. Today, Ecosystem Marketplace have published their data on the state of the market last year. And what you'll see when you get a chance to see it later or dial in at the 4 p.m. summary is the number 535 million. That's the value of credits that were traded last year versus 2.1 billion in 2021. So this market last year is a quarter of what it was in 2021. So we're failing by one measure. On the other hand, I'd argue we're succeeding a lot. The market's not new, but we've done a lot of work around integrity, a lot of work on the supply side. We've continued to do a lot of work on policy, and you heard all of that this morning. We only have to turn on the news to see the urgency of the need to address the problem. And there is increasing consensus that carbon markets have an important role to play in addressing the problem. And we can argue when, how, but I don't think we're arguing whether carbon markets have a role to play. So it's about getting the design right. So the macro trends are there. We clearly need to do something. Why does it feel like a new market? Often because it's full of new people who weren't here 5 years ago, including me. Because there's that sense of opportunity and just seizing the opportunity that's there that we know has to be realized successfully because our futures depend on it. So one way or another, we'll make the market work. So as the institutional investors come in, your other point was, well, the market's not new, but why now? Yeah, why are people coming into this market? They're coming in because of that opportunity. And so what types of institutional investors are coming in? There's so much opportunity that pretty much all of them, except I'd argue pension funds and to some extent hedge funds, and they will come, but they'll probably be last. So venture capital is always keen to finance innovation. And as those companies get bigger, then the private equity comes in. So there's an opportunity to invest in the ecosystem, rating agencies, MRV, project developers, and so on, insurance companies even, and those that provide data. The banks are there, but we'll come on later some of the challenges that banks face, not least the word bankable. The commodity firms are there, and they are largely the ones that are doing the financing. So although the headline number, and The Guardian tomorrow may well say, oh look, carbon markets have gone down by 75% in 3 years, brilliant. What I see, particularly with my lawyer hat on, is a huge amount of money, billions going into projects. And those billions wouldn't be being financed if the lenders did not have confidence in the ability of those project developers to develop credits that find buyers. So see them as the sign of confidence in the future of this market. Partly that confidence can come from convergence between the voluntary carbon market and compliance markets. I think increasingly we need to talk less about voluntary carbon markets and talk more about project-based carbon. And the use cases are whatever the use cases are. And of course there are investment managers and funds and asset managers. And then the carbon markets are not immune to technology. Wholesale financial markets that I came from are at pace looking at digitalization. And behind the scenes, not all of it public, there are some very large institutions doing some very exciting things on digitalization of carbon markets. So I think there's just a huge swathe of opportunity, regardless of who you are as an institutional investor. And risk management is going to be a critical part of helping scale. So good to see so much talk about insurance today.
Simon, thank you. Fascinating run across the course, I think, looking at it from the different perspectives. And I think what you said there is not actually out of line with what Adi and Julia were said, notwithstanding the point you were making about the downscaling of the market, but actually you seem to be talking a lot under that heading of opportunity about the potential with the market having undergone this, I suppose, rigorous self-examination. So, Nilesh, can I turn to you? And again, coming back to this theme of a new and emerging opportunity for institutional investors. Thanks.
Yep. I think I'll just build upon what Simon said. I think what's changed in the last couple of years, definitely on top of new talent coming in, is also a lot of structure that's been come up in the market. I think what's happened is a lot more mature institutions, including hedge funds, by the way, we are working with a couple of them. They have kind of come in on back of certain, long dated off takes, which provide that sort of visibility to again build on what Aditya said. So I think what's happened is what we are working on, we've seen mandates for commercial structured debt and equity coming on top of long dated carbon off takes, and that sort of works to bridge the different sort of risk return profile across different parts of the project life cycle, right? So I think that's an interesting maturity that I've seen coming up from financial institutions who've, including the banks, come in and use their balance sheets to kind of increase demands in this market and also build capacity, because once you have early stage capital, which is project risk capital coming into the early stage of the projects, you see a lot more capacity being built, which is mature and of higher quality. And on back of that sort of builds that virtuous cycle that we were talking about for corporate off-takers as well. And I think a lot more other institutional funds, including that of CAM, have come up with long committed funds, so 10, 15-year funds, that also I think would deliver that demand over that time period. So I think those are the few things that to note on top of obviously annual offtakes. I think that seems to be a very limiting sort of analysis of the market. I think a lot more has happened on the structural aspects of the market, including the quality through ICVCM, CCP labels and all of those. Yeah, that's my take. Yeah.
Nilesh, thanks very much indeed. So we're going to go to our final round here with the panel, and then we'll turn to the audience for questions after that. So we've done opportunities, we've done potential. Inevitably, we're going to have a look at the barriers now as well, but also try to look at it through an optimistic lens as well. In other words, what barriers need to be removed, addressed in terms of accelerating the market in this area. So, yeah, Adi, if I could turn back to you for your thoughts on this, please.
Sure. I think one of the key barriers here is economic utility of carbon credits. Carbon credits at the moment, they're a tool to do good, but there's only so far that we can go when it's a voluntary tool that companies will use to perhaps do some good or operationalize their ESG strategy. George made this point earlier, but what we're seeing is a lot of demand from areas of the market where carbon credits carry some utility. So we're talking about the Singapore tax scheme, for example, where using an eligible carbon credit can get you up to $25 of tax rebate. Look at the South African scheme. Nilesh and I were discussing this earlier in the day. Local companies in South Africa buying local credits can get up to 200 Rand in in a tax rebate. So the moment you have that utility, it creates a price floor, and more than that, it introduces sticky demand, which will be there year after year in a predictable fashion. So I think one of the big barriers here is building that demand up, but more from a regulatory or legislative standpoint, where governments step in, allow carbon markets to work in tandem with policy, and actually build these economic incentives to encourage participation in domestic carbon projects and potentially even international carbon projects.
Thanks, Adi. I understand, I wasn't here this morning, but the British government, there was a British government policy official. Did they have anything to say here about the role of policy and regulation in this area and addressing the barriers?
Well, as far as I remember and understand, I think that the UK stance is that we will meet our NDC target domestically as opposed to buying from international projects. But there is discussion about introducing projects from the Woodland Carbon Code and credits from there to be used under the UK ETS. And that would be a phenomenal example of where carbon credits, I think Woodland Carbon credits go for like £30 today, whereas the ETS allowance is about £60. So immediately there's an economic incentive to buy that Woodland Carbon credit, and that funnels investment into nature-based initiatives and into the real economy.
As an economic utility. Thanks very much for that, Adi. So Julia, over to you. What are the barriers and what really needs to be tackled in terms of accelerating this market then?
I totally agree with what Adi said, and I like the expression of economic utility. So demand definitely is one of those. As I mentioned before, sort of at CAM, we sort of decided to aggregate the demand in a way from corporate investors and then deploy it into the underlying projects. And I generally sort of, my background is in infrastructure, and I jumped into carbon markets a couple of years ago. And I think for us as a financier, to really institutionalize this market, what we would like to see from project developers is a bit more skin in the game. Obviously, the huge obstacle is the fact that carbon developers simply do not have any equity to put into the project. Very few of them have capital to actually develop the project, right? So a lot of project developers actually even need grants or some sort of early financing to develop the project, then for CAM to come and invest in scale up. So, and if you look at the space generally, as sort of NBS, obviously tech removals is slightly different. It's different type of players, it's different type of money we're talking about, right? It's not about, tens of millions of dollars. It's actually hundreds of millions of dollars. So it's a different, slightly different market, but actually nature-based solutions, NBS ARR projects. If you look at the landscape, who we're dealing with, who is our counterpart? So you either have startups that just, decided, why don't we come into the market and develop the projects and then try to raise funding. Another category are NGOs, which is great. They've been on the ground for many, many years, but then not all NGOs are commercial enough to be able to liaise with institutional investors like us. And then you have a very, very limited number of those commercial institutions who know how to execute the project, have been around, planting trees for a while, have some carbon experience, and have some capital at the holdco level, the topco level, to actually put in the project development. And this has been a significant obstacle to actually obtain funding, and funding at a reasonable rate. So we talk about, leveraging and project finance. Well, I'll tell you what, project finance is very expensive in this market. It's nearly like 15% plus, which is really not, if we want to scale, that cost needs to come down. And if you think about, the construct of sort of in funding the project against the offtake, with a 15% required return, NBS issuances coming every 2 or 3 years, if your cost of production is $20 per ton, you very quickly get to $40, $50 mark on the price, just because of cost of funding. And it's really been a huge, I think it's really a huge barrier really to make that carbon, especially in the voluntary market where we don't have that regulatory floor to really scale that. So I think it's really a combination of various things, and institutionalization of the capital, and generally the market, the maturity of the market, that would help lift those barriers. And obviously insurance, I think I'm really glad to see sort of, that those products are popping out, because there are a lot of risks inherent in the market that you need to cover. And the thing, in project finance, you need to be able to allocate the risk to the party who is most competent to take it. And there is a number of risks in this market that no one is competent to take. What if the methodology changes? Like, is that project developer's fault? Is it financier's fault? No. So who's going to take that risk? And I think this is where sort of additional products really help from the insurance market to actually close some of the gaps. But then obviously underlying problems still there. Cost of funding is really high as well.
Thanks, Sheila. I think it's really interesting to hear you sort of spell it out, really, the challenges there around costs from that institutional investor perspective. Simon, over to you, please.
Thank you. There are dozens of challenges, but if I try and bundle a few of them up, demand, financing gaps and opacity of who will lend what, shifting policy, reputational risk, and a need for education. Taking each in turn, on the demand side, if people aren't talking about that being the number one problem, I don't think we're focusing on the right problem. So we have to fix the demand side of the market, having spent a lot of time doing supply side. Personally, I think the way to do that is to look at a more integrated market between compliance and project-based carbon, where we use proceeds from an emissions trading scheme that does not contain any project-based carbon at all. And we use those proceeds, some of them, to provide a floor price for central government procurement of project-based carbon, if needed, as a buyer of last resort. That, being a buyer of last resort, enables the unlocking of finance, because it gives the lenders confidence that there will definitely be offtake, even if it's a government as a last resort, and that'll enable the finance to flow. In terms of those financing gaps and the opacity, some people come to me to go raise project finance for their projects, because it's really hard to understand who will lend what amount of money in what circumstances to a project developer at which stage of their development. And the only way you know the answers to those questions, is if you speak to the lenders. And unless you've spent years speaking to lenders, it's going to take you a very long time to find that out yourself. So there's two financing gaps that I see. One is the one that you just mentioned, Julia, which is going from 0 to 1. I've got an idea to, I've got my PDD done, project's registered. That's really hard. And the people that I do see lending there are lending at eye-watering rates. Then you've got the other financing gap, which is you need 25 million, 50 million, 100 million, 200 million, 300 million, right? So you need more than, say, 2 to 20. The 2 to 20 market is fairly well serviced today, and it's mostly actually commodity firms rather than banks that are servicing that at the moment. Why? Because the challenge with banks is their first question, as they look to assess the bankability of your project, is, have you got offtake? And 99.9% of projects don't have offtake, and so the banks won't lend to them. There are ways to mitigate that, as we've been hearing, but that then creates a gap, and that gap is being filled by commodity firms with a higher risk appetite, who take the view that they will provide the money, but they will take the marketing rights, and then the ability to get repaid is in their own control, and they're confident in their ability to sell. There's then fragmentation of the financing, to the point I mentioned earlier. So one of the problems I'm looking to solve behind the scenes is to bring together a group of bank, non-bank, and development banks together to finance carbon projects at scale, so we can bring developers on that growth journey through what I'll call a stairway to heaven. But really what I mean is by connecting them with the right finance at the right time, by orchestrating the finance side of the market proactively. Shifting policy, we've heard a lot about today, but I only have to mention a variety of acronyms along the lines of ETS, CORSIA, PACM, CRCF, to give you a flavour of the complexity of the market. The reputational risk, I'd like to argue, is overblown. I would love to see a bit of analysis that shows the harm to the share price versus being on the front page of The Guardian because Guardian thinks you've done something wrong. And I suspect there's no lasting impact on your share price. And so the approach the industry's taken over the last 3 or 4 years to just respond to trial by media, I think, is the wrong approach. There are thousands of people around the globe with the best of intent to the best of their ability looking to scale this market. And I think we should focus on not perfection, as we heard this morning. It's all about progress over perfection, and not looking to trial by media, but just show, don't tell, just get on with it. So the last bits then are around education and how are we all going to get there? Simply through collaboration. The beauty of this market compared to others I've been in is it's not a zero-sum game. My victory is not your loss, or vice versa. Why? We've all got the same North Star as to the problem we're trying to solve.
Simon, thanks so much for that quick follow-up question on reputational risk, because Julia, you mentioned that as well. You think it's overblown. Is that the hangover really from carbon markets generally? We can think back to the problems that the EU emissions trading scheme had in the past and so on. Or is this more specifically about the voluntary market and question marks about integrity and additionality and so on? Both of you.
Yeah. I think, again, I think the problem is that the market is not regulated, right? It's a voluntary market, it's self-regulated. And there are a lot of unknowns. And when a couple of years ago, the Guardian articles came out, it paralyzed the market. It did actually stop any spot market purchases. That's why we see the value of the market we see. But then if you dig deeper a little bit, the volumes, in fact, did not really fall that much. It's really the price that was affected, and it's the price of sort of those project types that are a bit more difficult to assess, right? So it's REDD+. What would we know what deforestation rate would have been if we didn't intervene? That's big unknown. Soil carbon, difficult to quantify, is 1 ton. Obviously, there is a lot of legacy methodologies that allowed the market or the players in the market to game the system. So there were sort of, bad actors, but I think the underlying, why would corporates do that? Well, they have certain net zero targets. They committed to offset their residual emissions. And ultimately, it's a voluntary commitment, right? So they are trying to do the best they can with the highest quality credits that the market was simply not delivering at the time. And it did affect significantly. But then last year, we saw huge demand signals from Symbiosis Coalition, from US tech companies, but also B2C companies. They keep low profile, but they're there. And we did see them committing to those safest carbon project types, right? So it's either tech removals or afforestation or reforestation projects where it's much easier to quantify carbon. But for example, we do not see them yet en masse in those more challenging product types or project types with their money and their offtakes.
Thanks, Julia. I mean, given you both highlighted reputational risk, I thought that was just worth digging into a little bit more. So thank you. So Nilesh, barriers, the last word to you, please.
Yep. I think barriers pretty much covered. Maybe I'll borrow on that phrase from Simon and give an instance of a stairway to heaven sort of an example where we've been able to successfully sort of stack up capital for a South African moringa plantation. So South African, as Adi referred to, is a local compliance market wherein local corporates with a high GHG sort of intensity have a mandate to purchase in the local market. This particular project developer that we kind of helped represent, they were able to secure a long-term offtake up to 2 million credits from a local chemicals company. Now, on back of that offtake, firstly, we got a lender to finance the feasibility study, although at an eye-watering rate at that. But I think follow-up to that, we had a hedge fund coming and write a check of up to $1.7 million that kind of financed the initial 100 hectares plantation of the project. Good thing to note is there's sorts of also commercial revenue stream from few of these nature-based projects. So in this particular moringa plantation, we had like commercial revenue coming in from sale of zeatin and from a green extract which comes from moringa. So they had long-term offtakes on that. So that helped hedge fund kind of run sensitivity kind of in case carbon doesn't work out. And then once this project hopefully delivers the 100 first hectares, I think we have enough interest from long-term like equity providers from 2 to 20 million. Right now we have expression of interest of $25 million at a growth stage into this project, which could kind of scale up the carbon project to kind of deliver that initial offtake demand of 2 million credits. So I think there's enough sorts of capital providers at each stage. I think one value that we've seen that could be added in the market is the capital providers to talk to each other on top of what everyone's already doing, for them to know what others are doing and what else exists out there in terms of products, and that could kind of help them figure out the person above and below them in that stack. So I think I'll leave you that with an example. Happy to discuss more on that over coffee.
Thanks, Nilesh. Yeah, no, I'm sure the audience would be interested to talk more to you about that in the break, perhaps, on the case study there. And I'm sure that Jimmy Page and Robert Plant would be very pleased to know that the title of their most famous song could be adopted as a virtuous pathway going forward for the carbon market. So I think we've got a few minutes left for questions. Am I right?
I think, yeah, we can do a couple of quick questions.
Okay. All right. So if you'd like to stick your hand up and introduce yourself. Yeah. Thank you.
Hi there. I was just wondering around whether or not you thought project developer consolidation would help the market, considering you say there's a lot of a lack of access to capital for those companies, and those companies that potentially are struggling financially could pose a worse risk.
Simon.
If I slightly rephrase the question, has the time come to pick winners, back them? I think the answer to that is yes. I've been thinking about that for a few months. I think that's yes. Some of the winning project developers are in this room. The danger is that today's winners may not be the ones that we need for tomorrow. So there are pros and cons. We can't finance 150 DAC developers. And there's a healthy discussion about whether one should be financing DAC at all if you can get the same ton removed for the price of biochar or something significantly cheaper than biochar. So to the point that Guy made this morning about there being a finite number of dollars. Yes, I think we will see the market back an increasing number of winners. What do I mean by winners? I mean those who can demonstrate they can execute, those who can raise project finance, find the off-takers, deliver the projects, not need to call on any insurance policy they may have put in place along the way, and they just scale, scale, scale. We're starting to see them evolve and emerge.
Thanks, Simon. Any others you'd like to take that question?
So just
Adi.
add a perspective to that. In terms of, so our observation in the market is there's a new cohort of developers that's coming around. Now, previously developers were sort of technical experts or agricultural experts who are building these projects because it's something they're really passionate about. What we're seeing now is development entities are moving on and they're becoming this this nexus where we have investment banking professionals, marketing professionals, all these, I mean, wonderfully talented people coming together, and they're raising tens or hundreds of millions of dollars. And that changes the game entirely, because if you're competing against that entity, what is your right to compete? So potentially, I think it's only natural that we will see more consolidation, because as this new cohort of developers emerges, to maintain competitiveness, other developers might be forced to consolidate. So I think it's more than likely that we'll see that.
Yep.
Yeah, Nilesh.
Yeah, I think just to draw a corollary, I think the market is quite maturing to a way you would see a real estate developer or an infrastructure developer. So there are a few big ones who kind of arbitrage on the cost of capital because of this size. Folks like Permian, for example, they're able to kind of deliver projects at a large scale, and that kind of helps also kind of improve the bankability at the holdco level as well as individual project level.
Thanks, Nilesh. We've got time just to squeeze in one more, if anyone would like to ask a question. If not, we can go to, is it coffee next? Yeah? Oh, all right. Oh, no, there is one at the back. Just one more. Sorry.
Last question. Max Hobhouse from VPlanet. I had a quick question about the role of blended finance in the carbon markets. A big issue with restoration projects is a long period of illiquidity. And I wanted to ask the kind of panel their thoughts on blended finance and bridging that gap.
Thank you for your question. Who'd like to take that? Yes, Simon?
So you may have seen Kumo last week announced that they've brought together 12 tier 1 banks to finance carbon projects. And I applaud them for that. I know how hard it would have been to do that exercise. It's progress, but for all the reasons I mentioned earlier around bankability and the general topic of risk management, those banks fit somewhere in that stairway to heaven, sort of here, but there's getting up to there, and then there's de-risking the bank. So my view, the reason I'm talking to so many development banks at the moment about doing effectively Kumo 2.0, i.e. a wider coalition of banks, non-banks and development banks, is because you need to solve the entire scaling journey, not just a segment of it, ideally. And getting those development banks to provide the first loss piece is going to be increasingly critical as the banks come in and look to deploy the 50 million, the 100 million, the 300 million that those winners are starting to require to deliver at true global scale.
Thanks, Simon. So there you are. Hope you found that interesting. I certainly have, and have learned a lot. Multiple themes, multiple issues to tackle. A real brains trust here. If you just put your hands together to thank the panel.
Okay, thank you, Richard, and the panel. That was wonderful. So we are going to take a quick coffee break. In the interest of finishing on time, maybe we can shorten it a little bit, and if everybody could be back here by maybe 3:10, 3:15, that would be great, and then we can get out on time. Thank you. Okay, so in the interest of time, yet again, I think we will get started with the final part of the day, the next two panel discussions. So with that, I'd like to welcome Neha to the table as the moderator of this discussion. The discussion is around nature-based solutions and technology-based carbon removals.
Thank you, and I'd like to invite my speakers on the stage, please. I can see, yes, they're all here. Excellent. It's always difficult to get a late afternoon slot because the energy levels tend to sag a bit, but I'm really fortunate that we've got a bit of a tea break before this discussion, so hopefully everyone's got their caffeine hits. So we'll start off with brief introductions, and then we'll go into the discussion. I'd start off with myself. So I'm Neha Dutt, and I'm the UK government lead on the TNFD. How many people have heard of the TNFD? Oh, excellent. Okay. I was afraid there'd be no show of hands. So the TNFD is basically, for those who don't know, it's an international market-led, multi-government-backed, science-based nature risk management and disclosure framework, and I'm the UK government lead on it. Have been on the journey since 2019, when it was a twinkle in the eyes of Andrew Mitchell, who is the high priest of nature finance, and all the way through to its journey now, where it is, it covers over 7 trillion assets in management in terms of the organizations that were part of designing this framework. It's got over 500 adopters all over the world, even in the absence of regulation. And the reason it's got so much market traction is because it is a clear financial risk. Nature risks are investor material risks. So without going into too much detail there, I'd like to quickly get the panelists to introduce themselves. So Henning, could we start off with you, please? Just a brief introduction about what kind of work you do and your interest in this topic.
Yeah, Henning Huntelaar, I'm an associate partner with Bain & Company. We're a global strategy consulting firm. Well, as such, we have two roles really in carbon markets. We're, of course, advising clients. Typically, those clients are like the S&P 500s, the global corporates on carbon markets. I lead our carbon market practice in Europe on that side. And then, of course, we have a second role in the market, which is we're a buyer of carbon credits. Last year had a carbon footprint of around about 200,000 tons, which we completely offset. We were the first company that got our VCMI claim approved, which we're of course quite proud of. And personally, I've been in carbon markets for 20 years in various functions.
Brilliant. Thank you for joining us. Max, can I go to you next?
Hello, my name is Max Hophouse. I'm the head of strategic finance at Replanet. And essentially, my role at Replanet is to lead the kind of project pipeline and marketing of our restoration projects. At Replanet, we do large-scale ecological reforestation and protection. But I think it's kind of two significant areas where we differentiate ourselves compared to other developers. First is we use kind of science-based claims to all the biodiversity uplifts. So we sell not just carbon credits, we sell quantified co-benefits. And alongside that, we commit 60% of the project revenues back to local communities. And we see this as kind of a really critical part of the next step in the nature-based carbon markets, which is, we were talking today a lot about reputational risk. We see a really kind of big fear. The next Guardian article is saying that you're buying a credit where community is getting $1 worth. And the finances in the middle are taking the largest chunk. Pleasure to be here.
Great, thank you. Phoebe.
Thanks, Neha, and thanks to all of you for still being here at 3 p.m. to listen to the final two panels. You've heard a lot today about the role of insurance and how we can scale the carbon markets, but as insurers, as a more wider industry, we face a lot of risks associated with the changing climate, and as of this year, we have 146 billion pounds worth of insured losses, largely driven by the LA wildfires and other natural catastrophe events. So it's really in our best interest to support the carbon markets, and there's also a huge opportunity for us to create products which help develop and support the transition to low carbon economies and use our underwriting portfolios to kind of influence and nudge our clients towards more sustainable choices. I'm lucky that I sit within an innovation team with my colleagues George and Adi that sits at the forefront of driving a lot of this change within the market, and my role as a carbon underwriter is one of the first in the insurance market. So I have the privilege and responsibility of assessing different types of carbon projects and defining quality and supporting those projects with putting our capital behind them. insurance is a fantastic risk transfer mechanism that can really get a lot of investors and corporates comfortable with investing in the space for the first time or for growing out and kind of increasing the number of credits that corporates are buying. So really excited to discuss this topic today.
Brilliant. Thank you all. So I know you've probably heard about the policy and regulatory landscape earlier, so I won't do like a comprehensive rundown of it again, but I do want to start off at a very high level and just quickly paint the policy and regulatory landscape picture and the principles sort of, picture, and then try and link that to demand drivers. So at an international level, we've obviously got Article 6 of the Paris Agreement, which was agreed and finalized at COP29. We've got the various, exchange trading schemes. We've got Fit for 55, carbon border adjustment mechanisms, etc. We've got the ICVCM CCPs, a lot of acronyms and alphabet soup over there. And in the UK, at a domestic level, we've got the legally binding Climate Change Act, and we've got the several carbon budgets. We're in the fourth one right now. We've got the net zero by 2050 target as well. Last November, the UK government launched the Principles for Voluntary Carbon and Nature Market Integrity, which has been now followed up by a consultation on strengthening voluntary carbon and nature markets. And just to mention a plug for DEFRA here, because we're sponsoring the British Standard Institute's Nature Investment Standards work. And it's going to basically develop a suite of standards to ensure that UK nature markets develop with high integrity. In March, an overarching principles standard was released for market adoption, and there are other standards in development, including one for biodiversity, nutrients, and nature-based carbon projects as well. So we've got this whole raft of policy and regulation and principles in place. And turning to the panelists now, to what extent are these policies and principles actually playing out in the real world to develop into demand drivers in your respective areas? And if they aren't, delivering the kind of demand uplift, where are the specific pain points and market failures that you see? So could we start off with you, Henning?
Happy to take a first step here. I think in my perspective, both on the Bain side and to some extent, from our client-facing work, the policies that we see are helpful, and they provide, let's say, the first signpost of more support towards credibility of the market, support against the buy side, some of the criticism that we've seen there. Of course, support on also driving the work on the supply side and establishing better standards there. They're not necessarily yet a strong pull factor to really encourage companies to invest, but they certainly help to chip away at the risks that we're seeing and that we have seen for the last 20 years in a very early emerging nascent market that in some years felt a bit like the Wild West. And I think that is a fundamental first step that's critically important. But we need to go further, and we need to, in my perspective, also drive very hard incentives for companies to really invest rather than just helping them navigate the risks.
Interesting, thank you. And do you think that's more of a compliance market play than, just publishing principles and having policies and regulation? Like, what would it actually take?
I mean, yes, the compliance market could be one solution. I think there's a broad variety of nuances between a purely voluntary market and a very hard compliance market, like let's say a link between the EU ETS or the UK ETS and international carbon markets. And some of the approaches we see under SBTI making first steps to think through intermediate targets towards net zero goals for carbon removals. Those are some of the first steps that we're seeing, but it needs to be much more to really be a strong incentive.
Great, thank you. Max, over to you.
Not to completely avoid the question, but I think actually that the power of where we operate right now in the VCM is actually, it is a voluntary market. It does a lot of work in self-regulating, and actually where a lot of the policies and international work has been very successful is setting a skeleton of which the voluntary market has started to, and bodies like Verra and Econometric and others are starting to fill in the gaps. And I think that's been very powerful in that sense. But actually, I personally think that actually there's a lot of power in keeping it voluntary and not moving to a compliance market. I think it can be much more efficient if you kind of leave a bit of freedom so that when you're purchasing a carbon credit, there is a lot of different directions that money can flow. And so I think for me that it's been a kind of a good, I would say, nudger of kind of pushing the energies in the right directions, but I think more work should maybe be done into kind of how you regulate a voluntary market between third-party bodies.
Thank you. Just a gentle challenge to that point about voluntary markets sort of being, or needing to be sort of developed more, than that compliance. And so we heard earlier about, how in South Africa they have local compliance markets and how that helps the credit flow, because there is then a sort of a requirement on high-emitting, companies to purchase offsets and credits, etc. So, and that's driven by the compliance market regulation. So, I mean, would it create, more of a level playing field in the voluntary space, do you think, or?
I think having a baseline of compliance, a requirement to go purchase credits is potentially not a fundamentally negative part. I think for me, it's more of a pushback against trading schemes where you see a certain level of efficiency of kind of where that money flows. I think if you follow the ETS and UK trading schemes, you only get about a 70% efficiency rate of, I think last year was 43 billion euros kind of was raised to that scheme. 33 billion goes to countries. How many of that actually go towards climate initiatives within that? It's nearly impossible to track. Whereas actually a voluntary market, you can really directly link it with that purchase. And so I think there is work to maybe bridge the two. But for me, I think it can be a voluntary carbon credit because if there is a link which requires a certain amount of money to flow back to the project or to the intervention, I think it can be a more powerful financial mechanism.
Great, interesting points. Thank you. Phoebe, your views on policy and principles and whether they're effective demand drivers or not?
Yeah, I think they definitely are affecting demand, but I want to argue that there's other things that are potentially being more of a blocker to higher demand. And I was reading a blog by Microsoft the other day. Obviously, we have to mention them for the third time today, but their Climate Innovation Fund, they listed for specifically nature-based solutions. The biggest things holding back them and other buyers in the market are insufficient data, issues around permanence, and also access to insurance is one of the biggest challenges. I have a background in tech underwriting, so I think I inherently believe that applications of technology and AI, despite acknowledging a lot of the emissions that go into having to train AI models, can be applied to the carbon markets to unlock a lot of big buyers, drive liquidity, and kind of create a really vibrant spot market. Just to touch on a couple of examples that I've seen in recent submissions for nature-based solutions that have really highlighted how technology can drive transparency are one for kind of site selection processes, so using satellite data to accurately set and delineate boundaries for projects, which then can be cross-referenced with government records and other kind of open source data to ensure that the ownership and the land use is confirmed. Also LiDAR technology, which can really drill down to afforestation projects or deforestation projects and kind of measure the granularity of above ground biomass at a branch to a singular tree level. And also just digital MRV tracking tons of CO2 as they move through the supply chain can really enable, if you kind of feed that data into a tech platform that can be delivered then to the end buyer who can see kind of the levels of environmental integrity delivered with each claim, can really get around some of the issues which we've experienced on the nature-based side. And it's also interesting to see a lot of VC investors really get behind these tech enablers in the market right now to scale their infrastructure, make sampling more kind of cost-effective, and unlock some of the demand in the market.
Great, thank you. I like that level of technical detail you've provided there because that creates a nice segue into the next part of the discussion, which is going to now focus on the topic, which is NBS and technology-based carbon removals. To share with you, the topic initially was NBS versus technology-based carbon removals. And when we did a prep call, we all decided unanimously that it should be changed to "and," because, we need all hands on deck, all types of projects, to deploy in the war chest against the scale of emissions reductions that we need. So that's why, the topic was changed to reflect the "and" bit. But there is still, a recognition that there are distinct pros and cons. And, Phoebe, you touched on the permanence point and the access to insurance on NBS versus now technology-based carbon removals or engineered CDR. So let's just, move on to that now. And Henning, if we could start off with you. When you're dealing with clients who want to build decarbonization portfolios, who want to buy NBS, sort of offsets or engineered CDR, sort of removals, would you be able to give us a bit of color on the sort of advice that you provide them, and how do you kind of calibrate it to the client type?
Mm-hmm. So first of all, I think having a client that comes to us and says, help me build a portfolio, help us buy credits, that is a very rare occasion, quite frankly.
Mm-hmm.
And I mean, it ties to the discussion earlier. We lack fundamental incentives in the market to actually make it attractive to companies to invest that money, that go beyond doing the right thing because Microsoft does it, or because it might sound nice in a marketing statement, because frankly it doesn't. So it's not a common solution typically, or a common request. Typically, we get to that point after we help clients really build a comprehensive net zero strategy. So, it might be a company has made an SBTI claim without fully understanding what that actually means. And then it drops on somebody's lap to actually figure out how to implement that, how to get there.
Yeah.
And then, we start with really building that net zero pathway bottom up, helping clients understand what are your module abatement costs for all your emissions, and how do you get those carbon emissions out of your value chain, not just your own operations. And then, of course, carbon credits and either an annual offset or kind of compensation of your emissions, and then definitely the net zero residual emissions. That is a topic that we always bring up. Not always does our client then have the appetite to really go there.
Right.
If they do, it becomes relatively a discussion around portfolio building, because in our perspective, a portfolio solution is simply the strongest way of dealing with some of those risks, starting to diversify some of the risks, because the market is very risky, and the solutions that we have seen are simply not strong enough at scale to fully help clients build that risk away or hedge the risk away. And George, I was super excited about your presentation and your process flows, and I would love to learn more in a follow-up conversation, because that is going in the right direction. But as you said, it's 1% of projects that are currently insurable. So we need to build this risk understanding way beyond where it's currently at. And then once you start having portfolio discussions, of course, you start discussing nature removals.
Yeah.
I'm a big fan of the Oxford Principles and kind of charting a pathway for a portfolio that starts now and goes until 2050 or beyond. And of course, then thinking through what do you do in the long term, where we eventually need to move to a status where that permanence question needs to be fundamentally addressed. I don't necessarily think that a like-for-like approach is the right answer here, because that leads you to ignoring or putting aside or deprioritizing nature. I think there needs to be a market-based solution that actually lets us hedge away that permanence risk that nature implies or comes inherently with, and get to a solution where we actually have a way to allow companies to invest in nature credits, but at the same time manage the permanence risk, and let nature be a long-term part of any portfolio rather than an intermediate solution for the next 5 to 10 years.
Brilliant, thank you. That was really illuminating. And now if we could switch to, switch hats and look at Bain from the perspective of, a buyer of carbon credits, in terms of your own journey to net zero. You've recently got a platinum claim, with ICVC, which is really impressive, with VCMI. So from an organizational perspective, do you have a preference when you buy credits for NBS over engineered CDR? And if so, what do you normally go for?
So, I mean, just as I just mentioned, what we often discuss in the client-facing contents, we look at the Oxford Principles as a kind of a guiding framework for our own portfolio. Last year, the numbers we disclosed for in the last year for 2023 were roughly 200,000 or 180,000 tons. A bit more than 90% of that was nature-based. The remainder was engineered removals. And the target is very clearly to gradually increase the durability. That does not necessarily mean immediately switch to engineered removals. It could also mean, as I mentioned, kind of some solution that actually lets us deal with the permanence risk on the nature-based side. And then we have kind of a relatively elaborate process to screen for the right projects that goes through various stages of diligence and sometimes visiting projects to make then choices on which of these projects we actually want in our portfolio.
Great, thank you. And reputational risk was mentioned earlier. Is that a concern at all?
Oh yeah, heavily, because I mean we go through this quite extensive diligence process, of course, to manage the reputational risk. We have now a system where I would say most of the time we get it right, but in the past we also had projects in our portfolio that then found themselves in the media a few years later. And so it's not a perfect process, and I think that is important to acknowledge both for us but also for everybody else that engages in the market. You will get it wrong at some point. You just need to be very well prepared for that point to understand what happens afterwards. Does anybody get fired? Do you have a kind of an emergency communication process to actually respond to that? How are you in terms of how are you dealing with in terms of transparency? What information do you want out there about your portfolio? And the diligence process, we have decided for us that we want to be as transparent as possible. And so our entire portfolio, including every supplier that we buy from, all of that is public and on our website. But it is a scary thought, especially when you work in an organization that is not publicly listed, that has a history of being very closed up in our client-facing work and everything we do internally. So there were quite intense discussions with our risk committee, with our CFO, on how we actually approach that.
Yeah. Interesting. Thank you so much. And Phoebe, I'd really like to move over to you now. We've all heard, earlier today about the really crucial role that insurance plays in influencing the bankability of projects, etc. But, focusing on NBS and engineered CDR specifically, are there any distinct advantages, for insurance underwriters from the perspective of underwriting one type of project over another? And I'd really appreciate it if you could touch on things like buffer pooling and protection gaps and, the likelihood of payouts, etc., if you can.
Yeah, of course. I think the point we really want to hammer home as a team is we're really here to support every type of high quality project. So when we're looking into and assessing the risk, we obviously drill down into the merits of each project type, but arguably different project types, nature-based, engineered, and hybrid, are all doing slightly different things in the carbon markets right now in the near term and longer term. Nature-based solutions, we're looking at how they're channeling finance into the global south and using that to protect other forms of biodiversity, sustainable development goals, which we look at how these projects are delivering these benefits back to the local community and the environment. Engineered solutions, obviously, a lot higher capex costs. Yeah. There's the logistics with storing the CO2 and kind of the energy demand of supplying that with renewables. So there's a lot of different risks we factor in. The hybrid solutions, using a combination of technology to accelerate some of the biological and chemical processes, are really cool in their business models. They're delivering back different benefits to the farmers they're working with and also kind of improving soil health at the same time. So I think we really do take each different project type that we receive in a submission to their own merit. And as my colleague Adi mentioned earlier, the kind of new breed of project developers who are seeing branding themselves almost. I was in San Francisco going to the Climate Week there, and there was a panel discussing project developers who are deep tech, science, and data firms, almost giving off that message. And I think the data that they can provide us, that we can then use to underwrite the projects and cover off each of the risks and then put our capital behind that means we're here to support it all, just the highest quality.
Brilliant, thank you. And just to kind of delve a bit deeper into the profitability aspect, like appreciate that each project type has its own sort of unique fingerprint of risks, etc. But from an NBS and engineered CDR lens, is one more profitable for the insurance sector over the other?
Just going off the submission count, I guess we've seen a lot more in the nature-based solutions sector at the moment, but as we see engineered solutions kind of bring the cost curve down, and as those scale and they're more readily available to buyers, then that means, because insurers see what's happening in the market, the kind of reality of the deals that are flowing between investors, buyers, project developers, we will see more tech and engineered policies being required, more premium on that side. But as it is reflective of the state of the market, nature-based solutions are still the most cost-effective in many ways. And there was a patch report a couple of weeks ago that did say, although there's a lot of talk still about engineered solutions, a lot of people or buyers aren't putting their money where their mouth is and really investing in them yet. So because we see the deals happening in the market at the moment, profitability is with nature-based, but it will be a combination of all of them as we move forward.
Great, thank you so much. Profitability is mostly on nature-based solutions. Nice point to move to you, Max. So you lead on business development for Replanet. In your opinion, what are some of the comparative and competitive advantages and disadvantages that you've experienced in pitching NBS projects, to prospective buyers who have obviously a limited budget and who also face a wider universe of options in terms of engineered CDR?
No, certainly. I think when we're kind of pitching Replanet projects to funds and investors to get the implementation capital, the key risk for all reforestation projects in the restoration world is it's a project finance and you have a kind of lack of cash gap. The issue you have right now is that even if you kind of engineer the project as much as possible, so you're using fast-growing species that are still native, you're planting high density, you're managing mortality, you're really only going to get meaningful credit volumes about 7 years into the project. Add in an extra year for development up front, so you're looking at 8 years from ideation, strong ideation through to any kind of meaningful credit deliveries. That's a kind of not massive, but it is a considerable kind of financing risk that makes accessing insurance sometimes very difficult. But also it means that you need to kind of, I think in the restoration space, the reason why there are so many co-benefits added to it and actually why the restoration projects are so powerful and why buyers are interested is because it goes simply just beyond the carbon piece. You're actually selling an enormous story. So a key part of a restoration project is what's the cause of the degradation? Like why has there been a change of habitat? What are you doing to stop that? How are you working with the local population? Permanence is essentially a human piece. So what are you going to stop in terms of either leakage or farmers going back and degrading the landscape again? So that by the time you've made a pitch on a restoration, NBS restoration project, you've essentially told a story of how you're going to intervene at normally a landscape level. You're going to work with the local economy. And so actually it's so much more than just we provide trees, put them on the ground and hope that they survive. It is a kind of human investment. Now, I think the bit that we're discovering now is that actually NBS projects and engineered projects can actually overlap. You see a lot with biochar now. We're exploring carbon vaulting. We're working a lot of forestry companies that essentially once they've felled their trees or cashed their crop, you essentially bury and cap the remaining kind of cuttings. It is an avoided emissions additional, but it's a massively impactful and powerful piece. And actually, I would also argue that we shouldn't think of these two carbon removals in isolation, actually at all. And actually, there's more and more work, whether it's tech-enabled or biochar style interventions, that you shouldn't go for one and not the other. Like the permanence piece is being addressed in the NBS projects. And there's a lot to learn from both sides.
Brilliant, thank you. I think the core benefits piece is also really important, right, in terms of that powerful story that NBS projects can tell. But is that the same for hybrid projects? Like when NBS say meets engineered CDR, like you were mentioning, there's a new sort of stream of projects coming on board. Would you be able to tell as powerful a story in terms of local co-benefits and community sort of?
Definitely. To talk about kind of dirty word in the ecology space, we're working with palm oil companies to essentially say palm oil trees, you plant them, it's a monoculture, you kind of kill everything. They're only productive for 30 years. At the end of 30 years, you need to clear tens of thousands of hectares to get another operating crop. At that point in time, you can either vault it, biochar it, and if the proposition you can make to those farmers is actually keep doing what you're doing, keep farming. When you clear those crops, let's work with you to vault it. Let's reduce the emissions associated with your production. And actually, we're going to pay you to, when you reinstate the crop, add kind of biological corridors. We want you to plant 10% of the land to be biodiverse, and we're going to pay you to do that through the blended finance approach of carbon financing. So I think the key part is to be innovative, especially towards these commodities. You can apply that same model to the valley. When you're doing avocado, you're doing with oranges, citrus. It is a very powerful piece to use in agriculture.
Brilliant, thank you. I really like that point. So moving on to the risks and opportunities piece of this discussion, I know it was touched on in the previous panel. I think Richard talked about the barriers and enablers to scaling up demand, etc. But I want to focus on the risk sort of aspect of this first. And I don't think it's a coincidence that Microsoft has been mentioned so many times, and that actually points to the risk aspect of this. Is according to Fast Markets research, Microsoft accounted for 64% of all durable CDR, in 2024. And between Microsoft and Alphabet, they constitute over 70% of all CDR purchases. So, this obviously points to a buyer concentration risk. Henning, does this concern Bain in any way, or do you see, a kind of natural progression of this space to include, a broader church of corporates in the future?
Well, hopefully it does, because otherwise it's kind of a waste of time. If Microsoft continues to be the one buyer, we're not adding anything of value here. So I think, yes, there has to be a trend towards broader corporate participation. We see a few of them. And, I think it was probably MSCI that published at some point a report that counted the number of unique buyers in CDR, and those numbers are going up. In my perspective, they're just not going up fast enough. So I would say it doesn't fully concern us in our role as a buyer ourselves. Of course, we want kind of that to scale faster. It certainly would help some of the companies that we're buying from, and kind of get the technologies faster down the learning curve. But it much more concerns us from a perspective of a good citizen that wants the market to restart quickly. What I would want to add is it definitely also comes up in a lot of client conversations. So we're working right now, I'm working with a company in Finland who is trying to prepare for the financial closure, financial decision making on a pretty large scale bioenergy plus carbon capture and storage hub in southern Finland to eventually collect and sequester more than 10 million tons of carbon dioxide per annum. And the matter of fact is there's one buyer that can make that possible, and that's Microsoft. And that's not a healthy situation. And so if we don't manage to scale that, it's pointless.
Phoebe, over to you now. So from the insurance perspective, is this buyer concentration risk manifesting in any way in terms of like premiums being higher, or is it a concern at all?
I mean, the VCM has been through stormy weather over the last couple of years, and I think a lot of buyers have lost confidence in the market. What Microsoft is doing is admirable. I think we just need more buyers in the space. We're seeing a lot more interest come from different sides of the market that we haven't seen it before. So I think there is an optimistic note of where we're seeing interest come from right now, and I don't think... I'm going to be cautiously optimistic, but I hope that more buyers will just keep entering the space and scaling demand.
Brilliant. And Max, in your experience as project developer, how would you sort of see this play out in terms of corporate offtakes? Like, do you see a good mix, from?
Yeah, so I don't want to kind of disagree with the demand side. I would say a nuance I'd like to add to it is everyone knows of the shock of 2023. I think arguably the market has rebounded. I think you have to have a strong look at where that market's rebounded. And I think twofold is carbon markets are imperfect. In the NBS removal space, 95% of transactions happen off market. They are long-term purchase agreements that quite a lot aren't public. So actually a lot of the data out there in terms of the confidence is essentially, it's not out there, it's unknown, it's not in these reports. I think the second part I would say is that I don't know what the term durable means in the stats you said at the start, but actually I think it's also questioning is actually, I think the organisation that bought the most credits last year was Shell, and the second after that was maybe BP. That the firms that are spending the most money are the tech companies, and there I'm saying are offering kind of a northern light, but actually in the kind of myriad of different credit types out there that's being offered, I think there is still quite a healthy transacting market. So I'm not saying that there hasn't been shocks at all. There has been a significant concern, but actually I think the market is doing, I think, what all markets do in a healthy way, which is to respond and kind of try and self-improve and become more efficient.
Great, thank you. To your point about what does durable mean, so according to Fast Markets, and please anyone correct me if I'm wrong, but it's the ability to lock away carbon for over 100 years. So that's, I think, how they defined it. You mentioned that 95% of NBS sort of agreements take place off market. Can you just delve into that a little bit more?
So yeah, for example, at Replanet, the way we tend to kind of raise the finances, we design a project. We talking about the sweat equity earlier of NBS project developers. We essentially invest nearly $1 million into bringing a project to market. At any point in that time, for a myriad of reasons, the project might fail. Once we have it at about 800k spend, we will go and secure an off-taker. And then we go out to the markets and we say, we're looking for project financing capital so that we can kind of fund the gap to be producing credits. Most of our off-takes are not public. And so I can only speak from our own example, which is actually the majority of ours aren't public, so they're all under NDA. So for a lot of the other developers out there, they're probably similar circumstances in that sense. And I think you've also seen a lot of buyers out there make grand claims. We've committed to purchasing 5 million credits from this developer. That developer fails. That buyer now has reputational risk because they would have put that into their carbon accounting. So I think everyone's just maybe calming down in the claims they're making, but there's still a lot of activity occurring now.
At a subterranean level, they're just sort of not, publicly shouting about it.
Yeah, but I've also got to believe in it because I'm selling it. But that's what I'm experiencing.
Brilliant, thank you for that. Okay, so moving on to the second question on risks. There is an emerging trend that we're seeing especially play out in the TNFD adopter space on organizations moving towards insetting, as a first step. So it's more of an existential question, actually. I mean, do you see this pivot towards insetting posing any kind of demand-side threat to NBS or CDR, engineered CDR projects, or is it, all part of making the pie bigger? Yep, Max?
Yes and no. I think the largest, so staying the NBS space, the largest corporate with a semi-public commitment is to kind of insetting is Nestle. I think it's $100 million. $100 million doesn't go that far in kind of large-scale planting or restoration activities. So I do question, and then with the kind of disconnect within a global supply chain, you're buying cocoa that's gone through a mixer, that's gone through a processor, that's gone from a middleman, that's come from the farm. I don't know how much pressure you can put through that supply chain. And I think where carbon markets are still very powerful in the insetting space is you could use that or project developer to go straight to the farm.
Yeah.
There's also an equity question I would like to put out to everyone here, which is you can do outcome-based payments to incentivize people to be more sustainable and kind of more positive for the environment, but actually you're still putting the risk on normally a smallholder farmer to make that transition to being more sustainable on their farms. They normally, in the tropics or the global south, can't access cheap capital. And actually, I would like to state that NBS projects can be an assistance in that transition financing. You can have a blended approach to do regenerative practices as well. So it's a certain type of use case for restoration projects. It's not the whole market, but I think in that regard, it can also be added into the insetting space.
Great, thank you. Phoebe and Henning, any additional thoughts on this, on insetting?
I think insetting can be a really great use case for projects or methodologies that actually no longer meet some of the ICBCM approved methodology kind of requirements. I think things like some soil carbon projects that will struggle to meet the requirements of carbon crediting and kind of get financing that way can actually start to look at different types of conservation funding or insetting schemes that might work in the longer term, where those kind of incremental benefits of storing carbon in the soil or different methodologies like that might actually benefit more from transitioning to insetting schemes rather than offsetting. Interesting, because what we're seeing in the TNFD space is that organizations are choosing to inset as a first step, in the mitigation hierarchy, rather than, if they don't meet the ICBCM principles. So, yeah, maybe we'll take that offline. Henning, any thoughts from you?
Yeah, two thoughts. One thing that I really like about insetting and one thing that I'm quite concerned about. What I really like is that you can actually build coalitions, right? I mean, to stay in that example of that cocoa value chain, you can partner between Barry Callebaut, Nestle, and Walmart, to pick random names, because all double count their emissions along scope 3, so all can also benefit from that reduction and they can share the burden if you establish a really, really robust data sharing across all of them. So that, I think, is a fantastic characteristic of these insetting projects. What I'm concerned about is in some instances the motivation of companies. So what I felt and what I've heard from a couple of clients, especially in 2023 after the Guardian articles, was this statement: look, we wanted to buy offsets and we wanted to kind of build a offsetting strategy, but now that offsets are criticized, let's just do insets, because we've never seen those criticized.
Right.
And that might work for a company like Nestle, who I think has the deep institutional knowledge about the supply chains and robustness of data sharing and being transparent. But you can very easily see a scenario where kind of there is a growth in insetting, and then there's more money being spent and more consultants I love consultants, but like more kind of companies moving into that space, and that market then growing and growing and growing, basically without any oversight, because we don't have the standards yet. Verra just published their Scope 3 standard. There's the Value Change Initiative and a couple of others, but this is very, very early stage. And so the worst case scenario, in my perspective, is that 5 years down the road, we're going to have a series of Guardian articles about the practice of insetting without any certifications, everybody doing whatever they want, and then, all of these anecdotal stories about, you can fill in the blanks here.
Yeah.
And so I think the market needs to be very, very careful to make sure that whatever happens in insetting is properly certified, regulated, quality controlled, and made as transparent as possible, and
Great
not
points.
done for the motivation to evade the public light.
Great points, thank you. I'm conscious of time. Can we have 5 more minutes?
Well,
or do we need to move to Q&A? Yeah, okay, all right. Okay, let's wrap up quickly then. So we didn't get to move to the climate rowback across the Atlantic and any of the kind of, experienced pushbacks of that. But I'd like to just quickly move to the opportunities side of the story and end on an optimistic note. So, to take a leaf out of the FTI Consulting's playbook, they said that the US cement sector for CCUS projects alone, can generate 7,500 jobs, 1.8 billion in economic output, 250 million in tax revenue. So despite all these ongoing headwinds, are you optimistic, about the future scaling up of CDR and NBS, engineered CDR and NBS? And if so, how's your organization sort of positioning itself to harness the opportunity? Henning, could I start with you?
I'm largely optimistic. I'm pretty sure it's going to be quite wobbly going forward, like it has been for the last 20 years. What we are doing, on the internal side, maybe let me give that anecdote. So we are doubling down in the sense that We've historically mostly purchased spot credits. We're quite aggressively now moving into offtakes. Just last week signed our first one, and we're going to publish the information about that quite soon. And 2 others in very specific, kind of in the very near future following. So from that perspective, I'm quite excited about what's to come.
Great, thank you. Max?
Yes, broadly optimistic. I think it is a very kind of, 2023 will happen again without fail, and it might become a cyclical thing as the carbon market keeps self-improving. I think in terms of the row across the Atlantic, I think there's been a lot of discussion around kind of a change of tides, but we've seen a lot of corporates like Bain just double down, and we've not yet seen any corporate walk away from a commitment yet. If someone knows differently, we'd love to, happy to discuss it, but haven't seen a big public walk away from people we've been discussing with.
Thank you. Phoebe?
I am very optimistic. We've seen some fantastic projects over the last couple of months, and we really need to focus our efforts on supporting and scaling some of the fantastic work out there to deliver the biggest impact on atmospheric CO2. As for insurance and our ability to kind of harness this opportunity, we're seeing more and more contracts require insurance as a condition precedent. So hopefully it might get to the stage where insurance is actually just the kind of boring part of the puzzle, and the more repeatable, scalable and bankable these structures are, the easier it is to make the market scale and to get financing flowing into the fantastic projects.
Brilliant. On that heartening note, can we please give the panel a loud round of applause? I don't know if we have time for Q&A. We don't have time for Q&A, right? No. We don't have time for Q&A, right?
Well, we're 10 minutes behind, so...
Okay. Thank you.
We can keep going. All right, thank you, Nihat. Thank you, panelists. My 5-star rating is slipping away as we speak from being rated as a chairman. So let's move on to the next panel. I'd like to welcome Dave Worthington, and the next panel discussion is on corporate decarbonisation strategies beyond buying carbon credits. Thank you.
Thank you very much. So last panel of the day, saving the best till last, obviously. So I'd like to invite my panelists up to the stage, please. So a brief introduction to myself and some introductory words before I hand over to our panelists to do the same. So I'm Dave Worthington, Managing Director of Velco. We're a sustainability consultancy focused on climate net zero support and part of the BIP Group's Global Sustainability Centre of Excellence. Personally, I've been in sort of carbon market space for over 25 years. At the dawn of what we call carbon management back in the day, so helping companies work out how to reduce their emissions and what a carbon reduction plan looked like. And we had a sort of interesting ride with the first carbon markets boom up to the global financial crisis in 2010, and then saw a big change in what corporates needed in terms of support. And I'm looking back at some of the parallels with maybe what we're seeing today, but there's some fundamental differences. So obviously we've got a very different world in terms of physical climate risk being a reality rather than a distant prospect today. We had the World Meteorological Organization report this week that we've got 70% chance of exceeding 1.5 degrees over the next 5 years, so global temperatures continuing to rise and that increasing climate risk. And we've got much stronger framework of targets now. So despite the US pulling out of Paris, we've still got 78% coverage of the global economy with net zero targets. And really it's the corporates that are setting ambitious targets and delivering on those that is giving the politicians the important signals that they should stand by the government targets and raise their ambitions in the run-up to the next COP. So the exam question for this panel really is how businesses are achieving this balance between pragmatic plans which increase competitiveness in the short term, in what is a tough economic market, whilst maintaining their progress momentum towards the longer term goals. And how are the companies doing that in the best way, and what are some of the lessons learned from those that are tried and have failed and looking to do things differently? So with no further ado, I'll introduce our panel. So we have Elaine Smith-Gillespie, Director of the Carbon Trust, Sarah Ferretti, Associate Director of Sustainability, Net Zero and ESG from Turner & Townsend, and Sherry Hickok, Chief Executive Officer at Climate Impact Partners. Elaine, would you like to go first with some introductory words?
Sure, thanks a lot. Yes, my name is Elaine Smith-Gillespie. I'm a director of the Carbon Trust. I've been with the Carbon Trust for over 10 years, part of the journey that we've had, and working with clients in many different sectors. And we work on helping companies along their entire journey, and transition journey and climate journey, from identifying what the key drivers are for making the case for taking action, through to developing strategies, through then helping them implement that as well. So, real pleasure here to be here today and to talk about some of the issues.
Great, thanks, Sherry.
Yeah, great. It's great to meet you. I feel like we should act like a professor and make you all come to the front of the classroom. You're all sitting quite far back. It's a pleasure to be here with everybody, even if it is the last panel of the day. So hopefully you find this of value. I'm the CEO of Climate Impact Partners. I've been with the company for almost 2.5 years now. I don't come from the carbon markets traditionally. I'm actually from corporate America, engineering background, and grew up in General Motors, so automotive, and then GE and renewable energy, building wind farms. But that's a lot of what I'm trying to bring into Climate Impact Partners, is how we think about scale. There's been conversations today around thinking about carbon projects, or this is a project-based market, large-scale infrastructure. And even you may not realize this, but if you think about automotive and how they drive scale, quality and volume is of the most imperative elements there, and how they can do that in a repeatable fashion. There's a lot of elements that can be brought into this market around standardization. I mean, these are elements that we're talking about that you hear, like commonization on the basis, and then you're unique where on things that don't impact fundamentals. So that's how we think about things at Climate Impact Partners. If you're not familiar with CIP, we're a 27-year-old company in the carbon market, and we operate both on the retailer intermediary side all the way through to project development. And I like to say we span the market across the full value chain, doing everything from secondary sourcing to greenfield origination on the ground. And we operate from across all project methodology types. So, and over the last 27 years, we've either reduced or removed over 150 million tons. So we're quite proud of that.
Fantastic. And Sarah?
Hello, everyone. Nice to meet you, and thank you for still being here. So I'm Sarah Ferretti. I'm a director at Turner & Townsend within our sustainability department. Turner & Townsend is an 85-year-old consultancy firm. We specialize in program and project management. So we've been working with the infrastructure sector and with the built environment for the largest part of our history. And the sustainability division was created about 5 years ago in response to a demand mostly from the public sector to manage and to support with the implementation of large programs that go to invest into the decarbonization of social housing. From there, we've then specialized and invested heavily into subject matter expertise to go and support our existing client base. We usually come in and interface with corporation, with the private sector when they are at the beginning of their implementation journey, of their decarbonization and net zero journey. So they may already have set targets, made pledges, and they need to figure out how to roll out a series of initiatives. we usually encounter the private sector when they tackle their scopes 1 and 2 emissions. And we like to think that we want to leave our clients at the end of their journey when they've actually realized that the biggest part of their endeavor is yet to begin, to involve all of their scope 3 emissions and then the beyond the value chain strategy. So our journey with corporates is a journey of enabling them to understand the shortcomings of their, initial strategy and to develop really resilient strategies that empower them for a successful delivery and implementation.
Okay, well, thanks very much. So we'll start with the first question, which is intentionally fairly broad. So what are the most effective ways that organizations can achieve deep emissions reductions, both within their own operations and supply chains? And also, any lessons learned from approaches that didn't work out so well? Looking for some examples, case studies. So, Sherry, would you like to start us on that one?
Yeah, I'll get us started. And maybe, again, just thinking about what has worked in other areas or what hasn't worked in other areas. As we talk to CSOs or the companies we work with, one of the most important things as you start on a journey as a corporation is having buy-in from the top. And I think this is very typical of any major project that you may participate in. So an alignment on what the strategy and vision is for the company, and really alignment on what the why is. And you heard a little bit about this through some of the panels today, but I think it's also evolving, especially now, where corporates may have predominantly done in the past, been engaging in the carbon markets more from a CSR perspective, or it's the right thing to do. But now really it's becoming like, how do we create value from this? And it may be a risk mitigation. It could be because they see regulation coming or compliance coming, or it may be because they need a license to operate. So really being aligned on that why from the top of the company down is so important, because what we've seen is where that's not happening, the CSOs or the sustainability teams really can't get buy-in, they can't get budget, they can't get prioritization, they can't get business units to engage. Where we've seen it with real buy-in across the business, and I'll give an example of a tool of how they get real traction, and it leads to even other improvements like employee engagement, shareholder engagement, other positive things, consumer engagement, that does become a value driver. One of the tools we're quite fond of is putting a price on carbon, integrating emissions costs into the actual KPI structure of the business. I think you all know whatever your business goals are, that's what you focus on. That's what your bonus is based on. That's what you're rewarded on. That's what the goals are targeted to. And so when companies can actually embed the price of carbon, and there's many ways to do it, into the actual structure, the KPI, the reward system, they get the most traction. I think it was in the first panel today where one of the members talked about when doing this, then they actually are identifying the realization of how much is this emissions actually costing us, and they can make the right choices on should they be decarbonizing, how do they make the most efficient decisions to take responsibility for their emissions on their pathway to net zero. And I know my panelists will talk about the importance of some of that language. Microsoft is actually a key example, and I know Microsoft gets talked a lot about, but I think this is important. They implemented a price on carbon over 10 years ago, okay? So when you think about where they're at from a business, like everybody's moving in the same direction, and kind of how I talked about everybody's bought in, it's because they've embedded it. So really embedding into the goal structure and measuring performance will enable consistent alignment across the business.
Fantastic. So leadership and the right price signals. And so if I come to you on what are some of the sort of fundamental success factors that companies need?
Well, that I should know. We've seen an awful lot of organizations succeed and put in place very successful strategies. Equally, we've witnessed some shortcomings, and we've learned and we've helped our clients learn from those mistakes. So to put it and turn it all into a quite simplistic 5 bullet points type of list, strategies that succeed tend to have in common these 5 factors. First of all, they tend to be data informed. So that means not setting the targets or not be tempted to make a pledge and go out there and commit on a website or elsewhere before having completed your base year greenhouse gas inventory, complete of all scopes and all 15 categories under Scope 3 emissions. It also means, and this is such a basic one, but it's essential, a successful strategy means that a corporation or a large organization needs to have gotten their head around how to monitor carbon intensity through KPIs and intensity factors rather than absolute numbers. Why is that important? Because corporations are very fluid. They constantly change. They divest and invest. And every year they can let go of, 5, 10, 6 subsidiary companies and acquire as many. That means that for organizations of this caliber, it's essential to have all the processes in place to have their numbers under control so that they don't need to continuously re-baseline these stalls progress. The second element is, and the most important completely, is having a solid financial planning. That means, coming back to Sherry's point, having a carbon pricing mechanism or another internal mechanism that makes sure that an organization has budget, dedicated, allocated budget between now and 2050 to decarbonize itself, to reach its goals. Without a solid financial planning, then strategies are, fail to set up to fail. And then another important point, and we can talk later about this, is to find potential revenue streams to also continue funding decarbonization. Through product diversification, through maybe even different evolutions, potential future evolutions of the carbon market that goes to serve the private sector. The third fundamental is to have complete buy-in from all internal and external stakeholders. And complete buy-in based on our experience is only ever achieved when there is agreement around the core values. So decarbonization has to talk to an organization's core values. If there isn't a total investment into the core cause, then in the long run there are bound to come up moments when other priorities become more important. And so strategies that succeed are strategies that are embedded and talk to how an organization desires to evolve over time. The fourth point is governance systems. So here we're at the implementation moment, and fantastic strategies can fail because they're not supported by the right type of implementation, and so they can't be rolled out very practically. So strategies that are successful are those that can rely on a practiced, proved, and tested governance system. Meaning, organizations that I've seen do the best at all are those that started greenhouse gas accounting 10, 15 years ago. Why? Because they put in place, without ever thinking that they were doing it, a system, a governance of roles and responsibilities that originally were just used for accounting and data gathering and due diligence. And then over time, these responsibilities have been turned into allocated, nominated roles and responsibility for the implementation of solutions. And so all those names, all those roles are already embedded in current governance. And finally, monitoring systems and the use of useful KPIs is essential, because how can you intervene and modify a strategy if you don't know if you're meeting your target year on year? And so again, finding KPIs that are meaningful to indicate whether your organization is progressing in the right direction is the final essential, I would say.
Fantastic, thanks, Sarah. I love a 5-point plan. Elaine, we just come to you. I know that the Carbon Trust are very involved in innovation, and so maybe bring some thoughts on how companies sort of innovating their way to success in decarbonisation.
Yeah, thanks. Really comprehensive answers there. So I'm going to attempt to build on those and try to bring in the innovation point as well. So I think the point that Sherry, you mentioned at the beginning, which is about linking sustainability to value, is really important. I think we're going to keep on coming back to that in this discussion. And the point by Sarah about buy-in. So buy-in driven by values, but also value as well. So we really are seeing a lot of companies who are saying, yes, we want to do the right thing, but we need to sell this to our investors, and we need to get the CFO on board. We need to actually get the financing, therefore investors on board as well. So part is building on some of the points I said earlier on about that. I really like the point about being data-driven and informed, and adding to an analysis of carbon emissions is really understanding what's driving carbon in the business model of a company. So where is it happening? And then that allows you to link that to ways of addressing that. So some of them are driven by actually the way the company works and its business model, which may need to change. The other is an analysis of risks as well, so bringing climate risks into the equation as well, the value-based equation too. And importantly, trying to link the dependency between carbon emissions and reducing carbon risks as well. So deep analysis of carbon emissions, climate-related risks as well. We talked about nature in the previous panel too. That can come in as well. Then taking a really rigorous approach to assessing decarbonization measures. One of the previous panelists talked about marginal abatement cost curve analysis. That kind of financially driven analysis is really important, and we find ourselves doing that a lot when working with companies across different sectors. So understanding what is it going to cost to reduce a certain amount of carbon, where do you get the financial bang for the buck, the biggest bang for the buck, from a financial and a carbon perspective, and then using that to prioritize and strategize. Other considerations, building what has been said, is about assessing financing constraints, but also opportunities. So where could you unlock financing, both internally, maybe through carbon pricing, for example, but also externally, by drawing on the financial markets and meeting those needs. And also acknowledging organizational capacity, the realities and opportunities there. So there's only so much change sometimes that organizations to take. So how do you actually space out your transition plan over different time horizons? So a number of different considerations. So a pragmatic and effective way of planning things out over multiple years, and also acknowledging that this will always be live. It's not going to be fixed in time. You need to be prepared to change the plan in response to changing realities and additional information and additional opportunities as well. So some particular examples where it gets really quite hard. Obviously, a lot of companies do have opportunities to buy renewable energy, to decarbonize Scope 2 emissions in their own operations. Where it can get very hard is around Scope 1 emissions, especially in hard-to-abate sectors where there are process emissions to contend with. And this is where innovation comes in, and sometimes companies need to play a long game as well. So having a plan that covers short-term, mid-term, longer term. So sometimes the hardest things do require time and will require innovation. And importantly, especially when it's hard to abate own operational emissions, but also Scope 3 emissions in the supply chain or wider value chain, working with suppliers, working with other companies, peers in the industry that have a similar problem as well. So we do a lot around joint industry programs and joint industry innovations. So identifying common challenges, working together, co-financing that, and creating a roadmap, even at an industry level, to address those things over the next 5-10 years is really key. So collaboration, really important. We may come back to this later, but Scope 3 emissions are obviously the thing that companies find hardest to address and influence. Depending on the sector, depending on the business model, there's actually a lot that companies can do. For example, looking at their product design, product portfolio, product and service design, can actually, and changing that through, for example, circular economy business models or other ones, can cut out a lot of upstream Scope 3 emissions, supply chain-based emissions, and also can cut out downstream emissions of the in-use of products. So the companies we work with, especially, for example, in the ICT sector, manufacturing sectors, have found many different opportunities there. That, again, will take time. Changing a business model is not easy. It requires identification of opportunities, piloting them, getting, again, the buy-in from the organization, but are really exciting, and we can actually get a lot of traction going forward. So I'll stop at that, but I'm sure we'll revisit some of those topics.
Fantastic, and all great content. But I wanted to move on to the more sort of near-term considerations and question around the impacts that the current global economy is having on the work that corporates are doing on decarbonisation today. I mean, across our client base, we're getting mixed signals. That on the one hand, messaging that there's no let-up in terms of investor requests for information around performance on climate and broader ESG initiatives. You know, if anything, asking for more and more detailed information and wanting to bypass some of the standards and frameworks and going straight to the raw data. But on the other hand, concerns about the ability to move forward with the bigger capital programs where there's so many uncertainties around the cost of key materials and services. So yeah, I'd like to hear from the panel on sort of what you're hearing from your current base at the moment. And again, start with you, Sherry.
Yeah, sure. I'm happy to start. I think, I don't know, I should know this. I'm the American on the panel, right? But how many days since he's been in office wielding his wand? So I don't know if the full implications have yet to be seen. I'll say it there. But what I can tell you, and I'll come from the perspective really of what I think is the most discretionary spend, which is carbon credits, right? That's where our company is playing at, an investment in carbon projects. We're still seeing action. And just some data points, and I think it's been talked about today, but one survey that was done by WineReb has stated that of the, I think it was about 250 CSOs they surveyed, 90% saying their plans are intact. 24% said they would be quieter about them. And that message is the same message that I'm hearing when I'm in Singapore, at the Ecosperity conference, to when I'm talking to our US team or clients, to here. And so right now, action is still being taken, which I think is great. And I think that does come back to what you were referencing. Now, our own report of the Fortune Global 500 that we did last year said 42% explicitly plan to use carbon credits on their net zero pathway. So we believe that action will continue. And I think there's been kind of mixed commentary a little bit today, but I have a view on it is the market up, is the market down? The market is actually held resilient at 180 million tons over the last 3 years. So yes, it's not been at the growth trajectory that I think everybody was anticipating, and therefore there were a lot of new entrants, and so a lot of new mouths to feed. But the reality is, even in this uncertainty, whether it's regulatory, whether it's political, economic, the market's holding for the carbon market. And I think that's a really good sign. And it's also been said today between VCMI, ICVCM, the number of governments, which will be my second point of what I think we're seeing, but the number of governments leaning in, is it's actually, I feel, as someone who joined January 3rd of 2023, and people who are in the carbon markets know what's happened over the last 2.5 years, I feel like it's stabilizing in a lot of ways, and it's more leaning forward. So I don't see a negative downturn, and quite the opposite. I think what we're seeing is governments, like you heard from Chris Shipley this morning, talk heavily about how the UK government is leaning in to say, how do we spur demand? The Singapore government has implemented a carbon tax. There's other governments, I heard today from someone else that Taiwan is looking at this. So there is a lot of places from a government regulation perspective, and even the fact, who thought 2.5 years ago that the EU ETS would be talking about putting carbon credits in? Okay, so I think about all of this as very positive signals. Now, it might not be the next 12 months per se. Even what SBTI is putting in potentially for version 2 of their net zero framework for corporates, it's all moving us in the right direction of more accountability, turning commitments into action, and we think corporates are still there. It just may be a bit slower, and it may be a bit quieter.
Okay, glass half full response on that one. Sarah, what are you hearing from your clients?
Well, I would say that your optimism could sort of, gave me a bit of a bit of energy. So from our side of things, we are seeing a change in narrative, quite a recent change in narrative. And by narrative, I generally mean, the words used and the choice of wording for internal as well as external messages. Sometimes even, sitting and considering the opportunity of changing the names used for, the same good old things, from sustainability to climate change, etc. So very many of our clients, and I would say of society, are currently sitting with that conundrum. At the same time, de facto, we haven't seen any change in the doing. We haven't seen any client pulling back. We've not seen any client postponing interventions that already, in the making or in the plan. We were already seeing a little bit of, I would say some degree of difficulty from the finance sector, so from banks, in the engagement with the decarbonization of financed emissions. So that reticence to sign up to the SBTi for financial institutions, that reticence from the banking industry to sign up to big disclosure type of framework. But we were seeing that way before the more recent changes. And equally, we've also seen great availability from the SBTi to work with the financial sector to figure out standards and target setting methodologies that do take into account the genuine needs of the finance sector. So all of this definitely generates some cause for optimism.
Fantastic. So we've got green hushing, we've got rebranding. Elaine, are you seeing anything else at play?
Well, I would confer with a view that companies are still forging ahead. And while the political climate in some countries, I mean, it's really of course, the U.S., but also, I mean, it is a factor even in Europe, right? There's like lurches to the right and questioning of this, and I think it's part of the maturing of everything because people are trying to figure out like why are we doing this again and what's the point of this? So it's a healthy debate that we need to rise up to, and of course, despite all that, the actual climate is not changing; it's still going in the wrong direction, and that is becoming increasingly apparent, and that'll come through ultimately through voters, through a lot of issues that will affect politics as well. So again, to reemphasize the previous point we're making, that creating a clear business case is really important, and really bringing into this all the factors, so both the long-term and short-term factors, risks and opportunities, all that is very important. We have also seen a bit of reframing in terms of external messaging. And to be fair, probably those companies that are looking at this still perhaps on the less mature end of their strategy, looking at this more from a compliance perspective, have taken their foot off their pedal a bit. But the risk is there that it's going to get even worse for them later on. So if they're not on the front foot and not putting in the measures now to address climate-related risks and opportunities and decarbonization, is just going to get even harder for them. And I think they are understanding that. Also, there's a lot of clear, I mean, you mentioned the sort of economic conditions, of the geopolitical conditions, things like cost of energy, that just feeds into a positive business case. The volatility of commodities or volatility of energy prices, again, feeds into a business case. So whether or not it's being reframed, I think the case is just getting stronger. And certainly that's what we're seeing in the work we're doing with clients. And I think the CFOs get that. But there's a challenge in just making that really clear to those that make decisions. And not everybody in companies are equipped and understand how to make the case strongly. So we're trying to work with those teams. In fact, we're collaborating with the WBCSD, the World Business Council and Sustainable Development, to actually develop toolkits for teams who aren't used to creating business cases on a day-to-day basis to be able to communicate that effectively. And of course, that does require strong working between sustainability teams, finance, strategy, procurement, different functions. So again, we are seeing a maturing of building relationships between different functions. So hopefully that's gonna create positive things in the coming years or so.
I can see we're over the advertised time. Have we got a chance for one final question to wrap up?
Yeah, I think we can wrap it up. Yeah. One more question.
One more question. Okay, well, I mean, we've saved the most difficult one to last, and I mean, it's the multi-billion-dollar question for the carbon markets in terms of the demand side, which is how do you get that balance right between the internal value chain mitigation and the external action? So, how are corporates really getting that balance right, and what's the right thing ultimately for our achievement of global targets? Not an easy one to address in very limited time, but Sherry again.
Yeah, I'll kick off. First of all, we believe obviously in the mitigation hierarchy. So we should obviously avoid what we can avoid, mitigate what we can mitigate, and then there's a residual left over on a pathway. And I was actually inspired by the first couple panels using the words carbon neutrality. I was like, I thought those were like crossed off, like nobody's allowed to use it. So this idea feels like it's coming back around, taking responsibility in year for what you're not able to mitigate on your pathway to net zero. And I think that is really the balance. And there's no perfect balance, right? I'm sure there's, because it's hard to make these decisions. It's hard to do these business cases. But I think moving into a place where corporates feel accountable for taking action and being responsible for what they aren't able to take account for. And one of the reasons we think the carbon markets become a really great tool, and it was said earlier, is it starts to show the price or the cost of those residual emissions to a company. It's putting a price on carbon without them realizing it if they're actually carbon neutral in the year, which is a really valuable tool. Now, there's ways to do that. Beyond value chain mitigation is coming into SBTi. We would argue that companies have been actually doing BVCM. So any company that's been investing in carbon credits has been doing BVCM. So it's not a new thing. We're just calling it a new thing. But the fact that SBTi is now trying to bring that into its actual structure for the pathway to net zero for corporates through their revised standard that is under consultation. And just an advertisement, that consultation input closes tomorrow. So if you have input, please make sure you get that in. I think actually June 1st, so maybe Saturday, I guess. But, we think that companies should take accountability for their residual. And there's data that shows that companies that are investing in the carbon markets are actually reducing their own footprint or decarbonizing twice as fast. And again, it comes back to that cost. They see that cost and they say, why am I spending for something outside the company when I could be driving it in? So just due to time, I'll leave it there. But lots of examples of how companies are doing that well.
Great, thanks. Sarah?
I would agree, but coming from a different angle. So corporations, as we see them, are right now, by and large, struggling and working on decarbonizing their core emissions, their scopes 1 and 2 emissions, and they've already started working on their purchased goods and services, capital goods emissions. So these are sort of the scope 3 emissions on which action has begun, mostly on data improvement and actual data acquisition and so on. What we are seeing is a private sector that, there is almost a divide between private sector that contributes to climate change, but whose core activities are not the sectors that contribute the most to climate change. For example, the service sector. They can decarbonize, they have a plan as long as they have a solid strategy and some, budget left aside. They can do it. There are then clients from sectors that are highly carbon intensive, energy, electricity generation, heat production, the agricultural sector, deforestation, transport. So clients from sectors like these are looking at a genuine dilemma. There will meet a point where they've installed all of the air source heat pumps that they can. They've installed all of the rooftop solar that they technically can, and all of the LED lighting has been there for 15 years. There'll come a point where they will have to tackle a profound, deep change in what they do, what they provide society with. So for these organizations, looking beyond the value chain is probably not what serves them best. They need to look deeper and to find resources from the carbon market as well as a multitude of other instruments, to find resources to tempt them to change deeply. And so this is what I hope, the carbon market can help us shape and do.
Len, last words with you.
I'm going to try to preserve your 5-star rating. Just very briefly, I think just compliment, one thing that may be an area that complements the investment in carbon markets we're talking about is how companies in certain sectors actually where their products and services can help enable positive change in other areas. So back to the innovation question. Some companies may have this opportunity, and so being able to quantify this and then to attract the financing for that through, say, alignment with green finance taxonomies or criteria could be a really interesting area to look at in addition to the carbon markets too. So that is something that could help enhance, again, the business case and bring new business opportunities and revenue to companies as well who are in that position. So I'll just add that final comment.
Okay, well, on balance, I think a very positive summary from the panel. So all that remains is to thank them in the usual way.
Okay, thank you to all the panelists and you, Dave, as well, for moderating. That was fascinating. So I'm going to wrap up really quick. I know a lot of people need to get out of here. But obviously a huge thank you to everybody that attended, everybody that sponsored, supported today, including our people that joined virtually as well. Thank you for coming along. Obviously, a big thank you to the team that made this happen today from Citi and Financial. I think it's been a really great day, and I think everybody is taking away a lot from today's conference. The only other thing is the questionnaires. Don't forget to do your questionnaires, of course. I think I did see a sign where there was some free champagne to one person for completing the questionnaire. So don't forget to do that. And also, all the footage today will be available on demand as well. So everybody will receive a link. So if you did miss a session, you'll be able to catch up on it at a later date. And with that, I'll close today's conference. Thank you very much. Thank you.